To the lesson, the topic is the financing decision. Today we continue with the long-term sources of funds. So far we've covered equity, debt. Today we proceed to the third long-term source known as hybrids. Hybrids, which is also known as hybrid instruments or hybrid securities. And these are financial instruments that combine features of both debt and equity. They possess characteristics of both the traditional debt and equity instruments, providing companies with a flexible and innovative means of raising capital. So in this lesson, we are going to discuss the characteristics of hybrids. We will look at the advantages of hybrids and the drawbacks of hybrids as long-term source of funding. Let us begin with the characteristics, the features, the attributes of hybrids. Attributes of hybrids. So candidates, by the end of the lesson, you should be able to explain or outline the characteristics of hybrids. You should be able to highlight the advantages and also the disadvantages of hybrids. So let us begin with the characteristics of hybrids. Now, the first characteristic of hybrids is the blend between debt and equity. Debt, equity, blend. Debt, equity, blend. Remember, I've just said that hybrids combine both the features of the traditional debt and the traditional equity instruments. And a good example of hybrids is the convertible bonds, the mezzanine debt. We may have hybrids like the warrants, the preferred stocks, and so on. So one characteristic is the debt equity blend. The debt equity blend. Blend means combining. Hybrids combine the elements of debt and equity, which then allows companies to benefit from both the characteristics of both debt and equity. That's first characteristic. 2, fixed and variable returns. Fixed or variable returns. Hybrid instruments may offer fixed returns that are similar to debt or variable returns that are linked to company's performance, which resembles equity. Fixed and variable returns. Then we have convertible features. Convertible. Hybrids, some hybrids have convertible features, allowing holders to convert their instruments into equity shares under predefined conditions. Convertible features. 4, participation in profits. Participation in profits. Hybrid holders may participate in the company's profits, receiving maybe distributions or even dividends based on the company's performance. Based on the company's performance. 5, subordinated nature. Subordinated nature. What does that mean? That means that hybrids are often subordinated to the traditional debt. They are subordinated to the traditional debt, meaning in the event of bankruptcy, the claims of hybrid holders come after the claims of the traditional debt holders. When it comes to prioritization, then hybrids are subordinate to the traditional debt. Then we need to mention perpetual existence. That's a key characteristic of hybrids. Hybrid holders may, the hybrid instruments have no fixed maturity period or date, which provides a perpetual form of capital similar to equity. Perpetual, it gives company perpetual existence. So these are 6 features. Then how about the pros of hybrids? What are the pros of hybrids? Pros of hybrids. The first advantage is flexibility. Flexibility. Hybrids provide flexibility in structuring financing, and companies can tailor the terms and conditions to meet specific needs, blending features that suit their financial strategy. They are flexible. It offers what we call tailored solutions. It offers, this form of funding offers flexible terms. It offers flexible terms and structure, which allows companies to customize by blending the two characteristics of debt and equity. Do you understand? It offers flexibility in structuring financing. And I've said companies can do what? Can tailor the terms to meet specific needs. Flexibility. Number 2, it offers diverse investor base. Diverse investor base. Hybrids offer diverse investor base to the company, including both debt and equity investors, as well as those seeking a module or a middle ground between debt and equity. Diversity. Risk sharing. Number 3. Risk sharing. How is it an advantage? Hybrid instruments allow for sharing of risk between the company and investors may benefit from the upside potential while accepting a level of risk similar to equity shareholders, equity holders. 4, it offers what we call enhanced capital structure. Enhanced capital structure. Enhanced capital structure. The capital structure is enhanced. The use of hybrids contributes to a more diversified and resilient capital structure, which optimizes the overall cost of capital. Then we have convertible options. Convertible options, convertible options, convertible options. How is this an advantage? Now, convertible hybrids provide the option for investors to convert their instruments into equity, which allows them to participate in potential capital appreciation. Convertible options. So these are 5 advantages. We will close the lesson by discussing the cons of hybrids, the cons of hybrids, the disadvantages of hybrids. The first obvious disadvantage is in relation to complexity. You understand? Complexity involves complex documentation, complex documentation, and that is a disadvantage, including negotiation, complex documentation and negotiation. Now, structuring and issuing hybrids may involve complex legal and financial considerations, which may require specialized expertise and higher transaction costs. That is a disadvantage. Complexity. It's complex in structuring these instruments. The hybrid structure can be complex, which can make it also challenging for investors to fully understand the terms and risks associated with the instruments. Complexity. Cost of interest rates, number 2. Cost of interest rates. Cost of interest rates. Cost of interest rates. Now, the cost of hybrids, including any fixed or variable costs, may be higher than the traditional debt. Additionally, hybrids are subject to interest rate risks, which affects their pricing and attractiveness. Costs and interest rates. That is a disadvantage. Subordination, from the word subordinate. Subordination. In the event of financial distress or in the event of bankruptcy, hybrid holders are subordinate to traditional debt holders, and that can impact recovery in case of liquidation. So that is a disadvantage from the point of view of the investors. For market acceptance. Market acceptance. The acceptance of hybrid instruments in the financial markets may vary. Do you understand? It may do what? It may vary. And investors' perceptions and willingness to invest in such instruments can influence the success of hybrid offerings. Because remember, we said that these instruments are complex. They are complex. They are not straightforward like equity or debt. There's also the feature of tailoring. Do you understand? So the market acceptance can vary. In the acceptance of the instruments can vary in the market. financial market, which can then affect investors, which affects investors' perceptions and also willingness to invest in such instruments. Market acceptance. 5. Regulatory considerations. There are also regulatory considerations, what we may refer to as regulatory frameworks. And these regulatory frameworks for hybrids may also vary, and compliance with the relevant regulations can be crucial, or we can say is crucial. And companies must navigate the regulatory requirements when issuing hybrid instruments. Hybrids also are subject to covenants, which could be restrictive. Let me say covenants and restrictions. Covenants and restrictions. Now, similar to debt, hybrid agreements might impose covenants which can then restrict financial activities or future funding of a company, thereby limiting operational flexibility. Remember, we say that hybrids is a source of fund that combines both the debt and equity characteristics. It's a debt equity blend. So this feature of debt in relation to covenants and restrictions. And I've said similar to debt because some hybrids may take the form of debt, some features of debt, and one feature is having restrictive covenants, which might impose restrictions, financial restrictions, which may affect the operational flexibility of an organization. That is a disadvantage. So these are 6 drawbacks, 5 benefits, 6 characteristics. Characteristic number 1, hybrids. A hybrid instrument is a debt equity blend. We have fixed and variable returns for those who invest in such instruments. These are returns, it can also be costs on the part of the company. It has convertible features. We've seen that there are some convertible bonds that can be converted into equity based on agreed terms and conditions. For participation in profits, hybrids instruments or hybrid holders may enjoy participation in profits just like the equity holders. Number 5, subordinated nature. When it comes to prioritization, when the company is being liquidated, then hybrids are subordinate to debt holders. Hybrid holders will be subordinate to the debt holders. Then the source also gives the company perpetual existence. They do not have maturity period like debt. These are 6 characteristics. Then the first benefit is that of flexibility. Number 2, hybrids give the company diverse investor base. There is risk sharing. We also have enhanced capital structure and convertible options. Disadvantage number 1, complexity, cost of interest rates, subordination, market acceptance, regulatory considerations, covenants and restrictions. Now, candidates, in summary, we can say that hybrids offer a unique financing solution by combining both the features of debt and equity. They provide companies with flexibility. They provide companies with the ability to tailor financing structures in order to meet specific financial needs. But on the other hand, the complexity of hybrids and market acceptance are factors that require careful consideration when incorporating them into the company's capital structure or in the company's long-term funding strategy. And that brings the lesson to an end. I'm going to give you an assignment, 3 questions. Number 1, what are hybrid financing instruments and how do they combine elements of both equity and debt? Number 2, in what situations might a company choose hybrid financing over traditional equity or debt? And what advantages or disadvantages does it offer? 3, how do regulatory frameworks and market conditions influence the attractiveness and feasibility of using hybrid instruments for financing? These are 3 questions. Attempt the questions before coming to the next lesson, where we are going to study the characteristics, the disadvantages, and the advantages of leasing finance, lease finance. Bye.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri and I practice within the financial services industry in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017. And we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here. And so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5%, 4%, 3.5%, and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5%, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply it with the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here. Because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS. And that's what exactly we are supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent, as a percentage of revenue. Enter there. And like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I32. Like that. So it's I32, which is this cell over here. But now, where do we pick it from? We pick it from I13. This is I13. I13 is this one here. So we're picking it just from there. And then also this one is going to be I14, which is down there. Now we move ahead and try and model the depreciation and amortization. In real life, trying to model depreciation and amortization will prove to be a bit of a challenge. Determining will be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to use straight line method. For simplicity's sake, the way I've seen it right over here, depreciation as a percentage of PPE, it's just based on straight line method like that, for simplicity's sake. So the depreciation and amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly, and we'll model it a little later on. As well, the interest right here, the interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so, to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard coded values. We just drag them. That. Remember that this value here is bound to change, as well as this value is bound to change because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, it's a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if we can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? The accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if we double click, you can see it is the revenue, or it is rather the accounts receivable. Yes, if we said before, accounts receivable. We divide that with the revenue, and then we multiply by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, how do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you what you're going to do, because the formula is given to us right over here. You can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days, and then we multiply that with the revenue, and we divide this, all of this, by 365. By 365. Over here, 365. That. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we're saying we get the accounts receivable times 365 over revenue. Just rearranging this formula. And that's exactly what we're going to do over here. We get the days. The days are here. See where they are. Just a second. Accounts receivable days. There. And then we multiply that with the revenue. Then we divide over 365. And we have that value given to us there. So shift, control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue, and here we're dividing against 365. That. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days. Which days? The inventory days right here, 73, divide by 365. once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE, or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out. Because this is a formula, so Shift, Control R. We can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. Same function, the same formula over here, only that we're going to put now accounts payable. Now over here, payable. Payable for revenue 365. So we look for the accounts payable days. Accounts payable days, you can see the accounts payable days are here, 37. And then we multiply that with the cost of goods sold and then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the supporting schedules. So here we drag it like that because this is a formula here, it's just the total. So this one I'll put it in a different color so that for consistency's sake, to maintain to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital, then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here. And we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right. And this one remains like so. So Shift, Control R. So it picks the formulas as the way they are. Remember, in a balance sheet, we always have a check. This check, with your permission, it will obviously not balance because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiners asked us, to fill and ensure that this one balances off, the balance sheet balances off, based on the forecast. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement and we will be able to also do a check for the cash flow statement and write down over here to determine if we are actually cooking figures or not. We jump onto the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable. You remember we had modeled it just above there in the balance sheet. So we just fill it out, link it with the one accounts receivable here. And you can see the accounts receivable is here, so we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that, and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The accounts payable, as you can see right over here, is 5938. You see, it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net working capital component. So just put it like that, and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that. Then now I can drag it moving down like that. Shift, Control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule, depreciation schedule. Now we can see something that is very unique from the historical values here. This value, which is the opening PPE, is there picked from the closing value here. This value has been picked from the closing value here. This one has been picked from there. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section, this one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up above over here. So debt and issuance repayment right now here, we link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do we get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. interest as a percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. These values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up, and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is linked to the supporting schedule here, right here, enter. Then we can be able to just drag it towards the right there, Control R. And in a good account or analyst format, we just make sure that this part is the same color because we've already filled out the missing items and our income statement is complete. Now, like I said before, that the cash is going to be filled out at the last, at the tail end. It's like the balancing figure. We can fill out the property, plant and equipment. So we're saying it's going to be from the supporting schedules down. So we are saying it's going to be this value here, the closing. You're reporting at the end of the financial year. So we pick the closing balance there and we drag it towards the right. Remember, it's just the sum of all of them. As well, the debt, we pick the closing debt, which is right here. Closing debt should be that. We can just drag it, Control R. So we can then, of course, now remove the theme color, put it here like so, with the exception of the cash. Now let's fill out the cash flow statement. Net earnings is picked up from above here. Here 35 is here, the net earnings, you can see the net earnings is there. Here we have the depreciation and amortization over here. Right here, so we pick that. And then we are saying changes in working capital. Where do we pick it from? We pick it from the supporting schedules right here. Change in net working capital, and we are saying we are going to pick that value. So because this is black and it's a formula, I can just drag it like so. Now we're almost there, but we're not there quite there yet. The investments in PPE represent the capital expenditures. So the capital expenditures down here, capex, you can see the capex is here. Link it to that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt here. And remember, they are following each other with equity. So like that. And this can be dragged like so because it's a formula, and we can complete this by doing that, by dragging the formulas moving to the right. The net increase or decrease in cash is a formula because you can see it right above over here. We're going to add cash from operations. We subtract cash from investing because that's money going out, and then we add cash from financing so that we can be able to get the decrease or increase in cash. Drag that towards the right. And we're saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So we are saying that we can then link that with that value. This one is a formula like so. So we can then drag these values moving towards the right, and we have the values like so. Now to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules, we can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here, and you can see it has balanced. But dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million like that and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements: the income statement, the balance sheet, statement of cash flows, very well. Thank you for being with Manifested Publishers, and God bless you. Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, of all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A, you can see the average right over here. And the average of what? We want to pick the average for Z term Kenya, to pick the average values right here. Up to there, close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You're told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, Control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, Control R, like that, the same values, excluding the All Share Index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the All Share Index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the bracket, and we enter. So I think I didn't put open a bracket here. That's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see We already have that given to us there. And if we were to drag it moving towards the right, like so, up till all share index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi all share index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already had the standard deviation over here, compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here. The corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with Kasneb's corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So we pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or covariance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, So we are saying this one for G is one that we can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now Before we do the variance like that, we can say okay, like that, because that's just the covariance, like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var p but var s, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets. That there, that's our beta, 0.0932. And if you are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1, because it's covariance of the market, it's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We are always here for you. Be blessed.
Hi students, welcome to another session of Manifested online classes. So in this session, I want us we continue with the topic number 3, subtopic number 5, financial statement of cooperative societies. And specifically on this session, I want us we look on an illustration question regarding presentation of financial statement of a cooperative society. So I want us we go through the illustration and then we see what was required. So we are told Marura Farmers Cooperative Society deals in marketing of two brands of coffee, Safi and Mzuri, on behalf of the members. As per the society's bylaws, the society is allowed to retain 20% of the sales for Safi and Mzuri for operation and pay the balance to the members. The following trial balance was extracted from the books of the society as at 31st of December 2021. We have a trial balance there. We have expenses relating to Safi, which include marketing expenses, processing materials, processing wages, and then we have expenses relating to Mzuri, which include marketing expenses, processing materials, processing wages. Then we have loans to members. We have dividends from investment, accrued lends, salary provision, appropriation account, revaluation reserve, statutory reserve fund, entrance fee, share capital, members deposit, salary creditors, bank overdraft, interest on loans to members, and then we have traveling expenses for staff, for committee members, bank charges, bank interest, salaries and wages, committee education, committee seating allowance, printing and stationery, general meeting expenses, members education, entertainment, legal fee, cash in hand, Wakulima Bank Limited savings, investment in Wakulima Bank Limited, receivables from members, receivables from non-members, and then finally we have equipment. Then we have some additional information. Number 1, we are told Bora Limited market Safi and Mzuri brand for Marura Limited. On 31st of December 2021, Bora Limited sold Safi and Mzuri brands for 175,000 US dollars and 115,300 US dollars respectively. Bora Limited remitted the above amount to Marura Farmers Wakulima Bank on 15th of January 2022. Marura Farmers Cooperative Society does not maintain a US dollars account in Wakulima Bank. So as far as that information is concerned, it is important to note that this company, which is called Bora Limited, which you're told market Safi and Mzuri Brands on behalf of the cooperative society, this is like an agency. This is just like KTDA, which is responsible for marketing and selling tea on behalf of various tea factories. So once KTDA sell tea, it remit now money to the bank account of various tea factories, and then which will be able now to pay their farmers. The same case with this particular Bora Limited is an agency of Marura a cooperative society. It market and do what? Sell those two coffee brand on behalf of that cooperative society. So therefore, once it sell, definitely it remit the money to the bank account of the cooperative society. But because you're given the sales in US dollars and the other figures are given in shillings, we have to translate those particular sales into Kenyan shillings, and automatically we're going to translate them using the exchange rate which was existing at the date the money was sent. I hope you can see we are told the money was sent or was remitted on the bank to the bank account of Marura Farmers Cooperative Society on 15th. So that is the exchange rate we are going to use. So in number 2, we are given the exchange rate for the two currencies, as shown below. So we're given the exchange rate on 31st of December 2021, which was 105 shillings, which was equal to $1 US. And then on 15th of January 2022, $1 was equal to 100 Kenya shillings. Automatically, in this case, I've said when translating the sales for the two coffee brand given in the information number 1, we are going to use the exchange rate on the date the money was remitted to the bank account, that is on 15th of January 2022. Number 3, we are told audit fee of 6 million is to be provided for. Number 4, salaries and wages amounting to 3.2 million had not been paid. These accrued salaries and wages. 5, interest on members' deposit is to be provided at shillings 6.08 million. And then finally, we are told, as per the relevant ministry's regulation, cooperative societies are required to transfer 20% of their net earnings to statutory reserve fund. This is something I mentioned in the first topic or in the first lesson of this particular topic, that cooperative societies are required to 20% of their net profit to a statutory reserve fund. So what are we required as far as that question is concerned? We are required to prepare the following financial statement for Marura Cooperative Society for the year which ended 31st of December 2021. Number 1, Safi Brand Marketing Account showing the profit and loss. Number 2, Mzuri Brand Marketing Account showing the profit or loss. And Part C, Statement of Profit or Loss for the year which ended 31st of December 2021. And finally, Statement of Financial Position. So as far as the first two accounts are required, Part A and Part B, whereby you're required to prepare the marketing account of the two coffee brands, we're required to prepare those two accounts basically to show the profit or the loss which was realized from selling these two coffee brands. And what we are going to do, we are going to take now the sales, the sales of the two coffee brand, which is given in the additional information number 1, and then there is some information which are given in paragraph 1 that this cooperative society is required to retain 20% of the sales and automatically remit the rest, which is 80% now to the members. So once we take the sales given in number 1, and we determine the amount to be retained, which is 20%, the amount to be paid to the members, which is 80%. Then we are going to less now the expenses, specifically relating to those two coffee brands. So we start with Part A of that particular question, we are required to prepare a SAFI, a brand marketing account, which is for the year which ended 31st of December 2021, 31st of December 2021. So in this case, we need to have just a single column here, and our figures are in thousands of shillings. So what do we start with here? We start with the sales from this coffee brand, and we are given that information in addition information number 1. We are told the sales from this coffee brand, that is a Safi, it was 175,000 US dollars. 175,000 US dollars, because these sales are in US dollars. So what we need to do, we need to translate these into Kenyan shillings. I've said we're going to use now the exchange rate when the money was remitted now to the bank account of the cooperative society. The money was remitted on 15th of January 2022, in which case now the exchange rate was 100 shillings, which was equivalent to $1 US. So we multiply that with what? With 100, so that we get the final figure here. So let's get the final figure. So this is 175,000, then times 100. So that will give us 17.5 million. Take into account our figures are in thousands of shillings. So that will be recorded there 17,500. Then what you are told is that out of these particular sales from these two coffee brand, now the cooperative society has to retain 20% to cater for the expenses associated with marketing and selling this particular coffee brand, and then 80% of these sales will have to be paid to the members, or basically to be distributed to who? To the members. So therefore, the first thing we need to do, even before we list now the the expenses. So first of all, we have now to deduct amount due to members. Amount due to members, and basically in this case we have said the amount due to members is 80%. Amount due to members. That amount due to members in our case we have said is 80% of these sales, because we are told the cooperative society is supposed to retain what? Supposed to retain 20%. 20%. So what is 80% of 80% of this? 80% of 17,500, which will give us 14,000. So this is the amount now to be paid to the members, meaning that the amount retained by the cooperative society, and which is now 20%, is how much? Is 35. So basically what that means is that this particular amount should be equal to, this amount should be equal to 20% of this. Maybe you can just confirm 20% of 17,500. That should give us 35. That is the amount to be retained by the cooperative society to cater for the expenses associated with marketing and selling this coffee brand. So then what we need to do is basically to go ahead and list now the expenses. We list the expenses. So we are given the expenses, or we're given specific expenses relating to marketing and selling this coffee brand, and those particular expenses are given in the trial balance. I think the first item is the trial balance. We have the expenses associated with marketing and selling a Safi. So we have marketing expenses, which is an amount of 640. We also have processing materials, an amount of 860, and then we have processing wages, which is an amount of 900. Yes, an amount of 900. So wherever you get down there is basically now the profit which this particular cooperative society was able to get from selling this coffee bread. So 35 minus 640 minus 860 minus 900. So this will give us 1100, and basically this is now the profit for the year from selling and marketing this particular coffee brand. So basically that's what the examiner was requiring there, and you can see how many marks were allocated there. The marks allocated were 3. So for recording basically these particular items here, the sales and these particular expenses here, then you had to get those 3 marks. So let's move to part B of that particular question, part B of that question, and we are required to prepare now a marketing account for the other coffee brand, which is Mzuri brand marketing account, which is equally for the year which ended 31st of December 2021. So our figures are in thousands of shillings, and we're following the same format. We start with the sales of this particular coffee brand, and that is given in the additional information number 1, which was 115,300, but this take into account our US dollars. We have to translate that to Kenyan shillings using the exchange rate which existed on the date this money was remitted to the bank account of the cooperative society, and this will give us 11,530,000. So just like what we have done here to this, we need to less the amount due to members, the amount which was supposed to be paid to the members from this particular sales. So we less amount due to members. In this case, we have said the amount due to members is 80% of the sales. 80% of the sales. And then what we get here is the amount retained by the cooperative society to cater for the expenses associated with marketing and selling this particular coffee brand. So 80% of 11,530. Okay, we can take that again. 80% of 11,530. Yes, that will give us 92.24. That is the amount which was due to members. And then how much amount was retained here? We deduct that from 11,530, which will give us 23,06. So this is the amount which was retained by the cooperative society and which was supposed then to cater for the expenses associated with marketing and selling this coffee brand. And we are also given those particular expenses. Those expenses are given in our trial balance there. So what we just need to do is to record them here. So we have marketing expenses. An amount of 150. And then we have processing materials. An amount of 320. And then we have processing wages. Which is an amount of 30. Yes. And then from there, what we do, we get the profit for the year. The profit for the year from this coffee brand. So what do we have here? We have an an amount of 2306 minus 150 minus 320 minus 30. That give us 1806, which is now the profit for the year. Equally, that is what was required as far as part B of that question was concerned. And these are some of the items which were marked as far as that part is concerned. And by doing that, you get now your three marks. So let's move to the other part of that particular question, that is part C. But even before we do that, there is something we need to note here, which is very, very important. One, when the year was coming to an end, this particular agency, remember we have said that this cooperative society has an agency, which is called what? Bora Limited. As per the information given in note 1, this agency had not limited this amount of money to the bank account of the cooperative society as at the end of the year. So therefore, this amount here, 17,500, and also this one, 11,530, it was an amount which the agency owed to the cooperative society. So therefore, in preparing our statement of financial position, this particular amount plus that one, because it is the amount which the cooperative society was expecting, it will be recorded there as an asset. So basically, we refer to that as the amount now to be received, or the amount receivable by the cooperative society from that agency. On the other hand, this particular amount which was due to the members, 80%, this amount was not yet paid to the members of the cooperative society when the year was coming to an end. And therefore, in preparing our statement of financial position, this one will be recorded there as a liability, because this what the cooperative society was supposed to pay to the members, it had not paid that amount. So therefore, it is important to note that. Let's move to part C of that question. And part C, we are required to prepare now a statement of profit or loss for the year which ended 31st of December 2022. Now, this one is prepared to determine the profit or loss for the entire cooperative society. Remember what you have prepared in part A. Part B is prepared to determine the profit from marketing and selling the 2 coffee brand. So part C, we are required to prepare a statement of profit or loss, which is for the year which ended 31st of December 2021. 31st of December 2021. So in this case, we need to have 2 columns. And we prepare these by comparing the incomes of a cooperative society with the expenses. Automatically we start with the incomes and then we less the expenses. So which are some of the incomes of this particular cooperative society? So even before you go back to the trial balance, because we know our cooperative society is responsible for marketing 2 coffee brands on behalf of the members, we know that from marketing of the 2 coffee brands, there was a profit of 1,100 from marketing and selling of Safi, and 1806 from marketing and selling of what? Muzuri. So that is the first source of income to this cooperative society, and that is what we bring here. So profit from the 2 coffee brand Safi, which is a figure of what? Of 1,100. And then we also have the profit from the other coffee brand, which is Mzuri, a figure of 1,806. Then what we need to do, we go back to the trial balance, we take the other incomes of this cooperative society. It's important for you to remember all incomes have a credit balance. So when checking for incomes from the trial balance, you check the items on the credit side of the trial balance. So the items on the credit side, I think the first item We have dividends from investment. Dividends from investment. Dividends from investment is a figure of 470. Below that, we have accrued rent. Accrued rent, these are liability. Sundry creditors is a liability. Appropriation account, these are like the retained profit at the start of there, which is not an income. Revaluation reserve is a component of equity. Statutory reserve fund is a component of equity. And then below that, we have entrance fees. This is still an income to a cooperative society. And these entrance fees is a figure of what? Is a figure of 300. Below that, we have share capital, members deposit. None of those is an income. Sundry creditors, bank overdraft. All those are items of liabilities. And I think finally we have interest on members' loans. Interest on members' loans. Members or interest on loans to members. Remember what you have said is that once a cooperative society give loans to the members, a cooperative society definitely will have to charge some interest. That interest charged by the cooperative society is basically what is an income. Yes, so I think those are the only incomes which we have. So then what we need to do is to get the total incomes. So let's add all those figures so that we get the total incomes. We have 1100 plus 1806 plus 470 plus 300 plus 35 890 35 890. Okay, yes, that will give us the total incomes of 39 566. Yes, after getting the total incomes, what do we do next? We proceed and we less now the expenditures. The expenditures of these cooperative societies, expenditures of the cooperative society. So here we have a number of expenses, and before taking the expenses in the addition in the trial balance, it is always advisable first of all deal with the expenses affected by the additional information. Let's go to the additional information. In the additional information, number one, I think we had information about sales of the 2 coffee brands. That has nothing to do with the expenses. Number two, the exchange rate that do not affect expenses. And then number three, we are told audit fees to be provided for. Audit fee to be provided for, that is an expense. But equally, because we are told this audit fee was provided for, it means that when the year was coming to an end, this audit fee had not been paid. Meaning that in our statement of financial position, there is a liability. So we have audit fee of 6 million, but remember all our figures are in thousands of shillings. And then number four, we are told staff salaries and wages amounting to 3.2 million had not been paid. So we have staff salaries and wages. So what we do, we take the amount which was not yet paid at the end of the year, which is 32, and then we add to this, we add the amount which had already been paid, and this is the amount appearing in the trial balance. So the amount appearing in the trial balance as a staff salaries and wages is a figure of what? Yes, is a figure of 2290. 2290. So we add the two figures, so that now we get the total staff salaries and wages for that year. So we have a figure of 3200 plus 2290. So the total staff wages and salaries for that year is a 5490. So let's go to note number 5. Interest on members' deposit is to be provided for. Remember, in this case, we have said that interest paid to members based on their deposit, this is an expense. This is an expense. And equally, it is also important to note that this amount are not being paid, it's just provided for. So therefore, still in preparing our statement of financial position, this will be a liability. So I think we are done with that point. And then number 5 is all about the amount to be transferred to the statutory reserve fund. That is not an expense. So what that means is that we go back to the trial balance which you are given, and we pick now all the other expenses. It's also important to note that all expenses in the trial balance, they have a debit balance. So we check the items on the debit balance, on the debit column of the trial balance, that is. And I think we can start from where we have traveling expenses. That, I think, where we have the first expense. It is important for you to note that we have some expenses which relate to these two coffee brand, Safi and Muzuri. And because we captured those particular expenses here in preparing this particular account, we don't take into account those particular expenses. Those expenses specifically relate to Safi and Muzuri. What we are recording here are the general expenses relating to the cooperative society. So we have traveling expenses for staff and committee members, a figure of 80 and 100. And then we have bank charges, an amount of how much? An amount of 200. We have bank interest, which is a figure of 890. Then below that we have salaries and wages. We have already dealt with that here. And then we have committee education, that is the other expenditure. Committee education, which is an amount of 1,000. Below that we have committee seating allowances. This is committee allowance. We have committee okay, this is a committee's education. Committee's education, which is 1,000. Then we have committee seating allowances, which is a figure of 1110. And then we have printing and stationery. So printing and stationery, we have a figure of 2050. And then we have general meeting expenses. General meeting expenses, an amount of 500. Below that we have members education. Members education is a figure of 1,500. And then below that we have entertainment. Entertainment is a figure of 50. And then next and finally we have the legal fees. Which is a figure of what? Of 400. So those are, I think, the various expenses which relate to this cooperative society. I hope we have not skipped any. Yes. So what then we need to do, we need to add all those particular expenses of this particular cooperative society so that we can be able to determine the profit or what? The loss for the year. So let's add all these particular expenses, starting from where we have audit fee, 6,000 plus 5490 plus 6086 plus 80 plus 100 plus 200 plus 810 plus 1,000 plus 1110 plus 2050 plus 500 plus 15 plus 50 plus 400. Yes, so that is giving us a total of 376. So what we need to do, we need to less that now from the total incomes which we have here. We deduct that from 39,566. So that will give us the profit for the year. The profit for the year of 14,190. So basically that is it, that what is required as far as that part was concerned. Preparation of the statement of profit or loss, and in that case now the examiner had given how many marks? The marks were allocated to that were six. So by recording those particular items of incomes and the expenses, you had to get now 6 marks. So finally, let's prepare now the statement of financial position as required in part D of that particular question there. So you prepare statement of financial position. Statement of financial position. That is part D. You can just refer to it as abbreviated as SOFP, as at 31st of December 2021. 31st of December 2021. So remember, you say that it is a statement of assets, liabilities, and equity. So we just need to have a single column here. And we start by recording assets. And remember what we said in our first session. As far as this is concerned, we don't need to classify the asset into non-current and current. We just record asset starting from the most liquid to the long term. And I think we are given the asset starting from where we had our last expense, the legal fee. Below that we have cash in hand. Cash in hand. The cash in hand is a figure of 540. Then below that we have Wakulima Bank. Wakulima Bank Limited savings, which is an amount of 6780. And then we have still investment in Wakulima Bank Limited. Wakulima Bank Limited, which is a figure of 6,550. Then below that we have receivables. We have receivables from members, which is a figure of 2,960. We also have receivables from non-members, a figure of 22,500. And then we also have office equipment. Office equipment is a figure of what? Is a figure of 900. Yes, so I think those are some of the items which we have in the trial balance. But I think also below the various expenses relating to Safi and also Mzuri, we have now the loans to the members. Remember, we have said that once a cooperative society has given loans to the members, advanced loans to the members, these particular loans to the members to a SACCO or even to a cooperative society is an asset. the cooperative society expects now the members to repay back that amount of money. So basically that is an asset. Then what else do we have? Maybe from the additional information. From the additional information, number one, we have now the amount which this cooperative society was yet to receive from the marketing agency, which is Bora Limited. So we can just refer to that as the amount due. Amount due. This is the amount which was not yet remitted to the bank account of the cooperative society by the marketing agency, which is known as what? Bora Limited. And this amount, because it is given in terms of US dollars, we have now to convert that now to Kenyan shillings. So we take the sales from Safi, 175,000 US dollars. We can just take it as 175. And then from the other coffee brand, 115.3. And then we get the total. We translate that now to the Kenyan shillings by multiplying that with the exchange rate on the date the money was remitted. So we have 175 plus 115.3 times what? Times 100. So this is the amount of money which now Bora Limited was yet to remit to the bank account of the cooperative society. So therefore, to the cooperative society, this is basically an asset. So that's what we have in note number 1. Additional information, note 1. Note 2 has nothing to do with the sales. Note 3 is that is a liability. Note 4, that is still a liability. And then number 5 is still a liability. And then number 6, this one will affect now the appropriation account. I'll be able to show you now the necessary what? Adjustment we are going to make as far as that is concerned. Yes, so what we need to do here is to get now the total assets. So let's add all these assets starting from where we have 540 plus 6780 plus 26 550 plus 2690 plus 22,500 plus 900 plus 972 340 plus 29,030 030. Yes, that will give us a total figure here of 1,061,330. So those are the total assets. Next, we record now equity. Equity, this one comprises of a share capital, members deposit, plus the various items of what? Of reserves, of which all these items, they have a credit balance. So let's start by recording the share capital of this cooperative society that is given in the trial balance. Share capital is given as a figure of 900. So then below that we have members deposit. Which is a figure of 64 650. Yes, and then from there we have various items of reserves, starting with just above the share capital entrance fee, we have statutory reserve fund. This one will need to be adjusted because whatever you given there as a statutory reserve fund, this is a statutory reserve fund at the start of the year, and then what you are told as per note number 6 is that 20% will 20% of the net earnings is the same with the profit for the year, will be transferred to statutory reserve fund. So this should be 20% of what? 20% of this profit for the year. 20% of that what? Profit for the year. So it should be 20% of 14,190. So that we get the statutory reserve fund at the end of what? Of the year. So then below that, or basically above that, we have revaluation reserve. Revaluation reserve. Revaluation reserve that remain the same, which is a figure of 750. We are going to compute that figure. We're going to compute that figure, and still we have appropriation account. Appropriation account, this account still, or this figure still need to be adjusted, because what you're given there is the appropriation account at the start, which is what? Which is 50. To this, we should add the profit for the year. The profit for the year, remember, is 190, but equally we are going to less the amount which was transferred to the statutory reserve fund, which is 20% of 14,190. 14,190, and we get now the appropriation account balance at the end of the year. So I think we have picked all the items of equity. We have picked all items of what? Of equity. So I think what we just need to do here is to get now these final figures, starting with the statutory reserve fund. So let's first of all get 20% of this, 20% of 14,190 plus 13,740. That will give us 16,578. What about the appropriation account balance? So we have okay, we have what? We have 6050 plus 14,190, and then to that we less what? We less 20% of 14,190, and that will give us 17,402. Yes. So those are the items of equity. So what we then need to do is now to get the total equity. Let's get the total equity by adding all these items, actually starting from there. We have 17,402 plus 750 plus 16,578 plus 64,650 plus 900,000. 900,000, which will give us 999,380. So that is the total equity. So what we need to do next, or actually finally, we need to record now the liabilities. We need to record now the liabilities. We need to record the liabilities. The liabilities. So we have various items of liabilities. Let's start with what we have in the additional information. In the additional information, number 1, there is something, first of all, you need to remember that there was amount due to members. There was some amount which was, this cooperative society was supposed to pay to the members, which was 80% of this amount, which was from the sales of the 2 coffee brand. So we can just compute that as 80% of this, 80% of 29,030. Although if you go back to what we prepared in Roman 1 and also all part A and part B, you can be able to see the amount due to the members as far as the sales of the 2 coffee brand is concerned. If you add those, the amount from Safi brand marketing account, Mzuri brand marketing account, should be able to get the same figure here as 80% of the total sales of the 2 coffee brand. So we have 80% of 29,030. That will give us 23,224. This amount which this cooperative society was yet to pay to the members. So that's what we have in note 1. Number 2 is about exchange rate. Number 3, we have provision for audit fee. For audit fees, this amount was not yet paid. It was just provided for. So therefore, it is a liability, 6,000. And then number 4 we have accrued salaries and the wages. Accrued salaries and wages is 3.2. And then below that, number 5, we have provision for interest on members' deposit. Still, this amount are not being paid. It was purely provided for. That's why we are accounting for it as a liability there. I think that's what we have. Yes. So let's then go back to the trial balance and we pick now the other items of liabilities. Remember, all our liabilities, they have a credit balance. So starting from where we have dividends from members, below that we have accrued rent, which is 470. Below that we have salary provision, 4950. And then down there we have salary creditors, which is a figure of 3410. And then we also have a bank OD, bank overdraft, of 6150. Yes, so I think we have recorded all items of liabilities. None of the items which you have not recorded. Yes, so what we just need to do here is now we get the total. Equity and liabilities. So for the total equity and liabilities, we take the total equity there and then we add all these items of liabilities. But let first of all we add these items of liabilities. We have 23,224 plus 6,000 plus 3,200 plus 60,86 plus 470 plus 4950 plus 3410 plus 6150. Yes, plus what we have there is 999 380. Okay, let me take that again. Okay, so we have what? We have 999 380, and then we have 23,224 plus 6,000 plus 32 plus 60,86 plus 470 plus 4950 plus 3410 plus 6150. Yes, so that is giving us the same figure there as 1061 330. 1061 330. So basically that is what was required in that part D of that question. These are the items now which were to be marked. But definitely that particular statement of financial position, as you can see, there are so many entries, entries, and basically by doing that, you are allocated 8 marks as far as that question is concerned. So that brings us now to the end of that particular illustration as far as the preparation of financial statements by cooperative societies are concerned. And I think that is the most recent question on cooperative societies. There is another question which was tested back in the year 2010. So if you can be able to access the past papers for 2010, you can be able to check a question which was tested. So I think was question number 4 from that particular sitting. So therefore, we stop at that particular point. See you in the next session as we move to a different topic. Hi student, welcome to Manifested Online Classes. My name is Joseph Kemani. In this session, I want us to look on a subtopic number 2 in topic number 3. Topic number 3 relates to the preparation of financial statement of various different entities, and in this particular class here I want us to look on how the professional firms prepare their financial statements. So first of all, what are professional firms? These are those particular firms which are formed in order to provide some professional services to their client. And good examples of professional firms include what we refer as the accounting firm, an auditing firm, a law firm, and so on. Those are good examples of professional firms which provide certain professional services to their clients. Now, at the end of the year, or once the year comes to an end, definitely the owners or the partners of such professional firm must determine how their firms are performing, and also their financial their financial position. That's why it is important for these particular firms to be able to prepare their financial statement. And therefore, our main interest as far as this particular topic is concerned is to discuss, or basically we're going to look on the financial statement which the professional firms are or basically which professional firms do prepare. But before you do that, we can say that professional firms firms are those firms established to provide professional services services to their clients, professional services to their clients. So what are good examples of a professional firm? So examples include number one, we have an accounting firm. Number two, we have an audit firm. Number three, we have a law firm, etc. So these are good examples of professional firms which are established to provide certain professional services to their clients. Now, what you have said is that the partners, or basically the owners of this particular professional firm, definitely they are interested with performance of their business and also the financial position of their firms. And that's why it is important for these particular professional firms now to prepare the financial statement. But before we look on the various financial statements which are prepared by professional firm, I want us to define some terms here. We look on the definition of various terms. Definition of terms. So some of the terms we need to define here. Number one is something called a profession. A profession. So when talk about a profession, generally we say that this is a recognized field of study which involves some training and also some examination by a certain professional body. So therefore, a profession is a recognized field of study. So therefore, you can say that this is a recognized Yes, so therefore a profession here we are saying is that recognized field of study, and which involves some training and also some examination. In this particular examination, we are saying it is administered by a professional body, e.g. what? A Kasneb. For instance, for you to be able to set up maybe something like an audit firm, to establish an audit firm, or maybe an accounting firm, definitely you must be a qualified accountant. So for you to be a qualified accountant, you need to undergo through some training. You need to attend a college which is offering some professional courses such as CPA, such as ACCA. You go through that particular training, and by the end of the day, you have now to sit and pass a certain what? Exam, which is administered by a professional body, e.g. Kasneb, e.g. ACCA, and so on. That's why we are saying that when talk about now a profession here, it is that particular recognized field of what? Of study. So the other term which we also need to define here, as far as the professional firms are concerned, is something called the cost charged to the client. Cost charged to the client. To the client. When talk about the cost which is charged to the client, in other terms, this can be referred to as the fees which has been earned. A professional firm, we are saying, by the end of the day, provides certain professional services to who? To the client. Once a professional firm has provided those particular services, the client will be charged. The client will be charged some amount because a professional firm incurred some cost in terms of providing those particular what? Services. So therefore, you can say that this is the fees. This is the fees charged by a professional firm. Charged by a professional firm to its clients and for services rendered. For services which have been rendered. For services rendered. Anytime a professional firm provide certain services to the client, automatically those particular clients will be charged a certain what? A fee. And actually, this particular fee which is charged by a professional firm, this is the main source of income as far as these particular firms are what? Are concerned. So the other term we also need to define here is something called a client account. A client account. When talk about the client account, this is basically an account which is prepared by a professional firm to record all the transactions relating to the client. For instance, money which has been received on behalf of the client, and maybe any disbursement or any payment which has been made on behalf of who? Of the client. All those particular transactions which now relate to the client, they are recorded in this particular what? Account. So this is an account which records all transactions relating to the client, relating to the client, relating to who? To the client. Any money which has been received on client behalf, and also any payment which has been made on client behalf, all those particular transactions will be recorded in that particular what? Account. So the other term we also need to define here is something known as WIP, work in progress. Work in progress. So what is work in progress? Work in progress basically refers to the services which are rendered to the client. These are those particular services which are rendered to the client, but when the year is coming to an end, those particular services will not have been completed, assuming you have a professional firm, like maybe an audit or an accounting firm. You have gotten a client, or maybe you have a client and you're providing certain services to that client, but when the year is coming to an end, you have not yet completed those particular services. So meaning that because you are yet to complete those particular services, it means that you have not invoiced to your client, you have not sent an invoice to your client for the client to be able to pay for those particular what? Services. So therefore we say that this is still work in progress, work which is still going on when the year is coming to an end. So we can say these are services Yes, so therefore these are those particular services which are provided to a client but not completed at the end of the year. And therefore, because this work has not been completed, then we have said the professional firm will not have invoiced the client for the client to be able to do what? To pay. Meaning that this particular work in progress, when a professional firm is preparing a statement of financial position, it is treated as a current asset. Services which have been provided, but because they are not fully completed, the client has not paid for them. It is basically like an accrued income, which should be treated as what? As a current asset. So the other term we need to define here is something called disbursement. Disbursement on client behalf. Disbursement on client behalf. When talk about the disbursement on client behalf, this refers to any payment which has been made by a professional firm on behalf of the client. Any payment by a professional firm on behalf of the client. Yes, any payment by a professional firm on current what? Behalf. And therefore, this particular payment which has been made by a professional firm on current behalf, automatically the professional firm expects to recover the same from the client. So this amount is recovered from the client. Recovered from who? From the client. From the client. Yes, so therefore these are basically some of the terms which you need to, or which you must be able to define as far as the professional firms are concerned. And think from there we can then proceed and look on the financial statement prepared by a professional firm. Financial statements prepared by a professional firm. A firm include what? We have two main financial statements which are prepared by professional firm, and those particular financial statements include: one, the income statement. We have the income statement. So the income statement, in other terms, is also known as statement of profit or loss. Statement of profit or loss. And number two, we have the statement of financial position. Statement of financial position. So therefore, any professional firm at the end of the year must prepare those two financial statement: income statement or statement of profit or loss, and the statement of financial positions. The statement of profit or loss, that is income statement, and the statement of financial position. So let's start by looking on what is a statement of profit or loss. Statement of profit or loss, and why these financial statement is prepared. Now, a statement of profit or loss, or an income statement, this one is prepared to determine the performance of a professional firm, to determine whether a professional firm operated at a profit or at a loss. And therefore, this income statement is prepared to compare the incomes of a professional firms with the expenses incurred by a professional firm during that particular financial year. So therefore, you can say that this is prepared to ascertain the performance. Ascertain the performance of a professional firm, firm. On the other hand, we have said it compares incomes and expenses. It compares incomes and expenses of a certain financial year, and automatically the difference between now the incomes and expenses here is a profit or a loss for the year. A profit or a loss for what? For the year. So let's look on the format, how we prepare the statement of profit or loss. Format of statement of profit or loss. And this one is prepared for a certain year, for the year which ended on a certain date. On a certain date. Remember, we have said that in preparing the income statement, generally what we do, we compare now the incomes of a certain financial year with what? With now the expenses for the same financial year. Equally, when preparing this statement of profit or loss, we prepare it using a vertical format. So here we start with the incomes. And for the incomes, first of all, we start with the cost, which was charged to client. Cost charged to client. Remember, in this case, we have said cost charged to the client is the same with the fees which was charged to the client. A professional firm, after providing certain services, it will charge a client some fee, which is basically the main source of income. And then now to this, there is something which we add here, which is known as the crossing work in progress. Crossing work in progress, this is like the accrued income at the end of the year. These are those particular services which will have been provided when the year is coming to an end, but because those services are not fully completed, the client has not paid. This is like an accrued income at the end of the year. Add it to that figure, and then to this you less opening work in what? In progress. Opening work in progress. So and then whatever you get here is the net cost charged to client. Net cost charged to client. And then now to this we add any other income. We add any other income, e.g. investment income. If a professional firm is having any other income, we come and we add it there. And then what we do, we get the total income. We get the total incomes of that financial year. To this now total incomes, we proceed and we less now the expenses. So some of the expenses which may be incurred by a professional firm will include things like the salary to staff, expenses, we record them in the first column, things like depreciation on PPE. These are tangible and current assets which are owned by a professional firm. Things like furniture and fittings, motor vehicles, and so on. Things like rent, ETCs, and maybe things like stationery and printing. This is also a common expense which may be incurred by a professional firm. So we get the total expenses, we take them to the last column, and we deduct this from the total incomes. Whatever you get here is the profit or the loss for the year. For the year. So automatically if you get a positive figure there is a profit, but a negative figure there is what? Is a loss. So that is how a statement of profit or loss or an income statement is prepared by a professional firm. Then let's look on how we prepare now a statement of financial position. Number 2, we have a statement of financial position. So when talk about the statement of financial position, this is a statement of asset, liabilities, and what? Capital. So we can say first of all that this yes, so it is a statement of assets, capital, and what? Liabilities. This statement of financial position will be prepared to record these items, to record this particular item. On the other hand, when a statement of financial position is to be prepared, it is prepared based on something known as the accounting equation. We can say it is prepared based on accounting equation. So the accounting equation basically is a fundamental equation in accounting. Is a very important equation in accounting. In fact, the concept of double entry is based on this particular equation there. So this equation states that assets are equal to capital plus liabilities are equal to capital and what? And liability. So let's look on the format. How do we prepare this statement of financial position of a professional firm? Statement of financial position as at the end of the year, because this one we have said is prepared at the end of the year to show the asset, the liabilities, and also the capital of a professional firm. Always we start by recording assets, and asset we classify them into two, non-current and current. So here we start by recording current assets, that is non-current assets, and in this case we just need to have a single column there. So some of the non-current assets which may be owned by a professional firm may include things like furniture and fittings, things like motor vehicles, things like maybe investment property, etc. You come and you record all those particular assets here. It is also important to note that when recording the non-current assets there, we record them at their net book value. So to compute the net book value of this particular asset, we take their cost minus the accumulated depreciation at the end of the year. The cost minus the accumulated what? Depreciation at the end of the year. Then from there we proceed, record the current assets. So for the current assets, these include things like cash and bank balance, and this cash and bank balance will be the cash and bank balance in, first of all, something known as the current account. Mostly the professional firms operate two different accounts, an account or a bank account known as the current account. Current account is whereby money belonging to the current, any money which has been received on behalf of the current will be deposited, and then another account which is known as office account. Office account is a bank account whereby money belonging now to the professional firm is recorded. So we have cash and bank balance, and then we have things like the crossing work in progress. Crossing work in progress is still a current asset. We also have disbursement on current behalf. Remember, you have said disbursement on current behalf. This is any payment which is made on behalf of the client. A professional firm, by the end of the day, expects to recover that money from the client. And things like the receivables. The receivables, any amount of money, maybe which is not yet paid by the client. And then we get the total asset here. We get the total asset. So after getting the total asset, we double underline that because now we are through with the first part of our statement of financial position. And then from there we proceed and record capital and liabilities. So we start here by recording capital. Then to this capital we add or minus, plus or minus the profit or loss for the year. So a profit is added to that capital, whereas now a loss is deducted. Also, if you are given drawings basically refers to any amount of money which is taken by the partners of a professional firm for their personal use, and then what we get here is the net capital. Net capital basically is the capital at the end of what? Of the year, at the end of the year. So then from there we proceed, we record liabilities. But for liabilities here, we start by recording non-current liabilities. Non-current liabilities, these may include things like bank loan, those particular liabilities which are payable for a period exceeding 1 year. And then finally we record the current liabilities. So current liabilities are liabilities payable within 1 year. This will include things like payables, or basically trade payables. This is the amount of money which is owed to the suppliers. Things like what? Things like money held on client behalf. Money held on client behalf. Money held on behalf on client what? On client behalf, and so on. And then from there we get now the total capital and liabilities. Total capital and what? And liabilities. Total capital and liabilities. And whatever you get here as the total capital and liabilities, always this one must be the same with the total asset, because you are saying that this particular statement of financial position here is prepared based on this equation, which states that total asset here should be equal to capital plus what? Liability. So whatever you get here is the capital and liability. Total capital and liabilities must be the same with what? The total asset. So therefore those are the financial statements which are prepared by the professional firm. We take a break, and then in our next session we look on an illustration question as far as the preparation of these particular financial statements are concerned. So see you in the next lesson. Hi students, welcome to another session of Manifested Online Classes. So in this session, I want us to continue with the topic on farm accounting, or accounting for agriculture activities. And specifically, I want us to do an illustration question regarding preparation of financial statements. But before you do that, there is a question which I want to give as an assignment. And that is a question for April 2023, question number 5A. You check on that particular question. It was requiring you give some provisions of IS 41 as far as the measurement of agricultural produce are concerned, and also the disclosure requirement, the information to be disclosed if the fair value of agricultural produce cannot be ascertained reliably. So make sure you attempt that particular question. Equally, if you'll have a challenge in terms of answering that particular question there, I usually encourage my students to acquire this particular revision kit or this revision partner for Manifested publishers. You'll be able to get now the solution for the same at the end of that particular book. So therefore, make sure you look on that particular question there. Now, for the purpose of illustration regarding preparation of financial statements, I want us we look on a question which is here, and I can go through it. And the question reads: the trial balance was extracted from the books of David Wekesa, a farmer, as at 31st of October 2019. So we are given the inventory that is on 1st November 2018. This is now the opening inventory for dairy cattle, maize which is growing, dairy cattle feeds, fertilizer for maize, landed buildings, tractors, other cattle which are bulls, and then we have cats which is the net book value purchases for dairy cattle, fertilizer for maize, fertilizer for napier grass, and then we have maize seeds, dairy cattle feeds. We have sales for milk, dry maize, green maize, dairy cattle, manure, and then we have crop expenses which include labor and other expenses, napier grass, labor. We have the general expenses. Then we have trade payables. We have capital as all on 1st November 2018, cash at bank, and then we have dairy cattle expenses which include manure, not manure rather, we have medicine, we have labor, other expenses. Then we have some additional information. Number one, you're given the inventory as at 31st of October 2019, which included dry, that is dairy cattle, maize, which is growing, other cattle which are bulls, dairy cattle feeds, and then we have fertilizer for planting maize. We have some additional information. Number two, we are told during the financial year which ended 31st of October 2019, the following distribution of farm produce were made. So we have the farm produce which were consumed by the family members, and then we have the milk delivered to relative hotel. You have to remember how we treat such farm produce. One farm produce which are consumed by the family members, we said this is accounted for as sales and also accounted for as what? As drawings. And then we have the milk which is delivered to relative hotel. This is like farm produce which are delivered or given to close relative. One, we account for that as sales, and two, we account for that as an expense in the general income statement. Number three, we are told manure valued at 600,000 removed from the cowshed and used in the maize plantation. This is what we refer to as the interdependence of department. Output from one department is an input in another department. So in this case, we said the producing department should account for that as sales, whereas the using department should account for that as purchases. Then we have the maize stock valued at 1.5 million used as dairy cattle feed. The same case in the interdependence of department. The producing department account for that as sales. The using department account for that as purchases. Then we are told the cattle bulls are used for pulling carts. So basically carts majorly are used in the farm, and what that means that these particular bulls then are used in the farm. Any information relating to the bull basically will be recorded in maize, or not in the maize lather, in the crop revenue account. And then number 6, you are told depreciation is to be provided on tractors and carts on the reducing balance method at the rate of 25% and 12% per annum respectively. Number 7, you're told income tax is estimated at 3.6. So what you're required to do here, Roman 1, is we prepare revenue accounts. You can see not one account, but two accounts. But from the information, or actually from the information which you're given there, it is important for you to note that David Wekesa was involved like in two farming activities. You can see we are given some information regarding dairy cattle, meaning that David Wekesa was involved in dairy farming, and at the same time we are given information about maize which is growing, fertilizer for maize, and so on. So therefore we can say that David Wekesa was involved in some form of livestock keeping, which are dairy cows, and as a result of that we have said that you need to prepare a revenue account called livestock revenue account. Also, David Wekesa is involved in growing of maize, in such a case, you prepare something called the crop revenue account. So therefore, here we're going to prepare two accounts, the crop revenue account and the livestock revenue account. Roman 2, the income statement. This, what in other terms we have referred to as general income statement. And number 3, statement of financial position. So we start with the Roman 1 of that particular question, whereby we are required to prepare the revenue account for David Wekesa. So this is the revenue account. The revenue account. And we have said that the revenue account, this one is prepared using a T format. We prepare this using a T format. This will be the debit side. The debit side. Whereas this is the credit side. The credit side. And this particular account will be having two sides. This is the credit, this is the debit. And then we prepare those two revenue accounts concurrently. We have now the crop livestock account. That is the crop revenue account and livestock revenue account. In the same case on the debit side, livestock revenue account and the crop revenue account. The livestock and the crop revenue account. Then the other thing which is important for you to recall here is that in preparing this particular account, we have said on the credit side we record two items. We record the sales and also the opening inventory. On the debit side we record three items: the opening inventory, purchases, and also what and also what we refer to as the expenses, specifically relating to crop and also to livestock. So let's start by recording the sales. And for sales we are given information as far as that is concerned in the trial balance. So we just need to record the sales given here. So we are given the sales one of milk. We are given the sales of milk. So basically milk, this is from dairy cattle. So basically dairy cattle, these are livestock. So therefore that one we recorded in the livestock revenue account. And also important for us to note here that all our figures are in thousands of shillings. All our figures will be in thousands of shillings. Will be in thousands of shillings. So then from there we also have the sale of dry maize. Maize is a form of a crop that go to the crop revenue account. And then we also have a sale of green maize, which is still a form of a crop that go to the crop revenue account. Then we also have a sale of dairy cattle. Dairy cattle, these are livestock. These go to the livestock revenue account, which is a figure of 81. And then from there we also have the sale of what? Of manure. Basically manure comes from what? From livestock, from dairy cows, and that is an amount of what? 3,000. So these are the various items of sales which are given. Then from there we need to go back to the trial balance because there are other items which we also account for as what? As sales, like maybe the farm produce which are consumed by the farm workers, by the family members, donated to close relative and so on. So let's go to note number 2. And in note number 2, first of all, we have the maize consumed by family members. Maize consumed by family members. So these we have said is accounted for as sales, and basically these are crops. So that will go to the crop revenue account. We also have milk delivered to relative hotel. Milk to relative hotel. This is also accounted for as sales. As far as the livestock is concerned, this is the agricultural produce from the dairy cows. That is an amount of what? of 4320. Yes, so we have that. And then note number 3 and 4, we have interdependence of departments. So number 1, we have the manure which was valued at 600,000 removed from the cowshed used in the maize plantation. We have said that the producing department now, which is the livestock, will basically account for that as what? As sales. So manure used in maize plantation. So that is sales as far as the livestock is concerned. And that is a figure of 600. And then we also have maize stock. Maize stock used as feeds or used as dairy feeds. Dairy feeds. So that maize stock is a form of came from the farm. The farming or the crop farming or the maize farming will account for that as what? As sales. That is an amount of what? Of 15. So I think that's what we have. Then note number 5, 6, 7 will not affect our sales. So therefore, those are, I think, additional items which you're going to account for as what? As the sales. 1, we have seen number 2, the maize consumed by the family members. That is accounted for as sales in the revenue account. Number 4, maize stock valued at 1.5 used to feed the dairy cows. So basically the maize stock come from the farm. That is what? Okay, yes, that will be accounted for as what? As the sales here. As the sales. And then we also have now the manure removed from the cow shed. Yes, so I think that treatment is okay. That treatment is okay, used in the maize plantation. And also, yes. So then from there, the next item we need to record on this side is the crossing inventory. Because I've said in the revenue account, we record 2 items on the credit side, the sales and also the crossing inventory. Now for the crossing inventory, this one is given in the additional information number 1. So for those particular items, we just need to copy them the way they are, no adjustment. So you have crossing inventory of dairy cattle. Dairy cattle, these are livestock that go to the livestock revenue account. We have crossing inventory of maize which was growing. Maize is a form of a crop that go to the crop revenue account. And then we have a crossing inventory of other cattle, which are bulls. There is some information which are given in note number what? Note number 5, whereby we are told these bulls are used in pulling carts. Carts mostly will be used in the farm. So therefore, these bulls are used in the farm. And that's the importance of that particular point number 5. So these will go to crop revenue account. And then from there we have crossing inventory for dairy cattle feeds. Dairy cattle feeds. So that go to the livestock revenue account, a figure of 1620. And then we have the crossing inventory for fertilizer for growing maize. Fertilizer for growing what? For growing maize. For growing maize. That automatically go to the what? To the crop revenue account, which is a figure of 1080. So those are the various items of crossing inventory we have. They are 5 items: dairy cattle, growing maize, and then we have dairy cattle, we have dairy cattle feeds, and then we have fertilizer for growing what? For growing maize. So that's what we record on the credit side. And then on the debit side, we record 3 items: the opening inventory. Then I've said we also record purchases and the expenses specifically relating to crop and also what? Livestock. So for this opening inventory, this one is given in the trial balance. So it's just a matter of transferring those particular figures here. And that is the first item in the trial balance. We have the opening inventory for dairy cattle. That that got to the livestock revenue account 54,900. Then we have opening inventory for growing maize, that got to the crop revenue account 36. And then we have daily cattle feeds, that got to the livestock revenue account 2520. And then we have fertilizer. This fertilizer is for growing maize, so that got to the crop revenue account 1980. So those are the various items of opening inventory. Then the other item which we also record on this side are purchases. Purchases, first of all, we have the purchases in the trial balance. We have purchases of daily what? Daily cattle. Automatically that got to what? That will go to the livestock revenue account 10,440. We have purchases for fertilizer. So some of the fertilizer is for maize, meaning that got to the crop revenue account, which is a figure of 2160. We also have fertilizer for napier grass. We know that napier grass, this is for feeding the dairy cows, so that will go to the livestock revenue account. And then we have purchases for maize seeds, maize seeds, that go to the crop revenue account, which is a figure of 1080. And then we also have purchases of daily cattle feeds, daily cattle feeds, which is a figure of what? Of 6120. Yes, so those are the various items of purchases given in the trial balance. 10,440 for daily cattle, fertilizer 2160 for maize, for napier grass 4,000, 1080 which is maize seeds, and then daily cattle feed 6120. Yes, so those are the items of purchases. But equally, in the additional information, we have some items of purchases. And basically what you check in the additional information is interdependence of departments. So in our case, we know note 3 and note 4, we are given information about interdependence of department. Remember, we have said this whereby output from one department is the input to the other. We have said the producing department will account for that as sales, but now the using department will account for that as what? Purchases. So let's go to note number 3. That manure which was removed from the cow shed and used in the maize plantation will be accounted for as purchases here. So we have what? We have the manure which was used in the maize plantation. Which was used in the maize what? Plantation. Which department will account for that as purchases? It is the maize farming or the crop farming. Whereas now we have seen that the producing department, which is now the dairy farming, account for that as sales. Then number 4, we have maize stock. Which is used as daily cattle feeds. So maize stock come from the farm. This will account for that as sales. The maize farming department will account for that as what? Or in the crop revenue account, we account for that as sales. Whereas now the using department, the consuming department, which is dairy farming, will account for that as what? As purchases. As what? Purchases. So I think those are now the 2 additional items of purchases which we have. And finally, what we record on these in this account on the debit side are expenses. Specifically relating to crop and livestock. Remember, the expenses which we record here are the specific, not the general expenses. So which expenses do we have here in the trial balance? Let's go through the trial balance. We see which expenses we have. Maybe starting up there, we have inventory. The first item in the trial balance, it is inventory. Below that, we have lard, tractor, other cattle, cats. All those are assets. Purchases, we have dealt with that. We have dealt with the sales, and then we have the crop expenses. These are crop expenses, and these we have labor, and other expenses, and these expenses we are told relate to crop. So therefore, we record that in the crop revenue account, a figure of 6480 and a figure of 720. Okay, so then from there we have Napier grass labor. So basically we know Napier grass is for feeding what? The dairy cows. So this is an expense relating to livestock. Napier grass labor that go to the livestock revenue account, and that is a figure of what? A figure of 1,000. And then from there we have now the general expenses. General expenses, these will go now to the general income statement. We'll go to the general income what? To the general income statement. From there we have payables, capital, cash at bank. Then we have daily cattle expenses. Daily cattle expenses. Daily cattle expenses are expenses specifically relating to livestock. So we have number one, medicine, which is a figure of 1080. We also have labor, which is a figure of what? Of 9480. 9480, and then we have other expenses. Other expenses, which is a figure of what? Of 1440. Yes. So those are the various items of expenses, or the specific expenses which we have. So basically what we need to do is now we balance our revenue account so that we can be able to determine the profit or loss of each department, of each what? Department. So let's start by balancing the crop revenue account. And what we need to do is to get the total on both the debit and what? The credit side. So we start by getting the total on the debit. So let's start by getting the total on the debit side. So we have a figure of what? A figure of 3600. Then we have another figure for 1980 plus 2160 plus 1080 plus 600 plus 6480 plus 720. 720. So the total on the debit is equal to 16,620. What about the total on the credit? So we have 36,000 plus 11,340 plus 1080 plus 1,500 plus 2,700 plus 5,400 plus 1080. Yes, that will give us 59,100. So out of these particular two totals, we pick the one which is higher than the other, which is 59,100, and we record it here in our totals on both sides. On both sides, both the debit and the credit side. So we know that once we add all these, it will give us now 59,100. But now if we add what we have on the debit, is not coming to that, but rather it is coming to 16,620. So the difference, which is 42,480, 42,480, this is now the profit from that department. So from that department of crop farming, we can say Wekesa had a profit. So we do the same. We balance now the other account, the other revenue account, that is livestock. So let's first of all get the total on the debit side, 54,900 plus 25,20 plus 10,440 plus 4,000 plus 61,20 plus 1,500 plus 1,000 plus 1080 plus 9480 plus 1440. So that is giving us 92,480, and then let's get the total on the debit side. Sorry, on the credit side, we have 27,360 plus 8,100 plus 3,000 plus 4320 plus 600 plus 54,000 plus 1620. Okay, so let's take that again. Yeah, it is coming to 99,000. 99,000. It's okay. 99,000. So basically, from that, the amount which is more is 99,000. We record it on both sides. 99,000. 99,000. But I think we can just confirm that. We can just confirm that for accuracy purpose. Can just confirm that. Is coming to 99,000. So the difference between the two now minus 92,480. So it's coming to 6520. So these whatever you have here, this is basically now the profit for the year from now those particular two what from those two departments. So basically that question was given how many marks? 6. So these are the items generally which are marked. If you are able to record now the sales and also the closing inventory on this side, and also in the correct revenue account, so basically you get now a mark. You get a mark. You can see these are questions with so many entries. So by doing that, you get now your 6 what? Your 6 marks. So then from there, let's proceed and prepare now the income statement. Quad in part A, not part A, rather Roman 1 of that particular question. Let's move to Roman 2, whereby we require to prepare now the income statement of David Wekesa, which is for the year which ended 31st of October 2019. 31st of October 2019. So this one is quite simple because we said that this one is prepared now to ascertain the entire the performance of the entire business of Wekesa. Is not prepared to ascertain the performance of each department, but prepared to ascertain the performance of the entire farming business undertaken by David Wekesa. And therefore, we have said in terms of how we prepare this, we take the incomes of David Wekesa from his farm, and then we less all what? The expenses. So what we start with here are the incomes, and basically I've said always we start from this we start with this particular profit from these two departments. So we have the profit from the crop revenue account and also from the livestock revenue account. So we have profit from the crop revenue account of 42,480, from livestock 6520. Yes, and then out to this we add other incomes. So what you need to check is whether David had any other income. You go back to the trial balance and basically check the items on the credit side of the trial balance. And I think up there I can see we have what, or basically on the credit side I think we have sales, which you have already considered as an income, and then payables, capital. None of those items is an income. So mean that David didn't have any other source of what? Income. So let's add the two figures so that we can get the total income of David. Okay, this will give us a total figure of what? A total figure of 49. And then to this, or basically this is now the total income. So to this we proceed and we less what? We less the expenses, and the expenses which we have, we deduct here are the general. The expenses the expenses not relating to these farming activities, not relating to crop farming, not relating to livestock, but these are the general expenses which are incurred. Maybe you can start from the additional information. In the additional information number 1, we have closing inventory. Additional information number 2, we have this particular milk which is delivered to relative hotel, milk delivered to relative hotel. Essentially what I've said is that any farm produce which is like donated, which is given free of charge, is accounted for as an expense here. But now that particular maize which is consumed by the family members, we say it is accounted for as sales here, and then as what? As drawings. So then we have note number 3, 4, 5. Okay, those will not affect this general income statement. And then we have now note number 6, we have depreciation on tractors, which is now at the rate of 25%, and also depreciation on carts. Carts, these one are like mkokoteni, which are used in the farm. So basically we need to compute now their depreciation, and we are told this depreciation is on the net book value. So what is the net book value of these two assets? So the net book value of tractors is what is 32,400. 32,400, and for the other one is 6,000. So this one we can say just that is 600. That is 600, and 12% of 6,000. Okay, let me confirm that. It should be 12% of 6,000. Of 6,000. Yes, that will not be 36, but rather it will be 720. So this will be 720. What about 25% of 32,400? This is 8,100. Yes, so that depreciation is a general expense. Okay, so then from there we have number 7. Number 7 is about tax. It's still an expense, but first of all we have to compute the profit before tax. Then we proceed and less what? Tax. So what then we need to do? Can we go back to the trial balance? We check whether we have any other general expense, and I think we only have one general expense, which in the trial balance is given, is referred to as the general expense. The general expense, or the general expenses, which is a figure of 800. So we need to get the total expenses, and then we less that from our total income. So we have 4320 plus 8100 plus 720 plus 10800. That will give us a total of 23,940. So we less that from our total up there, and we get a figure of 25,060. So this one we refer to it as profit before tax. Remember, in the additional information number 7, we are told we are given estimated income tax. So what we need to do, we less the estimated income tax, which is a figure of what? Of 3,600, and then we will get the profit for the year. The profit for the year. Profit for the year. This one will be how much? We have 25,060 minus 3,600. Yes, that will give us a figure of 21,640. So that is it. That what was required as far as that Roman 2 is concerned, and the marks are located. There were 6. So definitely the items which were marked is what we have there. So by doing that, you get now your 3 marks. So finally, Roman 3. we are required to prepare the statement of financial position, statement of financial position as at 31st October 2019. So this one is a statement of assets, liabilities, and what? And capital. So we start by recording assets. Specifically, we record always. First of all, we record non-current assets. So for non-current asset, I think we have a number of them in the trial balance. You have to record that all assets have a debit balance, and I think we can start from where we have land and buildings. Land and buildings. So for added buildings, I hope you can see they are not depreciated. So for the value for added buildings remain the same as 90,000. Then below that we have tractors. We have tractors. Tractors, we are given their net book value as 32,400, but these tractors during the year they depreciated. They lost a value of 81. So we have to less that depreciation there, so that we get their net book value at the end. We are going to compute that. And then from there we have other cattle, which are bulls. So remember, these are still assets. Specifically under IAS 41, we refer to them as biological assets. Biological assets. So they have a value of 6,000. And then from there we have cats. Cats, we are given the value as what? As we are given the value as what? As 3,000. 3,000. So meaning that there is something we need to correct here. This value was not 6,000, but rather it was 3,000. 3,000. So let's make that small change here. We took the wrong figure, so meaning that we have 12% of 3,000. 3,000. So that will be, this will be 360. 360. So we can correct this, which will be 23,940 minus 720 plus 360. That will be 23,580. 580. So we less it from that figure up there, 49,000. So which will give us 25 for 20. And then minus 3,600. Yes, so this will be 21,820. Yes, so that should be the correct thing. So I've taken the wrong figure for cats there, as 6,000 instead of 3,000. So that will be cats 3,000. So we less their depreciation here of 360. 360. Okay, so maybe you can just confirm whether we have any other item of non-current assets. Any other item of non-current asset in the trial balance, and I don't think so. So let's get now get the final figures here for these two assets, starting with tractors. Tractors, we have 32. We have 32,400 minus 8,100, which will give us what? Which will give us 24,300. And then we have cuts. We have 3,000 minus 320, which will give us what? 2640. 26 what? 40. 2640. Okay, I'm trying to counter check whether we have any other item Any other item of non-current asset? I don't think so. Yes, so next we record current assets. We record current assets. So for current assets, what do we have here? In the trial balance, we check the items on the debit side. What can I see? I can see cash at bank. Cash at bank, which is a figure of 15,300. 15,300. Yes, I think that is the only item we have in the trial balance. But now in the additional information number 1, we have the crossing inventory. Crossing inventory. So we have various items of crossing inventory which include daily cattle. Daily cattle having a value of 54,000. We then have growing maize having a value of 27. We have other cattle which are bulls having a value of what? A value of 54. And then we have daily cattle feeds. Daily cattle feeds having a value of 1620. And then we have fertilizer for planting maize, which is 10 what? 1080. So those are the various items of crossing inventory we have in note number 1. Note number 1080, 16, 20, 54, 27, 54,000. Okay, number 2, number 3, number 4. Yes, so we don't have any other item of current assets. So what we need to do is to get the total assets. Let's get the total asset. We add all these particular assets we have here, starting from what we have here at a non-current asset. We have 90,000. We have the other item 24,3, 6,000 plus 2640 plus 15,300, 300 plus 54,000 plus 27 plus 54 plus 1620 plus 1080. Yes, that will give us a total of 203,040. And then from there we record the financials, which include capital and what? Liabilities. So we start by recording capital, which is the first, actually not the first, but we have it in the trial balance as a figure of what? We have capital in the trial balance as a figure of 163,080. So to this, what do we add? We add the profit for the year. The profit for the year from the income statement, this one, which is 18 what? That is 21,820. And then to this, because this is a sole proprietorship business of David Wekesa, we less any drawings. And in the trial balance, we don't have drawings, but we have the information we have in note number 2 about the maize consumed by family members. We have said any farm produce consumed by the family member, we account for that as sales in the revenue account, and then we account for it as drawings here. So 1080. So then what do we get? We get the net capital at the end of the year. The net capital at the end of what? Of the year. So we have capital which is 163,080 plus 21,820 minus 1080, which will give us 183,820. And then to this we add liabilities. So always we start with the non-current liabilities. Because these are a sole proprietorship business, the only non-current liability which a sole proprietor may be having is a bank loan. Do we have a bank loan in this question here? No. So meaning that here we don't have any non-current liability. Finally, we record the current liabilities. For current liabilities, let's start with the what we have in the additional information. Additional information number 7, where we have the income tax. That income tax was not yet paid, and that's why it is given as part of the additional information. If it had already been paid, then it should be part of the trial balance. So take into account it had not been paid, it will be one of the current liability. And then in the trial balance, we have the trade payables. We have trade payables of 15,6 what? 15,620. 15,620. Do we have anything else? Do we have anything else? No. So what we need to do here is we get now the total. We get the total. We get total, capital, and liabilities. Total, capital, and liabilities. So we add those three items: 183, 820 plus 3600 plus 15,620. And that is giving us the same figure of 203, 040 as what we have there, is what we have there. So that is it. That basically what was required in that particular part of that particular question. And equally, the marks which were located there were how many marks? Were 3 marks. So those are the items now which were giving those 3 what? Those 3 marks. So that basically brings us now to the end of that particular topic relating to agriculture or accounting for agriculture activities, or accounting for farming activities. We have been able to discuss a number of issues. We have discussed what is biological asset, the recognition criteria, the initial subsequent measurement, and also we have looked on the financial statements prepared by an entity or basically a company involved in some farming or agriculture activities. Equally, you have looked on an illustration, and also there is another question which I've given as an assignment. Make sure that question which I've given as an assignment you attempted. So we stop at that point. See you in the next class as we discuss the next subtopic.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Ngwiri and I'm a practitioner within the financial services industry in Kenya. Today, ladies and gentlemen, we are going to discuss about portfolio management. Focus is on contemporary issues and emerging trends. Today, we are going to narrow down that discussion and talk about stock lending. So we can provide a description on what stock lending is, and we say stock lending, also called securities lending, is the lending of securities by one party to another. That is what stock or securities lending is. Also called securities lending is the lending of securities by one party to another. We proceed on and say that the terms of the loan will be governed by by a securities lending agreement, by a securities lending agreement. We can just remove that dot over there, securities lending agreement, which, pardon me for that, which requires that the borrower, provides the lender with collateral, provides the lender with collateral, in the form of cash or non-cash securities, in the form of cash or non-cash securities of value, non-cash securities of value, cash or non-cash securities of value equal to or greater than, equal to or greater than the loaned security, move on this other side, loaned security equal to or greater than the loaned security plus an agreed margin, Full stop there. So we are saying stock lending, also called securities lending, is the lending of securities by one party to another. The terms of the loan will be governed. By a securities lending agreement, which requires that the borrower provides the lender with collateral in the form of cash or non-cash securities of value equal to or greater than the loaned security plus an agreed margin. So that is what we're saying stock lending is. I will shortly demonstrate what stock lending is using a diagram. So we can, before we draw the diagram, I can say that the agreement is enforceable. The agreement is enforceable. It's enforceable under relevant law. Which is often specified. In the agreement. So we're saying that the agreement is enforceable under relevant law, which is often specified in the agreement. So this is the way securities lending or stock lending occurs. So on one side over here, we have what we call the lender, and on this other side over here, we have what is called the borrower. So borrower. And here we have the lender. Like that. On this other side, we have the investment. I have another rectangle right over here called the investment. investment. Now we're saying that the special arrows that highlight what securities lending are shown to you there. And I'll be able to label them in a bit. So the lender provides securities to the borrower. So here we're saying securities. Provides securities to the borrower, and the borrower is expected to provide collateral. Collateral is what we can be able to say as security, as a security. So what the lender does is that the lender then invests, rather using this arrow over here, sorry, not this one is moving up over here. The collateral is then provided for investment, so collateral, like that. And then what comes out of that is reinvestment income. So over here we can say reinvestment income. Reinvestment income, like that. So this is the simplest way I can be able to explain to you what securities lending is all about. The lender provides securities to the borrower. The borrower is expected to provide collateral, which in turn the lender invests that collateral there, and then they actually get reinvestment income from that element of investment right there. So moving over on this other side, we look at the benefits and disbenefits of securities lending or stock lending. We can say benefits of securities lending. Benefits of securities lending. Lenders. Point. Over here we say ability to earn income through fees charged to the borrower continuously. And then we also say that to the lender, it provides them with an ability to have diversification. So diversification. So the lender has an additional option to invest or to earn income by lending out the security to the borrower. From the borrower's point, the benefit or the major benefit is that there are more options available to take. There are more options available to take additional securities. There are more options available to take additional securities. Then we can also say allows them to take positions in short selling. Allows them to take positions in short selling. Like that. Then now we go to disadbenefits. Let me try and see if there's another advantage over here from the borrower's point. Increases liquidity. It provides for increased liquidity, provides for increased liquidity within the market so as to tighten spreads within the market, so as to tighten spreads, which is good for market participants to earn returns, which is good for market participants to earn returns. So here, let's look at the disadvantages. So disadvantages, these benefits of securities lending, Then we can say lender's point. We can say the value, if the value of the collateral decreases, if the value of the collateral decreases, below the cost, the lender is disadvantaged. Another disadvantage is that if is disadvantaged there as well, the borrower may become insolvent. Leading to default risk, which may affect the operations of the lender. Then, from the borrower's standpoint, if the value of the collateral increases, increases above the cost, if the value of the collateral increases above the cost, the borrower is disadvantaged. The borrower will be disadvantaged. So we are saying that if the value of the collateral decreases below the cost, the lender is disadvantaged. As well, the borrower may be more insolvent, leading to default risk. From the borrower's point, ladies and gentlemen, if the value of the collateral increases above the cost, the borrower will be disadvantaged there. And if that happens, then of course it means that the borrower is going to really spend much more repaying the debt that they actually took in form of securities right over here. So this diagram right over here, ladies and gentlemen, I can be able to explain to you that is a rather simple diagram, but if you look at it from the lender's point of view, the benefits and disbenefits, the borrower's point of view, the benefits and disbenefits are pretty straightforward. So this brings us to the end of today's lesson, ladies and gentlemen. I hope you've enjoyed it, and I will be able to give you an assignment. I can do it on this side. Explain the benefits and disbenefits of securities lending from both the lenders and the borrowers' standpoint. Thank you for being with Manifested Publishers, and be blessed. Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, and I am a practitioner within the financial services industry in Kenya. Ladies and gentlemen, today we are going to discuss about portfolio management. The focus is on contemporary issues and emerging trends. We are going to discuss about program trading, and we say the following, I can write the following, that it refers to volume trading, which is done by systems, executed by systems, usually automated, based on an underlying, let me write it properly, apologies for that, based on an underlying program or idea. Let's stop there for 1 second, guys. It refers to volume trading, which is done or executed by systems, usually automated, based on underlying program or idea. It is a wide range of portfolio strategies. It is a wide range of portfolio strategies, involving the purchase or sale, of stocks. We can say purchase or sale of 15 or more stocks, 15 or more stocks having a total market value, total market value of $1 million, $1 million, or even more, Stop there. It is a wide range of portfolio strategies involving the purchase or sale of 15, ladies and gentlemen, or more stocks having a total market value of $1 million or even more. Now, once we have introduced what program trading is, it can almost be referred to as algorithmic trading, high volume trading that involves the utilization of a given number of strategies, ladies and gentlemen. And we're also saying that the strategies could be, or the types could be either principal, they could be either basis or even contra-day strategies thereon. So we can continue and say that program traders are almost always program can come on this other side. Traders are almost always program traders are almost always executed by computers. Executed by computers. Although there are instances we can say although there are instances in program trading, there are instances when this isn't the case. When this is not the case, for example, institution X. Institution X wants to sell a basket of 15 stocks. Wants to sell a basket of 15 stocks totaling $2 million. Totaling to $2 million. $2 million. $2 million. It would simply split up. It would simply split up the sale among different brokers. Among different brokers. In other words, you're saying that people plan the strategy and you're saying the computers are the ones that do the work. So traders are almost, is R, I've written R twice, are almost always trades are almost always executed by computers. But although there are instances when this is not the case, for example, institution X wants to sell a basket of 15 stocks totaling $2 million. It would simply split up the sale among different brokers. So when people plan strategies and the computer does the work, this is how program trading looks like. So we have this computer right over here. Please forgive my drawing right over here. And I'm saying that here is where the coding or the codes are actually created. Of course, there has to be what you're calling the CPU right over there like that, and it's the one that actually does or processes or executes trades. Buy and sell. You can put it in a different color over here. Buy and sell. Buy and sell of securities. Buy and sell of securities. Then we are saying the types can be of 3 of them. Types of program trading can be where the principle over here we are saying this is where replication of an index is actually ensued. So replication of an index where the portfolio manager or the strategies try to copy the returns that have been generated by an index, and that is all done by the program trading or by the computer. So replication of an index, Then the second type of program trading is basis over here, and over here trying to identify price inefficiencies, strategy to identify price inefficiencies. So the computer tries to identify price inefficiencies, trying to identify undervalued stocks, or tries to identify undervalued stocks. Undervalued stocks is what the computer system actually buys those stocks, of course using an algorithm, and the overvalued stocks are actually sold. Then finally, the third type of program trading is contra trading, buying and selling through buying and selling consistently like that. So we're saying we buy in one market and sell in another market right there. So we're saying that's what happens in a contra. Buying and simultaneously selling the same security. Buying and selling the security simultaneously. So of course this uses futures or options, and that is actually executed using the computer system. So we are saying what? We are saying that the types of program trading include the principal, which involves replication of an index, and that is done by the system, by the computer system or algorithm. Basis trading, which involves a strategy to try and identify pricing inefficiencies, undervalued stocks and overvalued stocks. Then there is contra trading, where you buy and sell securities simultaneously in different markets using futures contracts. Let's move on this other side. Let's look at the advantages. Advantages of program trading. We're saying it is quick to execute and implement. It is quick to execute and implement. Number two, over here we say places trades according to strategy. It places trades according to strategy. Number three, exploits opportunities without emotions. It exploits opportunities without emotions. So it is quick to execute and implement. Execute and implement are the keywords there. Second, it places trades according to strategy, either basis, principle, or contra, actually executed using algorithms. So you can be able to come up with an algorithm that actually executes principal strategies, basis strategies, and even contra strategies. Very simple. It exploits opportunities without emotions. That is very key. So having looked at the advantages, we move over and discuss the disadvantages. Disadvantages. We're saying that number one, it brings about extreme volatility. For example, in the 1990s, it brings about extreme volatility. And for example, in 1990s, there was a bit of a flurry of activity that took place as a result of program trading. Number two, it is expensive. It is costly to implement and trade. It is costly to implement. So these are the two main disadvantages over here, that it brings about extreme volatility, for example, in the 1990s, and it is costly to implement. So this brings us to the end of the lesson. We hope you have enjoyed it, and I will leave you the assignment. The assignment is as follows, right down here. Assignment. Explain what is meant by program trading. Explain what is meant by program trading. So thank you for being with Manifested Publishers. Continue being with us, and we are here for you.
Hi there, my name is Patrick Kamau Kamure. You are lecturer in advanced taxation. So I welcome you today to the lesson where we look at a topic called tax investigation. And under the tax investigation, we are going to look at the back duty and in-depth investigation. So when we talk of the back duty, we are talking about the tax that is in arrears or that was in arrears. Back duty, you know, the tax, the duty that is backward, the one that was supposed to be corrected by the KRA from the taxpayer, but it wasn't corrected. So what the KRA normally do, they normally come and look at your books of account, and they do a thorough investigation in order to determine your tax position. So in this case, we want to see how is that investigation usually done. In this case, what you also need to understand is that when you talk of the back duty or the tax that is in arrears, and in which case an in-depth investigation is usually done. So in this case, what normally happens is that KRA usually have to come and look at your books of account and determine the taxable income. The taxable income of each of the years. So taxable income in that, if for example you are under investigation for 5 years, so they have to determine what is the taxable income of the first year, what is the taxable income of the second year, third year, fourth year, and the fifth year. And once they determine the taxable income of each of those years, then they multiply by the tax rates. If it is a company, 30%, and then they can be able to get the tax that you are supposed to pay. If you are an individual, then it is graduated, because we know that individuals, it is usually on graduated scales. So it is graduated to determine now the tax that you are supposed to pay. So in this case, we should ask ourselves then, what normally costs the tax that is in arrears? What normally costs the back duty? It is usually as a result of majorly 3 things. One, non-declaration of taxable income, where the taxpayer didn't declare the taxable income for those particular period at all. So the KRA would have come and now determine the taxable income for each of those years. 2, under declaration of the taxable income. It means that you didn't declare the correct amount of the taxable income. For example, you have been earning, let's say, 100,000 per month, but instead of declaring that, and remember we normally declare when you are filing the returns, instead of declaring the 100,000, you declare 50,000 every year. So that means that the KRA will tax you on 50,000. So the 50,000 that you have not declared, that would amount to the back duty when it is taxed. So another one we have where the taxpayer have been over declaring the allowable expense of the business. So remember, expenses normally reduce the taxable profit or income of the business. So if the expenses are overstated, then the taxable profit automatically will come down. So in that case, that means that if the profit is less, then the KRA will come and investigate. Why have you been under declaring the over declaring the allowable expense or under declaring the taxable profit? So in this case, then that means that when they do the investigation and determine the correct amount of the expense you are supposed to deduct, because now you have been over deducting, then that means that this would amount to the tax in arrears, or what we call the back duty. Now, when the in-depth investigation is usually done, the KRA normally use one item to do that. We call it the capital statement. And capital statement, as we are going to see, it is used when we have more than 1 year. The taxpayer has not been declaring their taxable income for more than 1 year, and we are going to see how that capital statement is used to determine the taxable income of the taxpayer. So before we go very far, I'd like us to write something on that. That back duty refers to the tax in arrears. In arrears, that is the tax that was supposed to be paid in the past years, but it was not paid. The tax in arrears is usually determined using by the KRA, determined by the KRA by doing an in-depth investigation. In-depth investigation is where KRA take a look at all books of account of the taxpayer to determine the correct tax position. Another point is that back duty stroke tax in arrears can be as a result of the following. One, non-declaration of taxable income. Number two, under declaration of taxable incomes. Number three, overstating of allowable expenses of the business. And the last one I want to add here is claiming expenses or relief one is not entitled to. One is not entitled to. So another point that you need to know is that when determining the tax in arrears, stroke back duty, the commissioner will determine the taxable income each year from where the tax in arrears will be computed through computation of taxable income and tax rate applicable for the years of income for the taxpayer and the year of income. We say another one is that determination of taxable income where investigation involves several years is done using capital statement. So it's good to know we have talked about capital statement there. And we say capital statement is used where no proper books of account have been kept by taxpayer. It involves comparison of assets and liabilities of business to determine the capital or net assets or net assets or net assets, after which growth in capital or net assets is used to determine taxable income. Capital statement which is used to determine the taxable income has the following format. So I already have explained to you what that means. However, we are saying now, where no proper books of account have been kept, the taxpayer normally use the capital statement, or KRA will use the capital statement to determine the taxable income of the person. Now, once they get the taxable income, then they'll just compute the tax payable by multiplying with the corporate tax rate or the graduated scale rates for the taxpayer, in case it is an individual like those in sole proprietorship or those in partnership. So we are saying that capital statement is usually prepared by comparing assets and liabilities to determine the capital or the net assets, after which the growth in capital or growth in net assets would then be determined, and from there now the taxable income would be determined. So capital statement, we are saying, has the following format. So I'm going to draw for you the capital statement there, see how it is used to get the taxable income. So I leave this space because of the structure of the capital statement, and utilize the space on the other end. So this is how capital statement look like. We have the capital statement. We have the items, and then we have years, which we have year 1, year 2, year 3, year 4. So this will be writing the figures. And so we usually start with the total assets. Total assets. For the total assets, let me write them this way. We start with the total assets. Total assets. So total assets of the business, which we list them here, year 1, year 2, year 3, year 4. And then we less total liabilities. Total liabilities we have for each of the year. Year 1, we less. And that will give us capital. Will give us the capital at end of the year. Capital at the end of the year, we have this for each. Then we less capital at the start of the year. Of the year. And that will give us the growth. Let me write in short, growth in capital or net asset or net accounting profit. Net accounting profit, which will have the amount. Then we add non-allowable expenses. non-allowable expenses for each of the year, and then we less capital allowance, and non-taxable incomes. And that will give you, it will give you the net accounting profit there. So that is how the capital statement look like. We have the name, and then this where you can see we are listing the item, and we list the years, year 1, 2, 3, 4. So what we usually do, we start with the total assets of the business. And when we talk of the total assets, take note we are talking about all the assets of the business, both private and commercial. So not that we may say that because we are looking at the taxable income of a business, we only take for the business only. No, we take the business and the one that are for private, non-commercial. Why are we considering the private? Because it's assumed that this person got the money from the business to finance his private asset. So that's why you take all the assets of the business. And then you raise the total liabilities of the business. Why are we minusing total liability? Which means both business and non-business liability, because this is the owner of the business, and what he's doing is that he cannot be able to differentiate the business, the income, the money that he borrowed for the business and the one he didn't borrow for the business. He can borrow not for business and bring the money into the business. So that's why we consider all the liabilities. So for each of the year, then when you compare the assets minus liability, it will give you the capital at the end of the year. So what we mean is that these assets must be at the end of the year, liability at the end of the year, so that it will give you capital at the end of the year for each of those years. And then you raise the capital at the start of the year. So when the year was starting, how much was the capital? So you come and post it here, post. Now when you say the capital at the end of the year minus capital at the start, it normally give you the growth in capital or net assets or net accounting profit. Because if, for example, at the end of the year you have 200 million, let me use another current so that you can be able to see. Let's say you had 200 million here, and then that is at the end of the year. At the start of the year, you had 150 million. So it means that now the capital grew by 50 million to 200 million from 150. So the 50 million is the growth in capital, which we normally post there. Now, once you get the growth in capital or net assets or net accounting profit, then you know this net accounting, an accounting profit where now you can use the net profit method to get the taxable income. Net profit method means that we add non-allowable expenses. So non-allowable expense for each of the year, and then you raise the capital allowance. So here you should have added non-allowable expense. One of the non-allowable expense we have run so far is the depreciation. So depreciation you should have disallowed, but now in taxation we allow capital allowance. So we deduct it here. And also if there is an income that is not taxable. And when we talk of taxable, we talk of non-taxable, we mean those that are investment and the operating income, the one that are not taxable. So like now, dividend and interest from abroad are exempted from tax. Interest from a bank for an individual, withholding tax is final. So those that are final and exempt, don't tax them, so we should remove them. So when you take this figure, net accounting profit, add non-allowable less the capital allowance and non-taxable income, it will give you the net taxable profit. So in this case now we can go ahead and tax those particular profit on that particular person or business. So that is how we prepare the capital statement to determine the taxable income. However, it's also important for you to note that if you are given the capital at the end of the year, then you don't have to compare the assets minus liability. You just take the capital at the end of the year, and then now you continue from there at the end minus at the start, and then you continue at the end. So I want us to look at a question to see what we are talking about, the back duty using the capital statement. So I'll have to rub what I have written here so that we can have a space to do the question. This is what the question says. Johnson Shauri has not been maintaining proper books of accounts since the inception of his business in the year 2019. The following balances were obtained from the available business records for 4 years period ended 31st December 2022. So we have the years 31st December 2019, 2020, 2021 and 2022, which we have leasehold property, motor vehicle, furniture, a bank overdraft, loss on sale of investment, account receivable, mortgage loan, inventory, computer, bank account, personal clothes and effects. The following additional information was obtained. Drawings of goods and provision for taxation for the year 2019 were 600,000, 360,000 respectively, and had been accumulating at the rate of 10% annually. A capital allowance were agreed at a total cost of 920 for each of the 4 years. Donation to a political party in the year 2020 amounted to shillings 142,000. Gifts from relative for the year 2021 were 840. Contingent liability in respect of a pending court case in the year 2022 was 1 million. Rent paid on behalf of a close friend was 605,000 in the year 2022. Living expenses were estimated at 800,000 in the year 2019 and had been increasing at the rate of 15% cumulatively each year. We are required, number 1, compute the taxable income or loss of Johnson Shauri for the year ending 31st December 2020, 2021 and 2022. Summarize 3 specific actions that the tax practitioner could undertake upon discovery of an irregularity in the client business. So first we want to get the taxable income, and in this case you can see we have been given several assets of the business, several liabilities of the business, and we are given them the years. There are several years, so we are supposed to get the taxable income for them for the 3 years. So that is 2020, 2021 and 2022. However, now we are also given the column for 2019 because we haven't given the capital at the beginning of 2020. Actually, if you are given the capital for each of the year, in that case we should now start from the capital and now we continue from there. But we are given the assets and liability. So we need the capital at the beginning of 2020, which is the first year of determination of the taxable income. So we need a column for 2019 where we take the assets minus liability to get the capital by the end of 2019. Once you get the capital by the end of 2019, then we can be able to use it in the 2020 as the capital at the beginning of 2020. So this is how the capital statement should look like. So we'll start with the total assets. We list them. The leasehold property is the first one. Which we have 11,760. 11,760 across the board. Motor vehicle. We have 50/40. Furniture. Then we have the loss bank overdraft, that's a liability. Loss on sale of investment, that is an expense. Account receivable is another. Then mortgage loan, that's a liability. Inventory is another. 620, 572, 482, 520. Then we have computers. 620, 720, 840, 720. Bank account is another. 240, 268, 272, 286. Personal cross and effects, those are supposed to be asset as well. Personal effects. Personal cross and effects. $60, $80, $100, $120. So we need to get the total. Before we do that, we also need to look for the total liabilities. Total liabilities, which we have the registered no motor vehicle furniture bank overdraft. Bank overdraft where we have 1288, 1400, 1210, and 15. The other one is mortgage loan. $2080, 1840, 1620, and 1500. And those are the liabilities that we have. So we need to get the total. Except there was one more liability, sorry. In the point number 5, there was a contingent liability. Already you are told it's a liability contingent one. So contingent liability. Which we have 1,000 in 2022. And yeah, those are the one that we have. So we'll get the total. We will add them starting from here. So we have 11,760 plus 5040 plus 864 plus 432 plus 620 plus 620 plus 240 plus 60. 19,636. The other one is 11,760 plus 4720 plus 864 plus 544 plus 572 plus 720 plus 268 plus 80. 19,488 The other one is 11,760. We add 9360. We add 864. We add 48. We add 482. We add 840. We add 272. We add 100. 24,086. Go to the last one, 11,760. We add 10,760. We add 864. We add 600. We add 520. We add 720. We add 286. We add 120. We have 25, 630. Then we come here, 1288. We add 2080, which will be 3368. And then 1400. And we add 1840, which would be that 240, 1210 plus 1620, 2830. Then we have 15 plus 1500 plus 1000. That's 615. So now we get the capital at end of the year, which will be now the asset minus liabilities. So for the first one, it will be 19,636, and then we minus 3368, which give us 16,268. The other one will be 19,488 minus that 240, which gives us 16,248. The other one is 24,086, and we minus 2830. 21,256. The other one is 25,630, and then we minus that 615. 22,015. So with that capital we less, and we are calling the capital at the end because these figures are at the end. So we less capital at start of the year. So for the first year, remember, the question was asking we get the taxable income from 2020. So capital for this one, we just required, the end of 2019 mark the beginning of 2020 so that we can come and bring it here. 16,268. Now, the end of 2020 mark the beginning of 2021. So it will be 16,248. This one comes here, 21,256. So this will give us now the growth in capital or net accounting profit. Which will be now this minus this, 16,248. And then we minus 16,268, which gives us negative 20, a loss. The other one will be 21,256. 21,256. and then we minus 16, 248. It will give us 5,008. The other one is 22, 015. And then we minus 21, 256. It will give us 759. And then now, this being the net accounting profit, we adjust it by adding non-allowable expenses. Non-allowable expenses. So we go through the question to look for non-allowable expense, starting with whatever has been provided in the list of the item. Leasehold property, motor vehicle. In the middle, there is loss on sale of investment. We don't allow loss on selling of the investment, so we add it back. Loss on investment, which happened in 2020, so it will come here. So dash from here, 100 here, dash, dash. Then we go to the additional information because there is no other fixers, there is no other expense up there. Then additional information, number one, the drawings of goods and provision for taxation for the year 2019 was 600, 360 respectively, and had been accumulating at the rate of 10%. So in this case, we are told for the year 2019, it was 600. That is drawings. And the tax was 360 and had been accumulating. So those are not allowable. Tax drawings are not allowable. So we have the drawings where they should be growing by 10%. So we have 10%. So it means that now, since that was for 2019, for 2020 we'll have 110% of, we take the drawings for the first one, 600. For the other one, if it is for the tax, not for the tax, so we have tax provision, which we have a 110% of 360. So we'll have 110 of 600, which give us 660. So here we should be having 60. Remember 2019, we don't need anything. So 660. The other one would be 110 of 360, 396. And then this one will again multiply by 110 because they are growing by that, times 660. It will give us 726. We multiply again by 110, which gives us 798.6. We come back here, 396 times 110, which gives us 435.6. And then the other one, the same, times 110, which gives us 479. We round off 1602 to one decimal place. Then we continue. Capital allowance, that is not, it's allowable, not non-allowable. Donation to a political party in year 2020 amounted to that. That's not allowable. So donation, political party. Political party, of which case we have a 142 in 2020. The other one is gifts from relative. That's not an expense. Actually, it's an income. So we'll consider it an maybe non-taxable income. Contingent liability, that we had already accounted for under the liability here. The other one is rent paid on behalf of close relatives in 2022. That is not allowable. Rent for relative. Rent for relative, which you have 605. 605. So I like us to continue here So I'll have 2019, 2020, 2021, 2022. A continuation. Then living expenses were estimated to be 800 in the year 2019 and has been increasing at the rate of 15% cumulatively each year. So we'll have living expenses. So we do the same. For the year 2019 was 800, and then you multiply by 115% to know how much would be for 2020. So that will be 800. Then you multiply by 115, giving us 920 times 115, which gives us 1058 times 115, which gives us 1216.7. So we are done with the non-allowable expense. Now we go to the non-taxable income and capital allowance. So we less capital allowance and non-taxable income. So we need the capital allowance and non-taxable incomes. So we are given the capital allowance already in point number 2. Capital allowance were agreed at a total of 920 for each of the 4 years. So we'll have capital allowance. Which we have 920, 920, 920. The only thing that remains is to look for non-taxable incomes. So non-taxable incomes, in the list up there, there is none. Additional information, number 1, there is none. Number 2, none. 3, none. 4, gift. Gift are usually not taxable income, so we need to remove them. Gifts. The gift which came in 2021, 840. Then liability, no. Number 6, rent paid on behalf of close friends, no. Living expense, nothing. So from there we can now get here net taxable incomes. So net taxable incomes, which will start from the loss, so negative 20, and then we add 100, then we add 660, and then we add 396, and then we add 142, and then we add 920, and then now we minus 920, which give us 1278. The next one, 5008, we add 726, we add 435.6, we add 1050, and then we minus 920, we minus 840, which gives us 54, 59.6. The last one, 759 plus 798.6 plus 479.2 plus 6 of 5, and then plus 1216.7, and then we minus 920. We have 2938.5. So this, remember, it is a point. Yeah. So that is the taxable income, and we have already answered the required number 1. where we were supposed to compute the taxable income or loss of Johnson Shauri for the year ending that 1st December 2020 and 2020, 2021, and 2022. So then you are supposed to summarize 3 specific actions that the tax practitioner could undertake upon discovery of irregularity in the client business. So here, so you can do this. This was for Roman 1. Now we have Roman 2. One of the things that you can do is not to notify the client. Notify the client of the irregularity. That is one. Another one is put measures to prevent further irregularity. And the last one, that when you discover there is irregularity in the client business, is to put measures. You can also put measures to prevent recurrence of the irregularity. So that is what you are supposed to do. Discover that there is irregularity in the client operations. So that is how you answer such a question. I'd like us to look at another question, same or about capital statement and back duty investigation. This is what the question says. Peter Chawawa started a retail business on 1st January 2012. He has not been filing income tax returns for the 6 years to 31st December 2017. Now, an investigation of his affairs revealed the following. 1. The balance sheet of the retail business as at 31st December 2012 was as shown below. So we have the fixed fixed assets, which consists of premises 2,000, furniture and fittings 1,000, motor vehicle 500, current assets given, debtors, bank balance, cash in hand. Then total assets. We have the capital as at January 2012, net profit for the year, drawings, mortgage loan, creditors. Number 2, he constructed an extension to the premises in the year 2016 at the cost of 625,000. The following accounts balances were outstanding in the respective years as shown below. So we have the trade debtors, bank balance, trade creditors, cash in hand, stock. He withdrew goods worth 5,000 per month per annum from the business for his personal use. The principal repayment on each mortgage loan amounted to 250,000 per annum from 31st December 2013. The mortgage interest paid in each of the 4 years ending that 1st December 2013, 14, 15, and 16 amounted to 100,000, 75,000, 50,000, and 25,000 respectively. His wife opened a saving account in a commercial bank in the year 2012. The balance in the account after crediting the interest earned were as follows. 2013 all the way to 2017, we have the saving account, interest earned. Then his living expenses and wear and tear allowance were agreed with the Revenue Authority as follows. So we have the living expense, the wear and tear. So we are required to compute annual income of Peter Chawawa from 2013 to 2017. So here again we see that we have been given several assets and several liabilities, and we are required to get the taxable income. So the first thing that we normally take, we note which years are we getting the taxable income. It is from the year 2013 to the year 2017. So now we have to determine if you are given the capital by the beginning of 2013. Yes, it is given in additional information. Number 1, because we are given the balance sheet as at 31st December 2012, which obviously the balance sheet has the capital, the assets, and liability. So if you look at the capital, We cannot talk of 3,000 because that is capital as at January 2012. So we want at the end, which was now that at the beginning capital, net profit for the year less drawings, you get 2,800. That is the capital now at the end of 2012, which marked the beginning of 2013. When the time comes to use it, we'll use it. So the rest we have to now, since we are not given the capitals for each of the year, take the assets minus liabilities. But if you look at the ones that are for each of the year, they are in point number 3, that the following accounts balances were outstanding in the respective years as shown below. So where we have trade debtors, the bank balance, creditors, cash in hand, and stock. But if you look at the characteristics of those assets and liability, they are current one. We don't have fixed assets and fixed non-current liability. So we have to confirm if we had them. Yes, we had them. If you look at the balance sheet of December 2012, there are fixed assets, 3 of them. Those must be carried in the subsequent years automatically. And when it comes to the premise, as per additional information number 2, we have an addition in 2016. So we just add. Otherwise, the others will be the same for those years. When it comes to the non-current liability, we can only find one, the mortgage loan of 1,000 as at 31st December 2012. So that should be in the subsequent years, except that in additional information number 5, we are told that the principal repayment on each mortgage loan amounted to 250,000 from 31st December 2013. So it was being paid 250 every year. So we'll be reducing by 250 every year. Otherwise, we post them as they are. So we'll have Peter, Chawawa, capital statement. So we have the years that we are required to get: 2013, 2014, 2015, 2016, and 2017. As per the required in the computation of taxable income. And I want us to convert them to shillings thousand. We start with the total assets. So first of all, we'll bring forward the non-current assets, which we have premises, 2,000, 2,000, 2,000. But now in additional information number 2, there was an extension in 2016 of 625. It will be 2625, 2625. And then now the other fixed assets, furniture and fitting, $1,000. Then motor vehicle, $500. Then we now bring forward the point number 3, trade debtors, $173, 190, 28, 230.5, 253. Bank balance, which we have 109, 194, 281. 281. Now for the last year is an overdraft, so we put a dash. We have cash in hand. $10. Stock $255. 302.5. 332.5. 366. 402.5. Now there's still another asset in point number 6. His wife opened a saving account in commercial bank in 2012. The balance in this account after crediting the interest earned was as follows. Although they are the wife, it is the wife the account, but we are not told that it was a separate or she was not getting money from the business. Because that is not clear, we have to assume she was getting money from the business being given by the husband. So it should be considered here. Remember we said we consider all assets, both commercial and private. So you'd have saving account. $300, $900, $100, $725, and $750. With no other, we'll get the total. And then we come to the total liabilities. So we start with the non-current liability in the balance sheet on number 1 as at 31st December 2012. We have mortgage loan. So in additional information number 5, we were told that there was a payment of $250 every year. So here 1,000 minus 250 give us 750. Minus 250 again, 500. Minus 250, 250, minus 250, dash. And then now we bring the current liability. In point 3, first we have the bank overdraft. A negative bank account represents a bank overdraft. So which was in the last year here, 32. And then the other one is the creditors, trade creditors. Trade creditors which you have to 30, 241, 253, 272, and 291.5. And then we can get the total. So 2,000 plus 1,000 plus 500 plus 173 plus 109 plus 10 plus 255 plus 300 giving us 43, 47. We do the next one, 2,000 plus 1,000 plus 500 plus 190 plus 194 plus 10 plus 302.5 plus 900. 5096.5. The other one is 2,000 plus 1,000 plus 500 plus 208 plus 281 plus 10 plus 332.5 plus 100, half 44, 31.5. The other one is 2625 plus 1500. This is already 1500 plus 230.5 plus 281 plus 10 plus 366 plus 725, giving us 5737.5. Next is 2625 plus 1500, that is the 1500 plus 253 plus 10 plus 402.5 plus 750, 5540.5. The other one will be 750 plus 230, 980. Then this will be 741. This will be 503, 272. And then this one is 291.5 plus 32, giving us 323.5. Now we can get the capital at end of the year. That is assets minus liabilities. So it will be 4347 plus 980 plus 980 minus, sorry, it should be minus 980, giving us 3367. Next is 50, 96.5 minus 741, give us 4355.5. The other one is 44, 31.5, and then minus 543, 3928.5. The other one is 57, 37.5 minus 272, giving us 5465. 5465, 65.5. Then 5540.5 minus 323.5, giving us 5217. Then now we less capital at the start of the year. Which for the first year we have to bring the capital that was there, which was 2800. The one in additional information number 1. Now for this one it will be this one, 3367. This one will be 4355.5. This one comes here, 3928.5. And this one, 5465.5. So we'll get the net accounting profit. So we start with this, that figure minus 5465.5, giving us negative 248.5. This one, 5465.5 minus 3928.5. 1537. The next one is 3928.5 minus 4355.5 43 4355 4355.5 giving us negative 427. The next one, this one, 4355.5 minus 3367 988.5 3367 minus 2800 567. Now this will now add non-allowable expenses as per the question. Number 1 does not have an expense. Additional information. Number 1 was a balance sheet. Number 2 was an extension. Number 3 were assets and liability. Number 4, he withdrew goods worth 5,000 per annum from the business for personal use. So we have drawings. Drawings are not allowable expense, which we are told each year was 5,000. Since they are shillings 1,000, it will be 555. Number 5, the principal repayment on each mortgage loan was 250 per annum from 31st December 2017. That doesn't have any issue. It's not an expense. It's a loan that was being repaid, but there was mortgage interest. Mortgage is used to construct a residential house. So the interest on mortgage is not allowable because it's not for business, it's for residential. So mortgage interest which we are told it's 100, 75, 50, 25. This didn't have anything. The number 6 is about the saving account and interest earned. That's an income, not an expense. Number 7, there is living expense. Living expense are not allowable. $300, 400, 450, 500, and 600. And wear and tear, that's now, wear and tear, remember, is a capital allowance. Capital allowance. So an unallowable ends there. We now less capital allowance and non-taxable incomes. And we start with capital allowance. We said capital allowance is the wear and tear. So capital allowance or WTA. So we deduct, we have 155.5. We have 130. We have 109. And then 73, 157. The only thing that remains is the non-taxable income. So we continue here, 2013, 2014, 2015, 2016, 2017. So we now look for the non-taxable income. There was only one income in the question. In number 6, interest earned from saving account. That, if you look at what we said when we were looking at the taxation of the business income, interest earned by an individual from a bank is a qualifying interest. Withholding tax is final. So that we need to remove because we should not be taxing it again. So interests from bank saving account, which we have 300, 900, 100, we have 725, and we have 750. Sorry, the interests are 25. These are saving account. We are looking at the interest 75, 90, 70, 60. And 60. Now with nothing more, we can get net taxable incomes. So we add them. So we'll start from here. 567 plus 105. This actually 405 plus 405 minus 155.5, and then minus 25. 791.5. Next, 988.5. And then this is 80, 480 plus 480 minus 130 minus 75. 1263.5. Next, negative 425.7. 427. And then this 500, 505 plus 505 minus 109 minus 90, negative 121. Next is 1537. This 525, 530, so plus 530 minus 73, and also minus 70. It will be 1924. Next, negative 248.5. That is negative 248.5 plus 605 minus 157 minus 60. We have 139.5. Yeah, so that is how you determine the taxable income using the capital statement under the tax investigation. So that brings us to the end of this topic. Until I see you in our next the next lesson, see you then. Have good time. Thank you.
Hi student, welcome to another session of Manifested Online Classes. So in this class, I want us we continue with topic number 1, and that is accounting for asset and liabilities. And in this session, I want us we look on the subtopic accounting for leases under IFRS 16. So as far as this particular topic is concerned, we're going to look on a number of issues, or basically we're going to discuss a number of issues. One, we're going to define what is a lease. Number 2, we are going to look on the various types of leases, or various ways in terms of how leases are classified under IFRS 16. And then from there, we also look on how leases are accounted for by the various parties in a lease, because in a lease, we have a number of parties, actually 2 parties. we have the owner of the asset who is called the lessor, and then we have the other party who has been given the right to use the asset and who is called the lessee. So therefore, those are majorly some of the issues we are going to discuss as far as this particular topic is concerned. So to start with, I want us to define what is arrears, and basically when we talk about arrears, this refers now to a contract, or basically part of the contract which conveys, or basically which gives the right to use an asset to another person for a specific period of time in return of some consideration or in payment of a consideration which is known as the minimum lease rental. So therefore, it is that particular contract whereby one of the party will be given now the right to do what? To use the asset for a specific period of time in return of some periodical what? Payment. So therefore here we can say that arrears is a contract Yes, so therefore in this case we are saying that when talk about arrears, basically we are saying that this is a contract or basically part of the contract that conveys or basically that gives the right to use an asset for a specific period of time in return of some periodical payment in some or in return of some periodical payment which is known as the minimum lease rental. So therefore, it is basically that particular contract whereby the owner of the asset will be able to give the right to another person to use an asset for a given period of time in return of some periodical what? Payment. And basically we are saying that those periodical payments, we refer to them as the minimum lease rentals. In very simple terms, when talk about the minimum lease rentals, we are talking of the rent now which is supposed to be paid to the person who has been conferred or basically who has been given the right to do what? To use an asset for a specific period of time. And therefore, it is important to note that in a lease contract, basically we have two parties. We have two parties. We have the owner of the asset, who in other terms we refer to as the lessor, and then we have now the person who has been given or who has been conferred the right now to use what? The right to use an asset. Therefore, we can say here that in a lease, we have two parties. So we can say that there are two parties. There are two parties involved in this contract. And those two parties include who? Number one, we have the person who owns the asset, the owner of the asset. And basically the owner of the asset, we refer to this as the lessor. And then number two, we have the person who has been conferred or basically given the right to use an asset, and basically that particular person is called the lessee. So therefore, the owner of the asset is called the lessor, and basically this is a person who will have conferred, who will have given the right to use an asset to another person who is called the lessee. Now, in this particular case, we have various ways in terms of how leases are classified. In accordance with this particular standard here, that is IFRS what? IFRS 16. So number one, we have something called a finance lease. Number two, we have something called an operating lease. And then we have something called a short-term what? A short-term lease. So therefore, we can look on the types of leases, or basically the various ways in terms of how leases are classified, types of leases. Number one, we have what we refer to as a finance lease. Some books refer to this as a capital lease, And number two, we have what we refer as an operating lease, And then number three, we have what we refer as the short term. What? So therefore, leases are classified into those three what? Categories. Now, first of all, when talk about a finance or basically a capital lease, we say that these are particular lease which transfers substantially all the risk and rewards associated with the asset to the person who is called the lessee, to the person who is called the lessee. So therefore, that particular risk there, the risk and also the reward associated with the asset will be transferred to the person who is called the lessee. So therefore, we can say that a finance risk, which is also known as a capital risk, known as a capital risk, we are saying that this is a risk, this is a risk which substantially transfers all the risks and rewards associated with the asset to the lessee, So meaning that this particular type of the risk here will transfer all the risk and rewards associated with the asset to the person who has leased the asset. Basically, what that means is that if, for example, you lease an asset from the owner, any benefit or basically any reward which is associated with that particular building, for example, the rent which is being generated by that particular building will have now to be collected by you as the lessee. And number two, the risk associated with that particular building will also be transferred to you. It basically means that you have the responsibility to ensure that particular building, because if something happened to that particular building, like the building is damaged and something like that, then you have the responsibility to do what? To repair that particular building. So that's why we are saying you have the responsibility to ensure that the building is actually what? Is actually insured. So that in this case, we say that the risk and also the rewards associated with the asset are transferred now to the person who is called the lessee. So number two, we have the other type of the risk, and that is operating risk. Operating risk. So when talk about an operating risk, this is actually defined to be any other risk. This is defined to be any other risk other than finance what it is. In other terms, what that means that under finance, or basically under the capital risk, the reward and also the risk which are associated with the asset are not transferred to the lessee. So therefore, we can say that this is any other risk Yes, so therefore, in this case, we are saying that this is any other risk other than what? The finance, or basically the capital what? Risk. And therefore, in this case, we have said that the risk and also the rewards which are associated with the asset are not transferred now to the person who is called the lessee. And then from there, we have the last type of the risk, which is called the short-term risk. The short-term risk. When talk about the short-term risk, this refers to any risk whose risk term basically do not exceed 1 year or do not exceed 12 months. When talk about the term of the risk, we are talking of the period of time when the lessee has been given the right to use the asset. So mean that if you lease an asset from the owner and the agreement is that you should use that asset for a period of time which does not exceed 1 year or basically 12 months, then we refer to that as what? As a short-term what? Risk. So therefore, you can say that this is a risk whose risk term does not exceed 1 year. Does not exceed what? 1 year, or basically does not exceed what? 12 months. But the two main classification of risks under this particular standard here, that is IFRS 16, is what referred as a finance risk, or and also what referred as operating what? Risk. So mean that for accounting purpose, the two main ways in terms of how risks are classified is the capital, or basically what? The finance what? Risk. So therefore, that is the first thing you need to know. You need to know what is a risk, which you have said is basically that particular contract whereby the owner of the asset will be able to confer, will be able to give the right to use an asset to a person who is called the lessee, and basically the lessee is supposed to pay some periodical payment which we have referred to as what? The minimum lease rentals. Equally, we have said in a lease contract, we have two parties. We have the owner of the asset, who is called the lessor, and then we have the person who has been conferred the right to use the asset, who is called the lessee. And then in this case, equally, we have said that leases are basically classified in three main categories. So actually, we have said we have two main categories: a finance lease, and then from there we have the operating lease. Then from there, I want us to look on how leases are accounted for by the person who is called the lessee. So by the person who is called the lessee, so we can look on what we refer as accounting for leases. Accounting for leases by the lessee. By the lessee. So first of all, who is the lessee? The lessee in this case, we have said, is that particular party, is that particular person who has been conferred the right to do what? To use the asset for a specific period of time, and then he is supposed to do what? To pay some periodical payment. Now, one of the important points to note here, as far as accounting for leases by the lessee is concerned, is that the lessee, in accordance with IFRS 16, should not classify the lease as an operating lease or a finance lease. So basically what that means, that classification of the lease as an operating or finance lease, it only applies to the owner of the asset. The owner of the asset is who? Is the lessor. So therefore, that is the first important point, that the lessee should not classify the lease, a lease contract as an operating or the finance lease. The finance what? It is, and basically I've said that this is a requirement of IFRS 16. It is also important maybe to note at this point that IFRS 16 is basically a new standard which was issued to replace the old standard on leases. The old standard on leases was IS 17, International Accounting Standard number 17, and that particular standard had given the lessee the option to classify the lease as an operating or basically what? Finance lease. And therefore, what most of the companies were doing after leasing asset, most of the company were accounting for those particular leases as operating leases. So what that means is that most of the companies were avoiding showing liabilities in their books of accounts by accounting for the leases as what? As the finance leases. Because once a company leases an asset for a long period of time, the company should be able to show the liability which will be in form of the lease rentals to be paid over the lease term. But what I'm saying is that at the IS 17, most of the companies were avoiding that, showing liabilities in their balance sheet, and therefore they were classifying for all leases as operating what? Leases, whereby companies were only accounting for the lease rentals which was paid in a certain financial year as an expense. But now, this particular standard here, IFRS 16, considered that as a limitation associated with IS 17, and basically now IFRS 16 prohibit now the lessee from classifying the lease as an operating or what? A finance lease. And therefore, once a company or basically an entity leases an asset, what that particular entity should recognize in its books of account are two items. Are two what? Items. Number one, we have something called the lease liability, and number two, we have something called the right of use what? Asset. So therefore, we can say that on initial recognition, the lessee should recognize, or basically record number one, right of use asset, and number two, something called the lease liability. something called there is what? Liability. So these are the two items which now the lessee is expected to initially record in his books of account once now the lessee has leased an asset. Has leased what? An asset. Therefore, in this particular case, what we are going to look, we are going to, or basically we are going to cover, we are going to look on how we determine these two items. How do we determine the right of use asset? And number two, how do we determine there is what? Liability. So I think we can start by looking on how we determine what we refer as the risk liability. Risk liability. Risk liability. So the risk liability, essentially, this represents the present value of the minimum lease rentals which now the lessee is expected to pay. So basically what that means is that if, for example, you lease an asset and you lease that asset for the next 5 years, then there is the minimum lease rentals you should be paying annually. Remember, in this case, you have said the minimum lease rentals is the rent to be paid on annual what? Basis. So therefore, for you to be able to determine the lease liability, what you do, you have to discount, or basically you have to get the present value of the minimum lease rentals you are going to pay over the lease what? Term. And therefore, in this case, we can say that the lease liability, this is equal to present value of minimum lease rentals, not paid at the inception date, of the lease, inception date of the lease, discounted using the interest rate implicit in the lease. Interest rate implicit in the lease. Implicit in what? In the lease. So therefore, for us to be able to determine the lease liability, what we do is that we get the present value of the minimum lease rentals, which is not paid at the inception date of the lease. So basically what that means that in getting that particular present value of the minimum lease rentals, we do not take into account, we do not include any minimum lease rentals which is paid at the inception date of the lease. Like maybe we take a small illustration here. We are told that a company leased an asset, and that company is supposed to pay a minimum lease rentals. Remember, in this case, we have said that when we talk about the minimum lease rentals, we are talking of the rent now to be paid by the company on annual what? Basis. So we assume that that company is supposed to pay maybe an amount of 100,000, and you are told that this particular rent is payable in advance. Is payable in what? In advance. So being payable in advance, that means that the rent for each financial year is supposed to be paid at the start of each year. At the start of what? Each year. And also we assume that we are told that the lease term, so in this case when we talk about the lease term, basically we are talking of the period of the lease. The lease term maybe we are told are 4 years. Are 4 years. Also, in this case, the examiner will have given you something called the interest rate implicit in the lease. So when we talk about the interest rate implicit in the lease, this is the rate now which you should use for discounting purpose, because in discounting, in getting the present value, you must be having an R. So R is now what? The interest rate implicit in what? In the lease. So let's assume that we are told that the interest rate implicit in the lease, maybe is 10%. Is 10 what? Is 10%. Now, in this case, how do we determine the lease liability? How do we determine the lease liability? So we are saying the lease liability will be equal to the present value of the minimum lease rentals not paid at the inception date of the lease. In this case, when we talk about the inception date of the lease, we are talking of the date when the lease commenced. We are talking of the date when the lease commenced. So in this case, maybe we can have a schedule here, a certain schedule. So we are saying our lease here is for how many years? for 4 years. So this will be year 1, year 2, year 3, year 4. So how much rent is supposed to be paid annually? So we know that the rent to be paid annually here is 100,000, and basically you say that this should be paid at the start of each year. So what that means is that the first rent will be paid at the start of year 1. Basically, the start of year 1, we refer to that as time 0. The other rent will be paid at the start of year 2. The other rent will be paid at the start of year 3. And the other rent now will be paid at the start of year what? Year 4. So to determine the lease liability here, we are saying that this will be equal to the present value of the minimum lease rentals not paid at the inception date. So not paid at the inception date. So in this case, when we talk about the lease, minimum lease rentals not paid at the inception date of the lease, we are talking of the rent now which was paid at the start of year 2, at the start of year 3, at the start of year 4, because this particular amount here was paid at the inception date. At the inception what? Date. So therefore, let's determine the lease liability, which will be equal to 100,000, which is now the minimum lease rentals. And then what we need to do, we need to discount that. So how do we discount this? We discount this by multiplying that with the present value, interest factor of annuity, at which rate? So this 10% will be our R at the rate of 10%. And then in this case, we are discounting the rent which was paid at the start of year 2, at the start of year 3, and also at the start of year 4. So therefore here, we consider rent for how many periods? 3 periods. Or basically, yes, 3 periods. So therefore, here our N will not be 4, but rather our N will be what? Will be 3 years. Because in this case, we are saying this particular lease rentals which was paid at the inception date of the lease does not form part of the liability. So therefore, we take 100,000, and how do we compute that? To compute this, there is a formula which we apply here. We take what? We take 1 minus 1 plus R. Our R in this case is 10%, so this will be 1.1 raised to power negative 3. And then we divide that with R, which is 0.1. So whatever we get here, this is now what we refer as the liability. There is what? Liability. So therefore, it is important here to note that there is liability. Basically, this is the present value of the minimum lease rentals, which is not paid at the inception date of the lease, because the amount which has already been paid at the inception date of the lease, that does not form part of the liability. So, and then we discount that using what we refer as a interest rate implicit in what? In the lease. And then once we have determined that particular lease liability, then what we should do, we should be able to amortize that. We should be able to do what? To amortize that, because now whatever you are going to get here as the lease liability, it basically represent the present value of what now the lessee is expected to pay over the lease term. So basically what that means that at the end of the lease, then the lease liability should be what? Should be 0. But we are going to look on how we do that particular amortization, specifically when looking on an illustration what? A question. So then from there, we can proceed and look on how do we determine the other items there. Remember, in our case here, we have looked on how we determine the lease liability. So next, I want us we look on how we measure, how we determine the value of what? Of the right of use asset. So let's look on how we determine that. That is the right of use asset. So we have right of use asset, right of use, abbreviated as ROU, right of use asset, right of use asset. So to determine this, basically we add like 3 items. We add 3 items. One, we take the present value of the present value of what we refer as the minimum lease rentals, present value of minimum lease rentals at inception date of the lease, inception date of the lease, and then now to this we add payment. So to that we add what? The payment made before all at the inception date of the lease. So when we talk about this payment made before or at the inception date of the lease, we are talking of any rent which was paid at the date when the lease commenced. For example, from this particular small illustration which I've given you here, so this particular amount of 100,000, this is a payment which was made at the inception date of the lease. So take into account that. And then to this we also add any initial direct cost, initial direct cost, e.g. what we refer as the legal cost. The legal cost. So in this case, when we talk about the legal cost, anytime as a company or as an entity you lease an asset from the owner, then you must have a lease agreement drafted by you, or basically you must enter into a lease what? Agreement. So that particular lease agreement will be drafted by a lawyer who definitely will have to charge you a fee. So that particular fee which will be charged by your lawyer, we refer to it as what? As a legal cost, which is basically an initial direct cost which is associated with what? With the lease. So therefore what we do, we add all this, and basically whatever you get here is the amount for initial recognition of what we refer as the right of use what? Asset. And then once this particular value has been determined there for the right of use asset, then subsequently it must be depreciated on a straight line what? Basis. So therefore you can say that the right of use asset must then be depreciated, Yes, so basically what you're saying is that this right of use asset must then be depreciated at the shorter of two period. At the shorter of two period, one what we refer as the lease term, and what we refer as the economic life of the asset. So like assuming you are told that the lease term, or basically the term of the lease, 4 years, and then you are told that the economic life of the asset are 5 years, So therefore, you depreciate this right of use asset at the shorter of these two periods. You take the period which is shorter out of the two periods. So in our case, the period which is shorter, 4 years. So what you do, you take the value you have determined here, and then you divide that with 4 years. Whatever you are going to get now is the depreciation per what? Per annum, of which that particular depreciation should be recognized by the receipt here in the income statement as what? As an expense. As what? As an expense. So therefore, it is important to note that according to this particular standard here, IFRS 16, it prohibits the receipt from classifying the lease as a finance or an operating lease. This standard requires that at the inception date of the lease, once an entity or basically a company leases an asset from the owner, that company should recognize two items in the books of account. One is what we refer as the lease liability, which you have said is equal to the present value of the minimum lease rentals not paid at the inception date of the lease. And then we have said that that lease liability should be amortized over the lease term. And two, the lessee should be able to recognize something called what? The right of use what? Asset. The right of use asset is basically determined by adding these three items: the present value of the minimum lease rentals at the inception date of the lease, plus any payment made before all at the inception date of the lease, plus any initial direct cost associated with the lease. And then you have said that that right of use asset should be depreciated at the shorter of two period. That is now the lease term and also the economic life of what? Of the asset. But in this case, we have two exemptions, or basically two instances or two circumstances whereby the lessee is exempted from recognizing those two items in his books of account. So mean that at a number of circumstances, the lessee is not required to recognize the right of use asset in his books of account, and what he refers there is what? Liability. Risk liability. So which are those exemptions? Which are those exemptions? Exceptions. So basically we refer to them as exemptions or exceptions from complying with IFRS 16 as far as accounting for leases by the lessee is what is concerned. One of the exception is in case of what refers the short-term risk. The short-term risk. Remember, we defined what is a short-term risk, and we say that these are risks whose risk term does not exceed 1 year or does not exceed what? 12 months. So whenever a company leases an asset and the company has leased that particular asset for a period which is less than 1 year, that company do not necessarily need to recognize the right of use asset and also the risk liability in its books of account. So such a company will just account for the rent which was paid as an expense in the income what? Statement. Number two, or the other exception, is in case of what refers as arrears of an asset, arrears of an asset of low value, of low what? Value. And a good example of this is arrears of a personal computer. Arrears of a personal computer. So if a company leases such an asset, e.g. a personal computer or even a laptop, which is of low value, that company do not need to recognize the right of use asset and what? The risk liability, but the company will just need to recognize the amount which is being paid as a result of having leased that particular what? Asset as an expense, as an ordinary what? Expense. So therefore, those are the two exemptions, or basically the two instances, two circumstances whereby the lessee is not required to fully comply with the requirement of IFRS what? 16 as far as the accounting for leases are what? Are concerned. So therefore, that what you need to know as far as the accounting for leases by the lessee is concerned. I want us we take a short break, and then once we come back in our next class, I want us we look on an illustration regarding accounting for leases by the lessee. And then once we do that particular illustration, we are going to proceed and look on how we account for leases by the other party, and that is the owner of the asset or the lessor. So therefore, we take a short break, and then we meet in our next class. Hi there. So welcome back to Manifested Online Classes. So in this session, I want us to look on an illustration question regarding accounting for leases by the lessee. And recall what you have said in our previous session, that the lessee is supposed to recognize two items in his books of account: the right of use asset and the risk what? Liability. So I want us to look on an illustration question here. We look on how we determine those two items: right of use asset and the risk liability. So the question reads, or the illustration reads, on 1st of January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for 3 years period. The terms of the lease were that Breakwood Limited was to pay shillings 500,000 each year, with the payment commencing on the 31st of December 2019. Initial direct costs incurred in the lease amounted to 30,000 and were paid by Breakwood Limited. The plant and equipment had a remaining economic usufruct for 5 years at the inception date of the lease. The lease contract did not contain any purchase option for the lessee. And then you're told Breakwood Limited can borrow at an interest rate of 10% per annum. So we are required to analyze the accounting treatment of the above lease transaction from the inception for 3 years period of and there is what? A contract. So basically, what you're told in this particular illustration here is that the company which is called Breakwood Limited leased an asset. So what that means, that Breakwood Limited is the lessee, is the company which has been conferred, is the company which has been given the right to do what? To use an asset for a given period of time. And I think in this case we are told that this company was given the right to use the asset for a period of 3 years, from 1st of January 2019 to or basically up to the end of the third year. So what you have said is that once a company releases an asset at the inception date of the lease, or when the lease commences, such a company should recognize two items. Something we have referred to as the lease liability, and number two, what we have referred to as the right of what? Use asset. So therefore, let's determine those two items. And we are going to start by determining the lease liability. And that is on 1st of January 2019. 1st January 2019, this is the inception date of the lease. And you have said that this is equal to the present value of the lease, or the minimum lease rentals, present value of minimum lease rentals not paid at inception date of the lease, So for us to be able to compute this, we have to understand what you're told in that particular question there, that this particular lease commenced on 1st of January 2019. So 1st January 2019, this is the inception date of the lease. It is the date when the lease commenced. So, and you're told the lease is for 3 years. The first year will end on 31st of December 2019, 31st of December 2020, and 31st of December 2021. 31st of December 2021. And we are told that the rent which is payable, the minimum lease rentals which is payable, is an amount of 500,000, and we are told that the first rent will be paid on 31st of December 2019. What that means is that this minimum lease rentals is payable at the end of each year. Payable at the end of each what? Year. It means that the other minimum lease rentals, or the other rent, will be paid at the end of year 2, and the other one will be paid at the end of what? Year 3. At the end of what? Year 3. So therefore, how do we determine the lease liability? We determine the lease liability by getting the present value of the minimum lease rentals not paid at the inception date of the lease. So in our case here, the minimum lease rentals which has not been paid on this date include this amount, that, and what? That. So therefore, the lease liability is equal to the minimum lease rentals, which is an amount of 500,000, and basically this is like an annuity, is a series of payment. We need to multiply that with the present value, interest factor of annuity, at which rate? At the rate which you are given there. In the last paragraph of that question, you are told that this company, which is Breakwood Limited, can borrow at the rate of 10%. That's what you are going to use for discounting purpose, and basically for period of 3 years. So we multiply that with the present value interest factor of annuity at 10% for what? For 3 years. So therefore, we have 500,000. So we need to get the formula for getting this, where we take 1 minus 1 plus R. Our R in this case is 10%. So this will be 1.1 raised to power n. Our n is what? 3. And then we divide that with what? With R, which is 0.1. So basically this is a formula which we use in terms of getting the present value, interest factor of annuity. So we take what? 1 minus 1 plus what? Plus R raised to power negative n, and then we divide that with what? With R. So that is now what we are using what? Here. So therefore, let's get that lease liability at the inception date of what? At the inception date of the lease. So let first of all we compute this, and we take 1.1, we raise that to negative 3, and then we deduct that from 1, and then we divide that with 0.1, and then times 500,000, and that will give us a figure of what? That will give us a figure of shillings 1,243,243 for 426 to the nearest what? Whole number. So this is now the lease liability at the inception date of the lease. And then what I've said is that once we have determined this particular lease liability, what we need to do is to amortize it. To amortize a liability is to gradually write off the liability, because now this represent the amount of money which now the lessee, that is Breakwood Limited, is expected to pay over the lease what term. So therefore, what we need to do before we determine the right of use asset, let's amortize this particular what liability. So we amortize that liability by preparing something called the lease amortization what schedule. So we need to prepare something called a lease amortization schedule. A lease amortization schedule. Lease amortization schedule. So how do we prepare this schedule? We always start with the years which are ending on 31st of December. So and basically we know that the first year was supposed to end on 31st of December 2019, and then the other column here will be for the lease liability. Lease liability at the start of the year, that is balance brought down. Then the next column which follows here always depend with when the rent is payable. If the rent is payable at the start, the next column should be for the rent paid. If the rent is payable at the end of the year, the next column here should be for the interest. So mean that because our rent here is payable at the end of the year, our next column here should be for the interest. And basically this interest we computed based on the rate of 10%, based on the rate of 10%. And then the other column here should be for the lease rentals paid, or in other terms you can just refer to this as cash paid. Cash what? Cash paid, which now represent the rent paid at the end of each year. And finally we have the lease liability. The lease liability at the end of what? At the end of the year. So that's how we prepare our amortization schedule. Our amortization schedule. So in our case, we have said the first year ended on 31st December 2019. The other year ended on 31st of December 2020. And the other year ended on 31st of December 2021. So what is the lease liability at the start of year one? So the lease liability at the start of year one is what you have determined there. The amount of 1243 426. So then we compute the interest, which will be 10% of this. 10% of this will be 43 or 343. And then we know that at the end of year one, how much cash, or basically how much rent was paid. So at the end of year one, the rent which was paid was 500,000. Was 500 what? 1,000. So how do we get then the lease liability at the end of year one? To get the lease liability at the end of year one, we take the lease liability at the start of the year plus the interest, and then we less cash which was paid. So that will give us the lease liability at the end of what? At the end of year one. So we take 1243, 426 plus 124, 343, and then we less 500,000. And that will give us now a lease liability of what? Will give us a lease liability here of 867 769. So we can confirm whether that is correct. We take 1,243,426 plus the interest 124,343 minus what was paid, which is 500,000. Yes, that will give us 867 867 769, which now will be the lease liability at the end of year 1, and equally that now will be the lease liability at the start of year 2. So we compute interest being 10% of that, which will give us 86 777, and then the cash which was still paid in that year was how much? Was 500,000. So let's work out the lease liability at the end of year 2. So we have 867 769 plus the interest, which is 86 777 minus 500,000, and that will give us a figure of 454 546, and then that now with the will be the lease liability at the start of year 3, 454 546, and then we get 10% of that, which now will be our interest, which will be 455 455, and then we list now what was paid. So what was paid at the end of year 3 is what we have there. So and then we get now the lease liability at the end of year 3. So which will be 454 546 plus 45 455 minus 500,000, and basically that now will give us what? 0. It will give us what? 0. So that's how we prepare what we refer as the lease amortization schedule. The lease amortization schedule, of which the objective, the purpose of preparing that lease amortization schedule is for us to be able to amortize this particular word, lease liability. And what now the lessee should account for in his financial statement is that this particular lease, or basically this interest which we have here, this one is accounted for as an expense in the income statement of the lessee, is an expense in the income statement of the lessee, and then this particular lease liability is or is basically a liability. Is what? Is a liability in the statement of financial possession. This one is recognized as a liability, in the statement of financial possession of who? In the statement of financial possession of the lessee, So then next what we need to do is to determine the other item, and the other item we need to determine here is what? Is the right of use asset. The right of use what? Asset. Right of use asset. Right of use assets, and we need to determine the right of use asset at the inception date of the lease, which is the 1st of January 2019. 1st of January 2019. Remember, we have said that we determine fees by adding 3 items. One, the lease liability at the inception date of the lease. Remember, you have already determined the lease liability at the inception date of the lease. To that, we add any payment which was made before or at the commencement date of the lease, plus also we add what we refer as any initial direct cost associated with the lease. So therefore, what we do here, we take the lease liability at the inception date of the lease, that is on 1st of January 2019, and we already have that figure here, which is 12 43 426, and then to this we add payment made at or before the commencement date of the lease. Commencement date of the lease. So if you check on this particular schedule which we have here, you'll be able to see that we don't have any payment which was made here. No payment which was made before or at the commencement date of the lease. But if this this minimum lease rentals was payable at the start of the year, then the amount now which would have been paid at the inception date of the lease, or basically before the commencement date of the lease, would be now the rent which was paid at the start of or at the commencement date of the lease. So therefore, in our case here, we don't have any payment which was made before or at the commencement date of the lease. And then to this we add the initial direct cost. So this is any cost which was incurred at the commencement date of the lease. If you go back to the question here, to our illustration, in paragraph number 2, we are told the initial direct costs incurred on the lease amounted to 30,000 and were paid for by Breakwood Limited. So in our case here, we have some initial direct costs which were incurred on the commencement date of the lease and which amounted to how much? Which amounted to 30,000. So we add it there. So whatever you get here, we refer to that as the right of use asset. The right of use what? Asset. So let's add these two figures, which will give us 1273, 426. 426. That is now the right of use asset at the commencement date of the lease. Then what you have said is that this particular right of use asset then should be depreciated at the shorter of two periods. At the shorter of two what? Periods. So this one should be depreciated. Right of use asset should be depreciated at shorter law of number one, the lease term. So in this case, when talk about the lease term, we are talking of the period of the lease. So in our case, we know this lease is for what? For 3 years, or Roman 2, economic life of the asset. Economic life of asset. So are we given the economic life of the asset in this particular question here? Yes. So we are given the economic life of the asset in paragraph 2, sentence 2, where we are told the plant and equipment had a remaining economic useful life of how many years? 5 years. So we are given the economic life of the asset, which are 5 years. So therefore, what we need to do is to depreciate now this particular right of use asset at the shorter of those two periods. So which period is shorter? The period which is shorter is the lease term, which are 3 years. So therefore, to determine the depreciation per annum, per annum of this right of use asset, we take the amount for initial recognition, which is 1273, 426, and then we divide that with 3 years. That will give us now the amount to be recognized as depreciation in each of those 3 years. So 1273, 426, divide that with 3, and that will give us annual depreciation of 425. So that is now the amount to be recognized as what? As an expense, or basically as depreciation in each of those 3 years, And then this particular right of use asset, in each year, it should be depreciated at that particular amount. Amount. So therefore, that is basically what the examiner here was requiring. You illustrate how this particular lease will be accounted for that particular period of 3 years. So what you are supposed to do there is to remember that the lessee, the company which has leased this particular asset, will recognize 2 items: the lease liability, and we have looked on how we determine that, and then which you have said should be amortized over the term of the lease. And 2, the lessee, that is Breakwood Limited, will also recognize what you have referred to as the right of what? Use asset, and then that right of use asset should be depreciated over the term of the lease, or basically at the shorter of those two what? Period, the lease term, and also what? The economic life of the asset. So that what is required as far as that particular illustration is concerned. So that brings us now to the end of how the leases are accounted for by the lessee. So we take a short break, and then once we come back, I want us to look on how how the leases are accounted for by the owner of the asset, or basically the person who is called the lessor. So we take a short break, and then see you in the next class. Hi student, welcome back to Manifested online classes. So in this session, I want us to continue with the risk accounting, and specifically I want us to look on how risks are accounted for by the RESA. So remember in our previous classes, we have already looked on how risks are accounted for by the RESI, and equally we have looked on an illustration as far as that is concerned. So in this session, I want us to look on how the risks are accounted for by the owner of the asset, or basically the person who is called the RESA. Now, according to IFRS 16, the RESA, the owner of the asset, should basically determine whether the risk is an operating risk or a finance what? Risk. So mean that the owner of the asset, the RESA, is permitted to classify a risk as a finance or an operating risk. Remember what we said as far as risk accounting by the RESI is concerned. We say that the RESI is totally prohibited from classifying the asset, from classifying the risk as an operating or a finance what? Risk. But the owner of the asset, or basically the RESA, should be able to determine whether the risk is actually what? A finance or an operating what? Risk. And we are going to look on some of the criteria which may be used by the owner of the asset in terms of determining whether the risk is what? Is an operating or a finance what? Risk. But first of all, here we can say that the RESA, you have to record that this is the owner of the asset. Owner of the asset should determine. Yes, so in this case we are saying that the owner of the asset here should determine whether the risk is an operating or a finance what? Or a finance risk. Now in this case, whenever the RESI, or basically the owner of the asset, is doing that, is determining whether the risk is an operating or a finance risk, there are a number of criteria which are used in terms of doing that. So therefore you can say that IFRS 16 gives the situations which can make a risk. So therefore, IFRS 16 here gives a number of situations which can make a risk now to be classified as a finance what? A risk. Now, which are those situations which can make a risk to be classified as a finance risk and not an operating risk? One of it is what we refer as a transfer of ownership. Transfer of ownership. Basically, what this means is that if the ownership of the asset, or in other terms, the legal title of the asset, will be transferred from the owner, that is now the RESA, to the person who is called the RESI, that risk should always be classified as what? As a finance risk. But on the other hand, if the ownership of the asset, if the legal title will not be transferred from the owner of the asset or the RESA to the RESI, then that should be classified as an operating what? Risk. So that is one of the criteria which may be used in terms of determining whether the risk is an operating or what? Finance. Number two is something called the option to purchase, option to purchase, or option to buy. Option to purchase or option to buy. What this means is that if the RESI, the person who has leased the asset, has been given the option to buy or to purchase the asset at the end of the lease, then that lease always should be classified as a finance risk. But if the RESI has not been given that particular option to buy the asset at the end of the lease, then always that is an operating what? An operating risk. So the other situation or the other criteria which may be used in terms of classifying the risk as a finance or operating risk is that a risk is basically said to be a finance risk if the risk term is for a major part of economic life of an asset, So basically what that means is that if the risk term, remember when talk about the risk term, we are talking of the period of the risk, the period the risk will take place, or basically the period within which now the lessee is supposed now to do what? To use the asset. So if that particular lease term is for a major part of the economic life of the asset, then that should be classified as a finance what? It is. And actually in this case, we say that the lease is for a major part of the economic life of the asset if the lease term is 75% or more, 75% or more of the economic life of the asset. For instance, let's assume that the lessee has leased an asset for a period of like 8 years. So mean that the lease term in this case are 8 years, and then we are told that the economic life of the asset, in this case are 10 years, So what we do in this case, we take now the lease term which are 8 years, then express that as a percentage of the economic life of the asset. The economic life of the asset in our case here are 10 years, and then multiply that with 100. So in this case, we are going to get 80%. So because you have gotten 80%, which is more than 75%, then we say that the lease term, which is a period of 8 years, is for a major part of the economic life of the asset. If that is the case, then that lease is classified as a finance what? Lease. But if you get a percentage here which is less than 75%, then that should be classified as a finance what? Lease. Now, the other situation which can make a lease to be classified as a finance lease, number 4 here, number 4 is if the present value of the minimum lease rentals, at inception date of the lease, So therefore, the other situation which will make a lease to be classified as a finance lease is whereby the present value of the minimum lease rentals at the inception date, at the commencement date of the lease, is equal to the fair value of the leased what? Asset. The fair value of the leased asset. So if the two are basically the same, present value of the minimum lease rentals and the fair value of the leased asset are the same at the inception date of the lease, that will make now the lease to be classified as what? As a finance lease. So the last situation which will make the lease to be classified as a finance lease and not an operating lease, number 5, is where the leased asset is of a specialized nature, So we say that a lease will be classified as a finance lease if the leased asset is of a specialized nature, such that it is only the lessee who can be able to use that particular asset without major what? Modification, without doing some major modification as far as the asset are what? Are concerned. So therefore, whenever now the owner of the asset, or basically the lessor, is determining whether the lease is an operating lease or basically an operating or a finance lease, these are some of the factors which now need to be considered by who? The owner of the asset, or basically the lessor. And therefore, after looking on those particular criteria, I want us to proceed and look on how these two types of leases, the finance lease and also the operating lease, are supposed to be accounted for in the books of account of who? In the books of account of the owner, or basically the lessor. So therefore, we start by looking on how operating lease is accounted for. So we can look on accounting for operating leases. So in this case, first of all, an operating or a lease will be regarded to be an operating lease if such a lease do not meet most of these particular what? Criteria. For example, the ownership of the asset will not be transferred to the lessee at the end of the lease. Number 2, the lessee has not been given the option to purchase or buy now the leased asset, and also the lease term is not for major part of the economic life of what? of the asset. So if most of these particular criteria have not been met, then that will be classified as an operating what? Risk. Now, how should an operating risk then be accounted for by the owner or basically by the lessor? So in this case, what the lessor should account for here is the rent now which is receiving from now the various lessees or from the lessee, and that rent which is being received by the owner or the lessor should be recognized as part of the other incomes in the income what? Statement. So therefore here we can say that the lessor should recognize rent received as a part of other incomes, in the income what? Statement. So that particular rent which is being received by the owner of the asset is what should be recognized as part of the other incomes in the income statement. It is also obvious that the owner of the asset here will still continue recognizing the asset in his books of account, because in this case what we said initially is that under operating risk, the risk and also the rewards associated with the asset will not be transferred to the lessee, will not be transferred to who? To the lessee. So therefore, it's also important for us to note that the lessor will recognize the risked asset in the statement of financial possession. So in this case now, the asset which has been listed will still be recognized in the statement of financial possession, simply because the risk and also the rewards associated with that particular asset have not been transferred to who? To the lessee. So therefore, in terms of how we account for the operating risk is just simple and straightforward. What the lessor will be accounting for in his books of account is the rent received, and which should be recognized as part of the other incomes in the income statement. And two, the lessor will still continue recognizing the asset in his statement of financial possession and be depreciated in the normal way. In the normal way, simply because the risk and also the rewards associated with that particular asset has not been transferred to the lessee. Then from there, let's look on how we account for the finance risk. Accounting for finance risk. So first of all, you have to remember, we have said that a finance risk is basically that particular risk which will have met most of those particular criteria. One, under this particular risk here, the ownership of the asset will be transferred to the person who is called the lessee at the end of the lease. Number two is that the lessee has been given the option or basically the right to do what? To purchase or buy the asset. And number three is that the lease term here is for a major part of the economic life of the asset. So if you express now the lease term as a percentage of the economic life of the asset, you'll get a percentage of you'll get a percentage which is more than 75% or basically 75% or more, or more. Or on the other hand, we have said that if the present value of the minimum lease rentals at the inception date of the lease is equal to the fair value of the leased asset, that will also make now that particular lease now to be classified as a finance what? Risk. You also have to remember what we said, that under the finance risk, the owner of the asset will transfer substantially all the risk and rewards associated with the asset to the person who is called the lessee. And here, because the risk and rewards associated with the asset are transferred to the person who is called the lessee, what the owner of the asset, what the lessor should do, first of all, is to recognize that particular asset in his books of what? Of account. So therefore, here we can say that the lessor Yes, so in this case, the lessor will basically, the owner of the asset will do what? Will recognize the asset in his or her books of account. To recognize, basically what that means is that that particular asset which has been leased out to the lessee will no longer be recorded or will no longer be appearing in the books of account of the lessor, meaning that the asset has been recognized. And then from there, the lessor will continue and recognize something called the net investment in the lease. The net investment in what? In the lease. So how do we determine this net investment in the lease? Net investment in the lease. So we can say the net investment in the lease, net investment in the lease, net investment in the lease. This is determined by adding two items. One, we take something called the present value of the lease payment receivable, lease payment receivable by the lessor. So in this case, if you own an asset, you have leased out that particular asset under a finance lease, automatically you'll be receiving some rent from the lessee. So get the present value of the lease payment receivable by the lessor, and then to this we add the present value of the unguaranteed residue value. Unguaranteed residue value. I'll be able to explain what we mean by the unguaranteed residue value. And whatever we get here is what referred as the net investment in what? In the lease. And this what the owner of the asset, or basically the lessor, should be able to recognize under what referred as what? A finance lease. Now, first of all, what do you mean by the unguaranteed residue value? Remember, there is something we have mentioned here, that under finance lease, always the lessee, the person who has leased the asset, will be given the option, will be given the right to buy the asset at the end of the lease. Let's assume that we have a lease here, which is for a period of 3 years. A lease for a period of 3 years, and the lessee has been given the right to buy the asset at the end of the lease, and when buying that particular asset, the two parties have agreed that the lessee will pay an amount of shillings 50,000. So this particular amount of shillings 50,000, we refer to it as a guaranteed residue amount. Guaranteed residue amount. Why do we refer to it as a guaranteed residue amount? Is because at the end of the 3rd year, when the lessee exercise the right to buy that particular asset, then he will be expected to pay an amount of how much? 50,000. So that amount which the lessee will have to pay, we refer to it as the guaranteed residue amount. Guaranteed residue amount. But now let's assume that the owner of this particular asset, that is now the lessor, expect that at the end of the lease, he will be able to sell this particular asset at a higher amount. So maybe the expectation of the owner of this particular asset is that at the end of the lease, he will be able to get another buyer who will buy that particular asset at an amount of how much? 80,000. Ordinarily, these two parties, that is the lessor and the lessee, will have agreed that if the owner of the asset, that is the lessor, can be able to get another third party who can be able to buy this particular asset at an amount which is higher than 50,000, then the owner of the asset, or basically the lessor, can go ahead and sell that particular asset to that other third party. So therefore, if the owner therefore expects that at the end of the lease he will be able to get to sell that particular asset at an amount of 80,000, now the amount which is above this 50,000, then we refer to it as unguaranteed residue amount, because the owner of the asset is not very sure that that particular third party will be able to come in and basically buy that particular asset at an amount of how much? 80,000. So therefore, in our case here, the unguaranteed residue amount from this small illustration will be 80,000, the amount which the owner of the asset expect to sell the asset at the end of the lease, minus the amount of money which the lessee will have to pay when buying that particular asset at the end of the lease. So that 30,000, we refer to it as unguaranteed residue amount. The owner of the asset is not very sure, is not assured by the lessee that he will be able to get this particular amount of what? 30,000. So therefore, in determining that particular net investment in the lease, one, we get the present value of the lease payment receivable by the lessor, that is the owner of the asset, and always this include the guaranteed residue amount, the guaranteed residue what? Amount, and then to that we add the present value of the unguaranteed residue amount. Whatever you get there is known as the net investment in the lease, and this should be recognized in the books of account of the owner of the asset, or basically the lessor, as an asset. As what? As an asset, and then from there it should be amortized over the lease term. Over the lease what? A term. So therefore, that is how the finance lease should be accounted for by the owner of the asset, or basically by the lessor, whereby we have said the lessor one, we need to recognize that particular asset in his books of account simply because he has transferred the risk and rewards associated with the asset to the person who is called the lessee, and then he recognized something called the net investment in what? In the lease. And basically that's how we determine what? The net investment in the lease. So I want us to look on an illustration as far as this is concerned. We look on how we determine this particular net investment in what? In the lease. Yes, so we look on an illustration, and the illustration reads, we go through that illustration, and it reads, a lessor, or basically the owner of the asset, entered into a 3-year leasing agreement commencing on 1st of January 2013. At the terms of the lease, the lessee commit to pay shillings 80,000 per annum commencing on 31st of December 2023, and then you're told the residue guaranteed or the residue guarantee clause require the lessee to pay shillings 40,000 at the end of the lease term if the lessor is unable to sell the asset for more than shillings 40,000. So basically what that means is that the lessee here has been given the option to buy the asset, and when buying the asset at the end of the lease, then he is expected to pay an amount of how much? Shillings 40,000. But in this case now, or the lessee will only be expected to pay this particular amount of money if now the owner of the asset, that is the lessor, cannot be able to get another person to buy the asset at a price which is higher than that. And then you're told the lessor, that is the owner of the asset, expect to sell the asset based on the current expectation for shillings 50,000 at the end of the lease. So the owner of the asset here expects that at the end of the lease, then he will be able to sell the asset at an amount of how much? 50,000. So we are told the interest rate implicit in the lease is 9.2%. Then what we are required is to show the net investment in the lease on 1st January 2013 to 31st of December 2015. 31st of December 2015 is the date when the lease is supposed to end, because in this case we are told in the first paragraph there that the lease is for a period of 3 years. So therefore, let's determine the net investment in the lease. So this now will be our solution in that particular illustration. So the first thing we need to determine here is the net investment in the lease. Net investment in the lease. Yes, so we determine the net investment in the lease at the commencement date of the lease. The commencement date of the lease in our case is 1st of January 2023. So how do we determine this? I've said to determine the net investment in the lease, basically we add 2 items. The present value of the lease payment receivable by the lessor, including the guaranteed what? Residue amount, and also the present value of what? the unguaranteed residue amount. For us to be able to compute this, maybe you can have a small summary here of what you are told in that particular question, so that you can be able to understand how we are computing this. We are told that this particular is one is for a period of 3 years. So year 1, year 2, year what? Year 3. And that lease commenced on 1st of January 2013. This is now what we refer as the inception date of the lease, the date when the lease commenced. And then you are told, under the terms of the lease, the lessee, the person who has leased that asset, commit to pay shillings 80,000 per annum commencing on 31st of December 2013. So the first rent here to be received by the owner of this asset will be received at the end of year 1, automatically the other one at the end of year 2, and the other one at the end of what? Year 3. So mean that this rent is payable at the end of each what? Year. And then you're told the a residue guarantee clause requires the lessee to pay shillings 40,000 at the end of the lease term if the lessor is unable to sell the asset for more than shillings 40,000. So basically what you're told here is that the lessee has been given the option to purchase or buy the asset at the end of the lease term, and in that case the lessee is expected to pay shillings what? 40,000 when buying that asset. This particular amount of money which is to be paid by the lessee at the end of the lease term when buying the asset, then we have referred to this as a guaranteed residue amount. Guaranteed residue amount. And then in the other paragraph, you're told the lessor expect to sell the asset based on the current expectation for shillings 50,000 at the end of the lease. So meaning that the owner of the asset, we are told, at the end of the lease expect to sell the asset at an amount of how much? Shillings 50,000. Shillings 50 what? Thousand. So why are you given this particular amount here? You are given this particular amount for you to be able to determine what we refer to as the unguaranteed residue amount. The unguaranteed residue amount in this case will be equal to what? To 50,000, the amount which the owner of the asset expect to sell the asset at the end of the lease, which is 50,000, minus the guaranteed residue amount. So in this case, we are going to get now the unguaranteed residue amount of how much? Of 10,000. So why do we refer to it as unguaranteed residue amount? Is because the owner of the asset, or basically the lessor, is not assured by the lessee of this particular amount of 10,000. Or in other terms, we say that the owner of the asset is not assured by any party that he will be able to get this particular amount of 10,000 at the end of the lease period, at the end of the lease what? Term. So having that, we can proceed and we determine this. Remember, I've said this is equal to the present value of the lease payment receivable, including the guaranteed what? Residue amount. So therefore, the first thing we need to do here is to get the present value of this lease rental, lease payment receivable. So we get the present value of the lease payment receivable by the lessee, by the lessor, that is. So first of all, let's discount this lease rental receivable, which is an amount of 80,000, and this is an annuity because it is receivable annually. So we multiply that with the present value interest factor of annuity, and the rate which we are applying here will be 9.2%, which is now the interest rate implicit in the lease. So meaning that we multiply this with the present value interest factor at the rate of 9.2 for 3 what? Years. So this will be 1 point, or basically 1 minus 1.092 raised to power negative 3. Our nth here will be 3, and then divided by R, which is 0.09 what? 2. So this now will give us the present value of the minimum lease rentals, and also to this we need to include the present value of the guaranteed residue amount. The guaranteed residue amount in this case you have said is what? 40,000. Now this 40,000 will be received at the end of the 3rd year. So therefore that is a lump sum. So how do we discount a lump sum? We take 40,000, we multiply that with the present value interest factor, which will be computed by taking 1 plus r, which is 0.92. We raise that to power negative n, which is 3, or basically negative 3. So that now will give us the present value of the lease payment receivable by the lessor, and then finally to this we add the present value of unguaranteed residue unguaranteed residue amount. In our case, we know that the unguaranteed residue amount is an amount of 10,000, which now is a lump sum, is an amount of money which the owner of the asset expects to receive at the end of the lease. So therefore, we multiply that with the present value interest factor, which is 1.092 raised to power negative 3, raised to power negative 3. So, and this now will give us the net investment in the lease at the inception date of the lease. So let's compute this. We start with this here. So we first of all compute this present value interest factor. So we have 1.09 raised to power negative 3, and then we deduct that from 1 divided by 0.092 times 80,000 times 80,000, which will give us 198, 101, 198, 101, and then we get now the present value of the guaranteed residue amount. So we have 1.09 raised to power negative 3 times 40,000, which will give us 887, and then finally we get the present value of the unguaranteed residue amount, which is 1.092 raised to power negative 3 times 10,000, so which will give us 76, 79, 76, 70 what? 9. So then what we need to do, we add all these particular figures, and then we will be able to get the net investment in the lease at the inception date of the lease. So we have 188, 101 plus 30, 887 plus 76, 79, and that will give us what? That will give us 36, 667, 7. So what is this? This now the net investment in the lease at the inception date of the lease, at the inception date of of the lease. So therefore, that's how we determine what we refer as the net investment in in the lease. And remember also what you have said is that other than the owner of the asset recognizing that net investment in the lease, he also needs to recognize that particular asset in his books of of account. So therefore, that basically what you need to know as far as accounting for leases by the owner of the asset, or basically by the lessor, is concerned. And basically that brings us to the end of that subtopic on accounting for leases.
Hey there, my name is Patrick Kamau. You are a lecturer in public finance and taxation. Welcome to today's lesson where we learn more about the taxation of the business income, and which we started sometimes back in few lessons, past lessons, where we say that we are supposed to look at the taxation of the business income, and we had 3 businesses we are supposed to look at: the sole proprietorship, partnership, and the limited company. In our previous lessons, we have covered the sole proprietorship and the partnership. So what is remaining is the taxation of the limited company, and it is the one that I want us to look at how it is usually taxed. So this is what you need to know about the limited company. That limited company is considered to be a separate legal entity from the owners, and therefore taxed on its own income at corporate tax rate. That is the first thing that you need to know, that a company is considered to be separate from the people who forms it. So when you're taxing a company, you tax the company itself. You don't tax the owners. Unlike the case of sole proprietorship, which you tax the owner, the partnership where you tax the partners, here you tax the company itself. So the following points are considered when you are taxing the company. So points considered. Considered in taxation of a limited company. There are only 2 points that you need to consider when you are taxing a company. One of them is this. One, or A, determination of the taxable income of taxable incomes. So this is determined using either number one, gross profit method, number two, net profit method. So what we are saying here is that when you are determining the taxable income of a company, you just determine it in the same way as any other business, the way we have been using it. Either gross profit method, if you have not been given net accounting profit. If you have been given the net accounting profit, then you use the net profit method. It's the same thing. Point B to consider is that taxable income of company is taxed at the following tax rate. One, resident company, %30. Number two, non-resident company, that's 7.5%. But note, so what we are saying is that when you determine the taxable income of a company, if it is a resident company, you tax it at 30% to get the tax to be paid. If it is a non-resident company, that's 7.5%, then you get the tax to be paid. But note, from 1st of January 2024, non-residents will be taxed at 30%. Yeah. So there was a change of the law on 1st of July 2023, which stated that come January 2024, the non-resident corporate tax rate will be reduced from that 7.5% to 30%. So it's good to know when you are taxing a company, which year is it rating to? Any year before 2024, that is 7.5% for non-resident only. And now beyond 2024 or 24 and beyond, then it's supposed to be, that is 30%. That is all that you need to know. Otherwise, everything else that we have been talking about taxation of a business, in terms of the method, in terms of the taxable operating income, non-taxable operating income, allowable expenses, and non-allowable expenses remain the same. So now we look at a question. This is what the question say. Zahari Processors Limited presented the following statement of profit or loss for the year ended 31st December 2022. We have the turnover, cost of sales, gross profit, other incomes, provision for foreign exchange gain, gain on sale of motor vehicle, release of liability, refund of excess duty, investment income gross, total income, less expenses, purchase of trademark, a design of company website, director's fee, donation to charitable institutions, depreciation expense, marketing expense, management and professional fees, general expenses, legal costs, loan repayment, allowance for doubtful debts, impairment loss of property, a net profit for the year. Additional information number 1. On 1st April 2022, the company acquired the following assets: factory building, warehouse, processing machinery, rolling 4 tons, drainage system, saloon car. Number 2, management and professional fee comprised development of strategic plan, tax consultancy fee, audit fee, environmental assessment fee. General expenses include installation of neon sign, car grant to a director, installation of processing machine, staff Christmas party, retrenchment costs. Number 4, legal fee comprised defense against claim for breach of trade agreement, renewal of Kenya Association of Manufacturers membership fee, negotiating a bank loan, a preparation of employment contract, drafting lease agreement 60 years. Number 5, release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due for over 4 years. So we are required compute the total taxable profit or loss for Zahari Processors Limited for the year ending 1st December 2022. So we want to get the taxable income. First thing that we need to ask ourselves, which method are we supposed to use? It's obvious that for this question we are supposed to use the net profit method because we have been given the income statement with net profit, but the key we have been given the net profit, or if we are given the net loss or net income, is the same. So we'll start. So we'll start with the net profit that has been provided to us. Which we have, note that the items have been given shillings 1,000. So we have 527, 614. And then we add non-allowable expenses. In P&L and taxable operating income, not in P&L. So, as we have been doing any question that we use the net profit method, we just need to go to the P&L, look for the non-allowable expenses there. The first expense in the P&L, purchase of trademark. Trademark is not allowable. The first expense in the P&L is trademark, which is not allowable. So we add it. Then we continue. The next one is design of company website. Website is a fixed asset which we should claim capital allowance later. It's not allowable. So we add it, which we have 12,400. The other one is director's fee. Director's fee is allowed if you look at what we had said among the allowable expense initially. Donation to charity, that's allowable, we said. Depreciation, no, that is not allowable. Depreciation, which we have that 240. After the depreciation, marketing expense. Marketing is allowable. A management and professional fee, that is also allowable, we say, because it's for the business. General expenses, they are allowable because they are for business. Legal costs, unless it is stated what it is, it's allowed, which we had already looked at the non-allowable legal cost. Loan repayment, no, that isn't allowable. Loan repayment, which you have 2,600. Then the next one is allowance for doubtful debt. Allowance for doubtful debt is not allowed. It's a provision. Unless they say specific allowance, it's not allowable. Which we have 2,250. The next one is impairment loss of property. We don't allow impairment loss. We don't. So impairment loss, which we have 1,500. Seems we are done with non-allowable expense in P&L, but we need to go to the additional information, check if there is further analysis of expense in the P&L, and if there is a part that is not allowable. At the same time, in the additional information, we look for taxable operating income not in P&L. An income that is taxable and is operating but has not been included in the P&L up here. So let's see. Additional information number 1. On 1st April 2022, the company acquired the following assets. Now, those are fixed assets. First, they are not in the P&L. If you go to the P&L expenses, they are not there. So ignore. Number 2, management and professional fee comprised. Now, that is in the P&L. We have to look for non-allowables. Higher development of strategic plan. That is an allowable expense because when you plan for your business, it's income generating, it's allowable. How about tax consultancy fee? No, anything to do with the tax we don't allow. Tax consultancy fee, which you have 208. The next one is audit fee. Audit fee is allowed. Environmental assessment fee, that is supposed to be an allowable expense. Why? It is not income generating. We said any expense that is not income generating is not allowable. So environmental assessment, which we have 256. After that, we go to number 3. General expenses include. Now, general expenses is in the P&L. When you go to the P&L, you find the general expenses there. They include installation of neon sign. Neon sign installation is a fixed asset. Expense incurred before you start using the neon sign, the fixed asset. Those we don't allow. So, we disallow. Which we have 820. The other one is car grant to a director, also not allowed because a grant to a director is a private, for private use. We don't allow. Which we have 2,800. The other one is installation of processing machine. We don't allow installation of the process. They are fixed asset. Expense incurred before you start using fixed asset. We don't allow them. Which we have 1,560. The other one is staff Christmas party. That is now allowed because we said expense for the welfare of workers. They are allowable. That's for welfare. The other one is retrenchment cost. We don't allow retrenchment cost. Expense that is not income generating. We don't allow. Retrenchment costs. Which we have 580. After that, we go to additional information number 4. Legal fee complies. Now, legal fee is an expense and it is in the P&L. We look for the non-allowable in it. Defense against breach of trade agreement. We don't allow breach of trade agreement. Breach of contract. We don't. Which we have 1450. How about renewal of Kenya Association of Manufacturers membership fee? That's a trade association. We said anything paid to a trade association is allowable. Negotiating a bank loan, no. Bank loan cost, not allowed. Which we have 1168. 68. The other one is preparation of employment contract. That is allowed. We said so. Drafting at least 60 years. We said up to 99 years this is allowed. So we are done with legal. Number 5. Release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due over 4 years. Here we said, that's an income. The income you are interested with is the one not in P&L for now. For that one, if you go to the P&L, you'll find it as one of the income in the P&L, in the income statement. So we ignore because we want the one not in P&L. Now that we are done with the addition, we come to the deduction now, less. And we list 3 items as we said. 1, non-taxable operating income. In P&L, that is 1, or in investment incomes, in P&L, and allowable expenses, not in P&L. So what we do, or we said, we start with the first 2 items, non-taxable operating income in P&L and all the investment income in the P&L. So let's go to the P&L, look for an income that is there that is not taxable or an investment income that is there. Like, the first income we have is the turnover. Turnover is a taxable income. It's a taxable. After that, there is, because it involves sales, it's sales actually or revenue, what they do. Cost of sales, that's not an income. Right now we are interested with the incomes. Non-taxable investment. Gross profit is as a result of turnover and cost of sales. Other incomes which we have, provision for foreign exchange gain. Provision is actually unrealized. If it was just in foreign exchange gain or realized, then that's taxable. But provision is unrealized. So it's not taxable. We remove provision for foreign exchange gain, which we have 84,000. We deduct. The other one is gain on sale of motor vehicle. Income from selling fixed assets we don't tax. Deduct. So gain on sale of motor vehicle. Fixed assets income we don't tax. 28,000. The next one is release of liability. What was the liability about? We were told in additional information number 5, release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due over 4 years. But that is not an operating income. So we remove. It's not an operating, it's not even an income, an operating income. So release of liability. The list of liability which you have, that's 2,000. Next, refund of excess duty. Excess duty is not an income. You are just being refunded the tax you had paid. It's not an income. So remove. Which we have 16,000. Last 3, investment income. Here we are saying that all investment income in P&L we remove. So we remove that. Investment incomes. So investment income which we have 24,000, we deduct. For now, up to this point we are done. So what remains is for us to look for allowable expense not in P&L. An expense that is allowable, but if you go to the P&L, it isn't there. If it is not in the P&L, where is it? It must be in the additional information. So let's go to the additional information and check. Number 1, on 1st April 2022, the company acquired the following assets. Well, those assets were not in the P&L, but themselves they are not allowable. What we allow in them is capital allowance or investment allowance. And there is nowhere we are told that this is the capital allowance to use. If you are not told, we said you compute yourself. So we start with, the first one is factory building. Factory building you claim at the rate of 50%. So capital allowance on factory building. In short, I'll write FB, factory building, which we said this being used for manufacturing, factory building, it is 50% of 28,800. That will be 14,400, the capital allowance. And we say that whenever you are claiming 50%, you don't consider the time. You claim for the full year, even if it is 1 day. The other rates, 25, 10, are the one that you consider time. Warehouse, that's supposed to be capital allowance at the rate of 10%. So we'll have here warehouse, which is supposed to be 10%. And then this we said we consider time from 1st April. Those are 9 months to the end of the year. So times 9 over 12 of 2800. That we will compute in a while. The other one is processing machine. Processing machine is supposed to be done at the rate of 50%. That's what we said. So we come here and say processing machine. So this is supposed to be 50% without considering time of 16,000. But we said all the expenses that are incurred before you start using a fixed asset, we add them together and we claim capital allowance together. What I'm saying is this. We had an installation of processing machine here, which we disallowed because it was relating to a fixed asset. Now, because they are the same, now we add it here, which we have 1560. And then we'll claim capital allowance on the total. All the cost incurred before using, like this installation was before use. Lorry, that is supposed to be 25%. This we consider time, 9 over 12 of 3,500. The other one is drainage system. If you look at the capital allowance, we say that should be 50%. So we'll have drainage system, which is supposed to be 50% of 2,600. For the Sarunka, we said it's 25%, and we consider time. However, we had said if a Sarunka or sport utility vehicle exceed 3 million, we only give capital allowance to 3 million. This one is already exceeding, it's 4,840,000, so we only give 3 million. So we have Sarunka. So 25% times 9 over 12 times 3. Now, those being the only fixed asset in number 1, we do the computation now. The first one is, we had already done, is 50% of 28,800. The warehouse now, 10%. And then 10% times 9 divided by 12. And then times 2,800. That gives us to 10. The other one, we add the 16,000. We add 1,560. And then we take 50%, 8,780. The other one is 25%. Times 9 divided by 12, and then times 3,500, giving us 656.25. I want us to round off to whole numbers, so we just have 656. Then the other one is 50% of 2,600, that will be 1,300. 25% of 9 over 12 times 3, which gives us 562.5. So we round off to whole numbers, 563. Yeah. So we have been looking for allowable expenses not in P&L, and we were in number 1. We found fixed assets that were not in the P&L, and so we claim capital allowance. Let's check for any other allowable expense not in P&L. Number 2, Management fee complies of the following. Now, all those one are in the P&L, including the audit fee, development of strategic plan. All those were in the P&L through management and professional fee. We said if the heading is in the P&L, ignore. 3 general expenses is in the P&L. Legal fee are in the P&L. Number 5 is not an expense, it's an income. So what did we say? We said if you have not been given capital allowance, we now come back here. Of the expenses that we have added back, if there is a fixed asset, claim capital allowance. We disallow the fixed asset, you claim capital allowance. So in this case, we had a website. Trademark does not qualify for capital allowance. It's an intangible asset. Website is supposed to be at the rate of 25%. And then the other one that we had was neon sign installation. And then the one installation of machine which we had considered there. And there was no any other. So we'll come here, website, which we have 25%. Now this we haven't been told when it was acquired or utilized from. So we take 25% of 12,400. 12,400. For the neon sign, that is supposed to be 10%. Neon sign. 10%. We haven't been told when it was started being used in the business. And here we had 820. So this will be 82. Now we do the website, which is supposed to be 25% of 12,400, which give us that 100. Yeah, that 100. Now with nothing else to deduct, because we are done with incomes in the P&L, allowable expense not in P&L, we now get net taxable operating income. So we'll start from the net profit we add, and then we minus those ones. So 527,614, and then 527,614 plus 48,800 plus 12,400 plus that 240 plus 2,600 plus 2,250 plus 1,500 plus 208 plus 256 plus 820 plus 2,800 plus 1,560 plus 580 plus 1,450 plus 1,168. Then this figure we minus the 84,000 minus 28,000 minus 32,000 minus 16,000 minus 24,000 minus 14,400 minus 210 minus 8,780 minus 656, we minus 1,300, we minus 563, and we minus 100, and then we minus 82. That gives us 394, 155. Now, we said this, because this is a company and you tax the company itself, once you get the operating income, you add taxable investment income. Investment income. We add the taxable investment income. In this question, incomes are in the income statement. There was only one investment income, the last one, a general investment income. We said if it is not indicated where an investment income is coming from, tax it. So this one is not indicated, so tax. So add investment income, which here we have been told is 24,000. And since there isn't any other, this will give us the total taxable incomes. So we take the operating plus the investment incomes, which 394, 155, and then we add 24,000. That gives us 418, 155. Now, if you go to the required, we were supposed to get what? Compute the total taxable profit or loss of Zahari Processors Limited, and it ends there. There's no other question. But sometimes you can be asked to get the tax. Unless it is indicated it's an unresident or a foreign company, we said you tax at the rate of 30% because it's considered to be a resident. So tax, if tax was required, that is if it was a requirement that we get the tax, so tax will be 30% of 418, 155,000. Now we add the zeros, the one that we had quoted here, because now we are outside of these zeros we had quoted. So we'll get 30% of 418, 155,000, which gives us 125, 446, 500. And so if you are asked to get the tax, that's what you do. So the taxation of the business ends there. And which case, in case you are told to use the gross profit method, or in case you have not been given the net accounting profit and use the gross profit method, you just have the same. You just start with the sales, cost of sales, and other income, less allowable expense. Then at the end of it, you get the taxable operating income, add the investment, and then if you are asked to get the tax, you do the same. So it's all about whether you have been given the net accounting profit or not, then you know the method that you're supposed to use. So for now, we are going to stop there until our next lesson. So kindly below this video, there is some assignment question, attempt, and then you see if you can be able to do it the way we have done it. Thank you very much.
Hello and welcome to the lesson. The subject is Introduction to Law and Governance. We continue with the topic Introduction to Corporate Governance. In our previous sessions, we defined corporate governance as the way in which corporations are controlled and managed and also directed. In our today's lesson, we will study the role of stakeholders in corporate governance. The role of stakeholders in corporate governance. Candidates, we know that organizations cannot achieve their intended objectives without involvement of various stakeholders. For a company to achieve its objectives, then it requires the input of various stakeholders like the shareholders, the management, the employees, the suppliers, the customers, the government, and so on. In our today's session, we are going to study roles of stakeholders, specifically the shareholders, the directors, and the government. We will restrict our study to three stakeholders. Number one, the shareholders. Number two, the board of directors, and the government. Let's begin with the shareholders. What is the role of shareholders in corporate governance? What is the role of shareholders in corporate governance? Now, candidates, shareholders of a company, both jointly and severally, are expected to protect, preserve, and actively exercise the supreme authority of the company in general meetings. The voice of the shareholders, as far as corporate matters are concerned, is to be expressed in the general meetings. They have a duty jointly and severally to exercise supreme authority, because shareholders are the owners of the company. Shareholders appoint the directors to run the affairs of the company on their behalf. So they have certain duties to perform in relation to corporate governance, which is said corporate governance is a way in which corporations are managed and directed. So what is the role of the shareholders in directing and managing a corporation? Number one, shareholders have a role to ensure that the directors who are appointed are persons that are competent and reliable, persons who can add value to the company when elected or appointed. So directors or the board of directors is a group of individuals who are appointed by the shareholders. So that is the first important role of the shareholders, to appoint the board of directors. And when appointing board of directors, the board should comprise of individuals who are competent and reliable. So when appointing the directors, the shareholders ought to ensure that the individuals who they are putting in office are people who will discharge their functions as required. They ensure that only competent and reliable persons are appointed. So their role is to ensure only competent and reliable persons or individuals are appointed to the board. To ensure only competent and reliable persons are appointed to the board. That is supreme authority of the shareholders, to ensure only competent. Competent means persons who have the required skills, persons who have the required experience. So when appointing these board of directors, they should be persons that have the relevant skills, relevant traits to discharge the functions of a director on a board. Now, the second role of shareholders in corporate governance is to ensure that the board of directors is constantly held accountable. To ensure that the board of directors are constantly held accountable, because they ought to account their responsibilities to the board. So the shareholders should ensure that the board of directors are constantly held accountable. They are constantly held responsible for the efficient and effective governance of the company. All right? Held accountable and responsible for the effective and efficient governance, right, of the company. Efficient corporate governance of the company. Corporate governance of the company. So the shareholders should ensure the board of directors are constantly held accountable and responsible for the efficient and effective corporate governance of the company. All right? What is the third role of shareholders in corporate governance? Is to change the composition of the board of directors that do not perform to expectation, where the shareholders have appointed a board and the board is not discharging its functions as required, then the shareholders have a role to change the composition of the board of directors, to change the composition of the board of directors, to change the composition of the board of directors that does not perform to expectation, all right? That does not perform, because when the board of directors are appointed, there are certain expectations. They have certain duties that they need to perform. They have certain responsibilities. When they do not perform to the expectation of the company or the board of directors, or to the expectation or in accordance with the mandate of the corporation, then the shareholders have a duty to ensure that they are removed from the board. Where directors are not performing or discharging their functions as they ought to discharge their functions, the shareholders have the duty to ensure that they are removed from the board, so that more competent and reliable directors are appointed. Confidentiality is another role. Confidentiality. Shareholders, candidates in a limited liability company are obligated to protect and maintain the confidentiality of company secrets. Shareholders of a company, by virtue of their position, may or will come into contact, will have access to certain information that may be considered secret, company secret. And such information should not be disclosed to third parties. And therefore, the shareholders have a role to maintain confidentiality. They are obligated to protect and maintain the confidentiality of company secrets. Now let's move on to the second stakeholder. The first stakeholder is the shareholders. The second stakeholder is the board of directors. 2, what is the role of board of directors in corporate governance? Now, the board of directors exercise all the powers of the company subject to the limitations contained in the law and the memorandum and articles of association. That means that the powers or the duties or the responsibilities of the board of directors is limited to what the law says, is limited to what is contained in the memorandum and articles of association. And therefore, one of the roles of directors in relation to corporate governance, number 1, is that they exercise leadership enterprise. Exercise leadership. Board of directors exercise leadership. They do what? They exercise leadership. They are also expected to make sound judgments in directing the corporation so as to achieve continuing prosperity and to act in the best interest of the enterprise while respecting the principles of transparency and accountability. They exercise leadership, they act, they make sound judgments, and when exercising leadership, they're supposed to exhibit high levels of integrity, because these are individuals who've been entrusted with the duty to steer the company to prosperity. So exercise leadership. The second role of board of directors in corporate governance is to ensure that through a managed and effective process, board appointments are made that provide a mix of proficient directors, each of whom is able to add value and bring independent judgment to bear on the decision of the company. Independent judgment. They have a role to bring independent judgment. The board of directors exercises its functions through board meetings. When decisions are to be made, the board sits, and therefore, the directors who sit on the board are expected to bring independent judgment, which is expected to bear on the decision-making process. Independent judgment is a judgment that should be objective. Judgment should not be biased. Judgment that is in the best interest of the company. Judgment that is free of conflict of interest. The third role of board of directors in relation to corporate governance is to determine the corporation's purpose and values. Determine the corporation's purposes and value. To determine the corporation's purpose and value, to determine the strategy to achieve its purpose, and also to implement its values in order to ensure it to ensure that it survives and thrives, and ensures that procedures and practices are in place that protect the corporation's assets and the reputation of the corporation. To determine the corporation's value, to determine the corporation's purposes, and to ensure that there is a strategy in place for implementation of the purposes and the values of the company. To monitor and do what? And implement. To monitor and implement. To monitor and evaluate the implementation of strategies. Monitor and evaluate implementation of strategies. First of all, the board envisions. The board envisions or comes up with the what we call a picture of what the company should be in future. The board determines the strategic direction of the company. The board develops strategies, and then the strategies are to be implemented by the management on day-to-day basis. So they come up with a vision of the company, where the company ought to be and all that. They come up with strategies, but the implementation is carried out by the management. And therefore, the board of directors has a role to monitor and evaluate the implementation of strategies. Okay? To do what? To monitor and evaluate the implementation of strategies, the implementation of policies, and management performance, policies and management performance. These directors are monitored by shareholders, and these directors monitor the management. So it's a very key role that the board of directors plays in corporate management, that one of evaluating the implementing of strategies, policies, and also evaluating the performance of management. Number 5, the board of directors should also ensure that the company complies with various laws to ensure compliance to various laws, regulations, and so on. Ensure that the corporation complies with all relevant laws, regulations, codes of best practices, and so on. Regulations, codes of best practice, like the one we are studying. We are studying the code of corporate governance, which is a set of guidelines on how corporations are to be managed. So the board of directors should ensure that the company complies with the laws. These are laws that are put in place by the government, the acts of parliament, the taxation laws. There are also regulations that are put in place, like authorities like the capital markets authorities, the securities exchanges, and also the codes of best practice. The board ensures compliance to such laws. The next role of directors in corporate governance is to ensure that the corporation communicates with shareholders. The corporation communicates, is to ensure the corporation communicates with stakeholders. To ensure that the corporation communicates with the stakeholders and the shareholders and stakeholders effectively. Effectively. There ought to be communication. The company is required to communicate with all the stakeholders. The government, the shareholders, the financiers, the customers, and all that. There has to be proper communication, because candidates, we know that the company cannot achieve or attain its objectives without the input of different stakeholders. Number 7, the board of directors serves the legal interests of the shareholders. That's another role of the board of directors, to serve the legal or the legitimate interest of the shareholders and the corporation, and also to account to them fully. Serves the legitimate, let me use the word legitimate, to serve the legitimate interest of the shareholders. They have a role to do what? To serve the legitimate interest of the shareholders. So these are seven roles. Let me add another one, 8. Regularly review processes and procedures. Board of directors have a role to regularly review processes and procedures. And why should the board regularly review and review processes and procedures? So that the board can ensure effectiveness of its internal systems of control, so that decision-making capability and the accuracy of its reporting and financial results are maintained at a high level at all times. So the processes and procedures of the company ought to be regularly reviewed by the board of directors. Number 9, appoint the CEO, Chief Executive Officer. It is the role of the board of directors to do what? To appoint the Chief Executive Officer of the company. And they should at least also participate in the appointment of senior management to ensure that, to ensure the motivation and protection of intellectual capital intrinsic to the corporation. Remember, candidates, corporate governance refers to the way in which an organization is managed and directed. The chief executive officer of a company plays a key role in proper management of a company. The chief executive officer is the one who is in charge of the day-to-day operations of a company. Then, if that be the case, then the board of directors should be responsible for the appointment of such an individual. Of course, you have seen here that the board of directors develops strategy, policies that the company ought to be guided with in the process of discharging its function. They develop strategies. They give strategic direction. But the day-to-day operations of the company are left in the hands of the CEO. So this CEO ought to be a person who has the required skills, the required expertise, the necessary experience in order to steer the company to the desired end. And therefore, the board of directors should appoint the chief executive officer. And we know the chief executive officer does not work as an individual. No, there's a team of management, the management team. So the board of directors should at least participate in the appointment of senior management to ensure the motivation and protection of intellectual capital that is intrinsic to the corporation. So that is appointment, but that's not enough. The board of directors should ensure that this team of managers, these senior managers, are continuously trained. They should have continuous training, continuous training, so that they discharge their functions effectively. Appointment of the CEO and the senior management. So we can go on and on, candidates, and mention roles like that are related to technology. We can say that the board of directors ensures that technology and systems used in corporations are adequate to properly run the business. All right? So that such technology can help the company to maintain what we call competitive edge. The board of directors, you can also say, that has a role in relation to risk. The board of directors have a role to identify key risk areas. Identify key risk areas. Identify key risk areas. identify the key risk areas and also the key performance indicators and key performance of the business. And the board should not just identify, but should also do what we call monitoring. They should monitor the key performance indicators of the company. Yet another role is in relation to going concern. Going what? Concern. The board of directors should ensure annually that the corporation will survive, the corporation will thrive, and the corporation will continue as a viable going concern. As what? As a viable going concern. So these are 13 roles of board of directors in corporate governance. We are going to discuss the last stakeholder, C, the government. The first role that the government plays is legislative and regulatory. Now, government through parliament makes public policy, it legislates, and also makes what we call statutory instruments. The government creates a conducive environment for business to operate. The government regulates and comes up with what we call the statutory frameworks. And the government, through the courts, also interprets and enforces the legislation that is done through the courts or the judiciary and other national enforcement agencies. So legislative and regulatory role. Government through parliament, I've said, makes legislation, makes statutory instruments. The government creates a conducive environment for business to operate, and through making regulatory and statutory frameworks, the government can also the interpretation and the enforcement of legislation is done by the courts and other national enforcement agencies like the Kenya Police and other such bodies. So legislation ensures fairness, legislation ensures a level playing field, legislation ensures transparency in business dealings, and that is very important. It's an important tenet of corporate governance. Transparency, disclosure and transparency is a key component, is a key tenet of good corporate governance. Through legislation, we know the government can, for example, determine what kind of financial records are to be published, right? We know candidates that the company law provides for the financial statements that public limited companies ought to make public, to disclose. That's a legal requirement. And transparency and disclosure, those are important tenets of good corporate governance. So the first role is legislative and regulatory. To legislate and to regulate. And by legislating and regulating, the government creates a conducive environment for business to operate. Is that clear, candidates? The second role of government in corporate governance is a monitoring role. Monitoring. Monitoring what? Monitoring. The government ensures that there is fair play in business through monitoring. How does that happen? The government oversees and monitors organizations such as the Securities Exchange Commission, the Stock Exchange, and other financial institutions. Another role that the government plays is an overall role, or what we can call an overarching role. The government provides an enabling environment within which the private sector can thrive. The government is responsible for example, for providing basic what I call basic security. The government, through the public law, maintains order. The government ensures the protection of private property. And it also has an obligation to protect the vulnerable members of the society. All right? Overarching role. Let me call it overarching role. The government has an overarching role. It provides the general basic security, it provides law, it provides order, it helps in the protection of property, and so on. The fourth important role that is played by the government is that one of solving disputes. Solving disputes, and when disputes are solved, then justice is ensured and ensures justice. And where there is justice, candidates, there is most likely to be peace. So the government helps to bring justice in corporate leaders, because you know corporate leaders who are from time to time involved in scandals. The government does what? Solves disputes among the corporate leaders, disputes between companies, disputes that may arise because of financial scandals, because of fraud. And the government can also help gather enough evidence against the corporate leaders who are involved or who are involved in scandals. The government can gather enough incriminating evidence against such individuals, and that is a very important role in corporate governance. Justice. The government does what? Ensures justice. So these are four roles that are played by the government in corporate governance. And that will mark the end of our today's lesson, where we've discussed the role of stakeholders in corporate governance. The syllabus restricted us to study the three stakeholders, that is the shareholders, the board of directors, and the government. Today we have learned that the shareholders ensure only competent and reliable persons are appointed to the board. We also learned that shareholders ensures that the board of directors are constantly held accountable and responsible for the effective and efficient corporate governance of the company. Efficient, good corporate governance of the company. The third role played by shareholders is that they help change the composition of the board that does not perform to expectation. In case there are directors who sit on the board who do not perform their duties as expected, then the shareholders have a role to remove them from the board. There is also the role in relation to confidentiality. Shareholders are under obligation to maintain information that is considered secret. The company secret should be protected by the shareholders of the company. We went ahead in this lesson to discuss the role that is played by the board of directors in corporate governance. We saw that board of directors exercise leadership, they bring independent judgment, they determine the corporation's purpose and value, they monitor and evaluate implementation of strategies, policies, and management performance. The board of directors also ensures compliance to various laws, regulations, and calls of best practice. The board of directors communicates with stakeholders efficiently. Number 7, they serve the legitimate interest of the shareholders. Number 8, they regularly review processes and procedures. They also have a role to appoint the chief executive officer. And number 10, they identify key risk areas and key performance indicators. Then there is a role in relation to going concern. We've also discussed the role that the government plays in corporate governance. The first is the legislative role and regulatory role, the monitoring role, the overarching role, and the role of solving disputes and ensures justice. The government helps to bring justice in corporate leaders who are involved in scandals. Who are done what? Who are involved in scandals. So candidates, I'll leave you with an assignment based on what we have studied today. Discuss the role of the following stakeholders in corporate governance. A, shareholders. B, board of directors. C, the government. Thank you for taking time to attend today's lesson. When answering this question, close the notes, close the video. Try and see if you can recall what you have learned in today's lesson from your memory. God bless you. Bye-bye.
Welcome, learner, to our subject of today, research, consultancy, and advisory. We are looking at underlying theories, models of research, consultancy, and advisory. And our focus today in the lesson will be on social systems theory, which falls under selected research and consultancy theories. The social systems theory has been used extensively in social sciences, and the social systems theory is also called or referred to as systems theory. This social systems theory has its conceptual origins in social systems theory and can be traced to the 19th century, to the work of a philosopher, Herbert Spencer, and Emile Durkheim. They extensively looked at social systems, and the social systems theory is the study of society as a complex arrangement of elements, including individuals and their beliefs, as they relate to the whole. That is very critical as it relates to the whole. And in terms of the whole, this refers to a country, an organization, an entity, or a corporation. And specifically when it comes to social systems, when it comes to a company, then the company as a whole is an entity or an organization. And inside that particular organization, according to the social systems theory, there are subsystems within that particular organization. And those systems, the way they relate to each other, they contribute to defining what the whole system is. And when it comes to a country, then within a country, there are systems within a country. Within a country, there are organizations, and those organizations, under the beliefs of those people within that particular country, individuals, they define what that particular country is. In the social systems theory, we are going to look at the basic assumptions of social systems theory, basic assumptions of the social systems theory. And there are 4 assumptions that underlie or underpin this theory. And the first basic assumption is that there is an underlying general order in the world. So one, there is an underlying general order in the world. So this system assumes or makes an assumption that generally there is the aspect of order when it comes to things, the way things are done in the world. And that's the first basic assumption of the social systems theory. The second assumption of the second basic assumption of the social systems theory is that social ordering is a consistent and dynamic process. Social ordering is a consistent and dynamic process. What this implies is that when it comes to any society, whichever way the society is structured, or whichever way an organization is structured, there will be dynamics in terms of how order is maintained and sustained in terms of that particular working organization or that particular entity. Then the third aspect is that, the third assumption is that all human social behavior is purposive. All human social behavior is purposive. What this underlying assumption indicates is that any kind of behavior that is exhibited by an individual in a company, in a country, or in any system, whether it is a church, mention any group, that particular social behavior that is exhibited, it's purposive, or it has a purpose. So that is the third basic underlying principle underpinning the social systems theory. Then the fourth one is that all forms of social organizations display self-responsibility. All forms of behavior reflect a form of responsibility or responsiveness. So all forms of behavior reflect a form of responsibility or a response. They display a response in terms of the characteristics. So these are the four assumptions which underlie the social systems theory. So the proponents of this theory argue that there is an underlying general order in the world. Then two, social ordering is a consistent and dynamic process. They also argue or assume or underpin that all human social behavior has a purpose, and they argue that all forms of behavior reflect a form of responsibility or a form of response. Then when it comes to the social systems theory, there are certain components of the social system theory. Components of social systems theory. There are components or the characteristics of social system theory which define what the social system is. And these components are: you have an input within the system, you have a process in the system, you have output in the system, and there is a feedback loop from output to input, and then there is the environment within which that particular system operates. So the components of a social system can be seen in a display figure It can be displayed such that you have a figure or a diagram that indicates the components of a social system. And within this particular social system, we have indicated that this social system will have input, or you can call them inputs. And these inputs as they come, you will have the inputs directed towards the process that they have to be processed within an organizational setting. So you have the processes, you can call them processes, and from processes, then you have outputs. So any system will have inputs, will have processes, and then there will be a loop. There will be a loop from outputs to inputs, which provides feedback. So from outputs, then you have feedback. So this is feedback. And when it comes to the feedback, then within that particular system, then you have the environment. And within that particular environment, there will be stakeholders. Within the environment, there will be stakeholders. And these particular stakeholders could, for example, be consumers. You have suppliers. You have, for example, government, among other members. So you have inputs, you have processes, you have outputs, you have feedback, and then you have environment within which the social system operates. And this is typical for any organization. If you are taking a company, for example, an organization that receives raw materials, these raw materials will be processed through processes. For example, if it is tea, for instance, it will be, for example, brought in as raw materials. It will undergo a process from the green leaf, maybe raw leaf and so on, to semi-processed outputs, which can now be dried. For example, tea leaves may be packaged. Then these ones are now, feedback is given to the output. And then when you have consumers, so from the outputs, the consumers will be there. Suppliers will also be interacting with this particular system and providing the inputs, like now you need energy, you need regulation by government, you need the price controls and so on. So these would form now the components of a social system that is continuously interacting with its environment to be able to provide goods, to be able to provide services within that particular working context. So the components or characteristics, components or characteristics of a system, of a social system, will include the things that will define a social system. Will include, we have indicated, one, you have the inputs. Two, you have processes. Three, you have outputs. Four, you have feedback. And then five, you have controls. Now, these controls can be brought in by, say, government. You could be an organization and you are operating maybe in the service sector, maybe tourism sector or manufacturing sector. So for you to be able to operate, there will be controls that are put in place by a government. There will be codes of ethics that are put in place by suppliers. You will also have consumers. Consumers will also have the bodies that are representing them in relation to the benefits or maybe the rights of consumers. So the system is in constant interaction with its environment. So when the feedback is provided that what has been produced is being accepted by consumers, then that particular system will basically continue working effectively. If the feedback is negative, then wherever the inputs are coming from, there'll be controls implemented to ensure that if consumers are complaining, if suppliers, for example, are not being paid, then it is important that that arrangement is made to ensure corrective measures are taken into consideration. Otherwise, if there are products being produced by a given company or by a given organization, if they don't meet the expectations of the environment, then those kind of products may not be readily acceptable in the market. So those are the components or the characteristics of a social system as envisaged in the social systems theory. And we have indicated you have inputs, you have processes, you have outputs, you have feedback, and then you have controls. So one may ask, so what are the applications of the social systems theory? Applications of the social systems theory. How can the social systems theory be applied, or of what use is the social system? Now, the way the social system has been put forward by its proponents, a social system looks at a system as being more important than the subsystems. So one, the whole is more important than the subsystem. So when it comes to operations within a given work environment or organization, it is important to note that there will be different sections within a particular system or components. But when it comes to the issue of preferences in terms of choices, what should be done, then the outputs or the processes or the components have to ensure, or the players within the system have to ensure that the players as subsystems are not more important than the whole system. So the whole system and its requirements take precedent when it comes to structuring of events and activities. It is also important to note that those making decisions should be aware that the environment within which a system operates is important. So the environment influences how organizations operate. Environments influence how organizations operate. Let us take an example. You have an organization that is in the manufacturing sector. Now, government and government agencies, for example, you have NEMA. If an organization is manufacturing, it is expected to comply to the regulations that have been set by government and its agencies like NEMA. So if that organization does not comply, then that organization may suffer consequences. So the social systems theory try to explain that as organizations operate, those organizations must be sensitive to the environment. The same thing with Kenya Bureau of Standards. So if an organization is operating, then it has to meet the quality mark. If that organization does not meet the quality mark, then that particular organization may suffer in the market, and customers may not be very confident in, or consumers may not be very confident in patronizing the products of that particular organization. So that's another area where the social systems theory underpins or informs decisions within the area of organization operations. Then it's also important to note that another area of application of the social systems theory is that organizational structures should be designed to be adaptive to changes. Organizational structures should be designed to be adaptive to changes. What is noted widely is that change is the only thing that is permanent. So as organizational structures are designed, it is important to be informed by the social systems theory that change will come. So organizational structures should be designed in terms of how they relate to different functions, with that particular understanding that when change comes, this particular structure is flexible enough, can be adaptive to the changes that are anticipated within a given working context. Then it's also important to note that another area or use of the social systems theory is that subsystems have to be aligned to support the main systems. Subsystems should be aligned. Subsystems should be aligned to support the main system. The main system. So if you have a country, we have given an example that an organization or a country could be now the main system or the main organization. So the way subsystems are designed, they should be aligned to support the main system so that the main system can be able to function and function effectively. Then it is important to ensure that the principles and concepts should be designed to be broadly applicable. Principles and concepts should be designed to be broadly applicable. So when it comes to organizational settings, if concepts or systems are designed within an organization, those systems should not be designed for just specific functions. Those systems and underlying principles within systems should be designed in such a way that because systems relate to each other, principles and concepts should be designed to ensure that they can be broadly applicable within the context of operational organizations and so on. Then it is also important to ensure that when it comes to the social systems theory, every system is bounded by space and time. Every system is bounded by space and time. Every system is bounded by space and time. So at any one given event, if the system is supposed to receive, for example, input, then that particular system that is receiving input, that input is expected to come at a particular setting. And that bounding in terms of time may affect the operations of another system. So the issue of space and time should ensure that the way the systems are working, they are properly synchronized, so that if you have the receiving point, you have the processing point, you have the output point, you have the feedback time, then those systems must be interconnected and interrelated to work effectively as the case might be. Then it is also important that to note that the social system is consistent with the systems thinking approach. The social systems thinking, social systems theory is consistent with systems thinking. Social systems theory is consistent with the systems thinking. So basically what this implies is that in any given organization, it is important that though you have subsystems, you have sections in a department, you have processes like input, processing, outputs, and others. It is important to ensure that for effectiveness of performance of organizations, there must be one approach for the whole organization. So the whole organization must look at issues holistically. Whatever decision that is being taken, the decision has to be taken in the context of the entire organization. So these are some of the areas where application of social systems theory can be able to be applied in management and other operational areas. So in our lesson today, Lana, we have looked at social systems theory as one of the selected theories in the area of research and consultancy. And we have seen that social systems theory is also called systems theory, and it was conceptualized in the 19th century, and it is attributed to philosopher Herbert Spencer and Emil Durkheim, who was a sociologist. And we have seen that the systems theory is the study of society, and it looks at society as a complex arrangement of elements that include individuals and their beliefs, what they believe in, as they relate to the whole. And we have seen that when it comes to the whole, it could be a corporation, it could be a country, it could be a county government, for example, it could be an entity like a church or maybe any other social organization. And we have gone ahead to see some of the basic assumptions of social systems theory, where we have looked at the 4 assumptions. And the assumption 1 is that there is an underlying general order in the world. That is an assumption of the social systems theory. Number 2, social ordering is a consistent and dynamic process. To put things in order, it has to be done consistently, and the process is dynamic. Number 3, the third basic assumption is that all social behavior is purposive. Any behavior that is in an organization, in a work environment, in a group, it has a purpose. Then 4, all forms of behavior reflect a form of responsibility or responsiveness. Then we have gone ahead and looked at the components of social systems theory, where we have looked at inputs, processes, outputs, and we have looked at the feedback loop. And we have also discussed that the social systems theory operates within an environment, and this environment may include stakeholders like consumers, suppliers, government and government agencies. And the components and the characteristics of a social system, we have mentioned them as inputs, processes, outputs, feedback, and controls within the system. And then we have also gone ahead, Lana, and looked at the applications of the social systems theory, where we have looked at 7 of the applications where the social system theory can be applied. And we have indicated that number 1, that the social system looks at the whole, indicates that the whole is more important than the subsystem. There will be subsystems within an organization, but when it comes to the degree of importance, then the whole should be looked at as more important and than the subsystem. Then number 2, environments influence how organizations operate, and we gave an illustration and indicated an organization in the operating in the production setting should be aware that the environment, for example, government and government agencies or suppliers or consumers may have an impact on what the organization does. Hence, it is important that organizations become sensitive to their environments. Then thirdly, organizational structures should be designed to be adaptive to change. So this social systems theory can inform those designing organizational structures, so that the organizational structures are designed with an element of flexibility, so that they are flexible and they can be able to operate and adapt to changes. Then 4, subsystems should be aligned to support the main systems. So the subsystem exists for the purpose of supporting the main. So if it is in a government setting, for example, government agencies and government operational areas must be able to support what the entire government is doing. When it comes to a company, the departments and the sections within a company should ensure they are moving towards the realization of the organizational vision. That is how the social systems theory can inform decisions at that level. Then principles, number 5, principles and concepts should be designed so that they are broadly applicable. There should be no principles or concepts that are designed in an organization. If you are designing, say, a system within an organization, then that system should be strong enough and versatile enough to be able to be applied within the organization to achieve the greater goals of that particular organization. Then number 6, every system is bounded by space and time. Whatever system that an organization has, whether it is an open system or a closed system, then that system is bounded by space and time. For example, you may have inputs by a particular time, processes must take place by a particular time, outputs must take place. So if you are receiving raw materials, the system of receiving raw materials should be conditioned to the operational cycle of maybe the operational machines, so that if the machines are, for example, uptaking, then that uptaking of raw materials should be done at a particular time. Processes must be, for example, started. Then you have the outputs in relation to the issue of space and time, so that the systems are well synchronized. Number 7, where the social systems theory can also be applied. Social systems theory is consistent with the systems thinking, where the whole organization is supposed to think as one. So decision making processes must be synchronized so that the organization is able to operate from one point of command. So that is your social systems theory in relation to selected research and consultancy theories in our lesson that we have completed. And before we finalize the lesson, there is an assignment that you need to work on to be able to consolidate your knowledge in the area of theories as they are applied in relation to the social systems theory. And the assignment is examine the application of the social systems theory of the social systems theory social systems theory in management. So learner, your assignment for today's lesson: examine the application of the social systems theory in management. Thank you very much for being attentive in our lesson today. Welcome, learner, to our human resource management subject, and we are looking today at Friedrich Herzberg's two-factor theory, and we want to look at it in terms of the two aspects two factors presented by Friedrich Herzberg. Friedrich Herzberg's two-factor theory is also referred to as motivation hygiene theory. Is also referred to as motivation hygiene theory. And in 1959, Friedrich Herzberg proposed a two-factor theory. And according to Herzberg, there are some factors that result in satisfaction, while there are some other job factors that may prevent dissatisfaction. So according to Herzberg, the factors which enhance satisfaction should be maintained, and the factors which prevent dissatisfaction should be addressed to ensure that employees are motivated within a working environment. So Herzberg classified these job factors into two categories, and these two categories are hygiene factors. So you have the hygiene factors. You have the hygiene factors and motivational factors. Hygiene factors and motivational factors. And according to Herzberg, within a given environment, there could be some aspects built in the job itself. And these aspects that are built within the job itself, according to Hasberg, these are the satisfiers. And that is what Hasberg proposed, that managers have to be able to find out, organizations have to be able to find out what are these inbuilt factors within the job in relation to motivational factors that may enhance employee motivation, and they can be cultivated, and they can be put in place, and workers can be encouraged to be able to perform. So we want to look at the two factors. So we will start with the hygiene factors. Hygiene factors. Hygiene factors. These hygiene factors that were brought out by Hasberg, the hygiene factors are those that may, in the working environment, if they are not addressed, bring dissatisfaction within that particular setting. And Hasberg proposed that an organization has to address those hygiene factors. And what are some of the hygiene factors according to Hasberg? So according to Hasberg, the hygiene factors in an organization may be things like pay. And when it comes to pay, number one, pay. So this could be pay structures, and pay levels. Pay structures and pay levels. So what Hasberg was suggesting, if an organization wants its employees to perform, then they have to look at the hygiene factors in relation to pay. And in this case, you are looking at pay structures, you are looking at pay levels, you are looking at commensurate pay that should be given to employees depending on their performance. Then the next thing could be company policies, organizational policies, organizational policies and procedures. So an organization has to look at the organizational policies and procedures in terms of the guidelines that are available within the work environment that govern the relationship between workers, supervisors, managers, and how work is done in that particular work environment. So when that is now addressed, then there are also aspects of fringe benefits, benefits. So these ones are the extra perks that are provided to workers. For example, an employee in a given organization could be told, if they are in an environment where parking is a challenge, that worker could be having a specific area where they park. So when they come to the work environment, they are able to find ready parking. They don't have to move up and down looking for parking. They could, for example, have good physical working conditions. So physical working conditions, physical working conditions. Physical working conditions should be looked at. So when it comes to the working environment, physical working environment. So this physical working environment may encompass things like maybe the machines, the tools, the equipment that employees are using. So here, machines, tools should be in good condition. Should be in good condition. So if an employee is working and the machine they are using, the machine the employee is using, and the equipment the employee is using is in good order, then that employee will enjoy even doing that particular work. So when you give employees equipment that are current, modern technology, even that worker will want to come and see how they can also be able to use those equipment. Then number 5, you have status. status. Employees should be recognized, and appreciated. Recognized and appreciated. So if you have designations or titles, then an employee will feel recognized, will feel appreciated, and this can also help in enhancing that employee's, for example, position. Then you also have interpersonal relations, interpersonal relations, interpersonal relations, interpersonal relations. Interpersonal relations. So this should be cordial. Cordial relations should be cultivated within a given environment. Interpersonal relations. An organization should ensure that the way workers relate to each other, the way they also relate with managers and so on, the way subordinates and superiors relate, that should be cordial relations. Then you have the aspect of job security. Job security. So this could, for example, be given in terms of contracts, stable appointments, among others. So an organization should be able to provide job security, ensure there is work for employees, and that way employees can put in more effort. So this could be some of the hygiene factors which must be addressed within a given working environment to ensure that workers are able to be motivated to be able to work in terms of their areas of operation. Then you have now the second part. That one was hygiene factors. Then you have what we are calling motivational factors. Motivational factors. Motivational factors, or sometimes they were referred to as satisfiers. Motivational factors or satisfiers. So we have looked at the one side. These aspects are not inherent in the job. These are things which are around the job. So Hasberg recommended that in terms of the motivational factors, an organization has to look at the job itself now. The organization has to look at the job itself in terms of how that particular organization is able to work. So in terms of motivational factors, there is the first one, which is recognition. Recognition. So the employees have to be recognized in the organization. The organization, like now, if you have a general manager, you have a maybe plant manager, they have to be recognized within that particular organization, and they have also to be recognized in terms of their accomplishments. In terms of accomplishments, which must also be, which have to be appreciated. For example, an employee has invented some way of doing work that has to be recognized in a function, and if possible, that worker could also be given some reward in relation to that particular recognition, and that one will motivate that worker and other workers to be able to work effectively. And then number two, there is the aspect of sense of achievement. What happens, Lana, human nature is that if somebody does something and there is an element of achievement, right? For example, if an employee is given a target, okay? An employee is given a target, for example, you have got 1,000 acres of land that is arid, for instance, and you put there a team and they are supposed to be able to translate these 1,000 acres into farmland and be able to make harvests from there. So these kind of workers in that kind of a team, they will have a sense of achievement if they achieve this target of translating arid land that is 1,000 acres into arable land that can be able to sustain life and be able to feed people and so on. Then there is the element of growth and promotion. Growth and promotion. Growth and promotion. So an organization has to provide opportunities for advancement. Opportunities for advancement. If workers have achieved, if workers have performed, then these workers should be promoted, for example. So these ones could be, for example, promotion to higher grades. So that will make those employees who have been promoted to move to higher grades. It will make these employees to be able to work hard, and other employees will also want to work smart so that they can also grow in terms of their career expectation, as the case might be. And then it is important that employees within organizations are also made responsibilities. So we are looking at motivational factors. So if you have a team, for example, if you have a team and you make them responsible for production, for example, responsible for production, so they will set targets, they will bring together their schedules, they will decide when they are supposed to maybe stop the machine and do overhaul. And when they have those responsibilities as a team, if they achieve or if they are challenged to be able to achieve challenging targets and so on, then that particular kind of a group can be able to operate, can be able to be motivated in terms of a team, in terms of the members and so on. Then there is the element of meaningful work. Meaningful work. So that work should be worthwhile. Whatever employees are doing should be worthwhile, something they can be proud of. For employees to be proud. Employees should be proud of what they are doing. If they are doing things that are making lives better, if they are doing things that are changing the environment, that are changing the society, they are, for example, producing products that are being used to save lives. They are making products which are used to feed people who are hungry, dress or clothe people, provide intervention measures and so on, assist humanity. So this meaningful work will make it worthwhile, and it is a motivational factor for employees, and it is one of the satisfiers that management has to make sure within a given work environment employees are motivated. So having looked at now hygiene factors, we have also looked at motivational factors. What are some of the implications of two-factor theory? Implications of two-factor theory. Implications of two-factor theory. So we want learner to look at what are some of the implications of the two-factor theory. So one, managers and supervisors must create a conducive work environment for effective motivation. Two, employees should be involved in decision making in decision making. Number three, why this Frederick Hasberg's two-factor theory is critical. Jobs must be designed. Jobs must be designed to enhance employee motivation. So what you are saying, Lana, in this point is that if you look at the hygiene factors, these are factors which are outside the job. But if you look at the motivational factors, these ones are factors which are inherent within the job. Then progressive recognition should be made to employees, to encourage motivation. So you have a situation where employees have performed well, and it had been agreed that if you achieve, it is important that you are recognized. So the recognition should be made. And number five, organization should combine intrinsic and extrinsic rewards. Organizations should combine intrinsic and extrinsic rewards in their motivation. So what happens, it is not only the extrinsic factors, intrinsic and extrinsic factors are important. So organizations must seek to strike a balance in terms of how they may want to motivate their workers. And then it's also important, number six, job enrichment. Should be used to provide employees with vertical job loading factors, to motivate workers, through challenging tasks. So Lana, these are just some. Job enrichment should be used to provide employees with the vertical job loading factors. So here is where higher level jobs tasks are brought down to encourage employees to be able to perform in a given organization, to achieve that sense of achievement for the meaningful of the work, so that the work is also exciting. So Lana, summary of Frederick Hasberg's two-factor theory. We have looked at Frederick Hasberg's two-factor theory, and we have indicated that Frederick Hasberg's two-factor theory may also be referred to as motivation hygiene theory. It was proposed in 1959 by Frederick Hasberg, and according to Hasberg, there are some job factors that result in satisfaction, while there are other job factors that prevent dissatisfaction, and Hasberg classified them as hygiene factors and motivation factors. We have had a look at some of the hygiene factors, and we have indicated that some of those hygiene factors are pay, where you are looking at pay structures and pay levels. We also have hygiene factors like organizational policies and procedures and guidelines. We also have fringe benefits or extra perks, number 3. Number 4, physical working conditions, like machines, tools should be in good conditions to facilitate smooth working. Number 5, status, where we have said that employees should be recognized and appreciated. Number 6, interpersonal relations should be cordial. Number 7, job security should be provided to workers where they are appointed in contracts that are stable. So, Lana, those are some of the hygiene factors. Then when it comes to motivation factors, which we have indicated like satisfiers, number 1, there should be recognition where employees should be recognized for their accomplishments and appreciated. Number 2, sense of achievement, where workers are given targets that if they achieve, they also feel they have conquered and achieved something. Number 3, growth and promotion opportunities should be provided to workers. Then number 4, responsibilities, where team production could, for example, be encouraged. Number 5, meaningful work should be made available, where workers feel that it is worthwhile to be able to perform those tasks. Then we have also looked at the implications of the two-factor theory, and we have indicated that it has several implications, including number 1, managers and supervisors must create a conducive work environment. Number 2, employees should be involved in decision making. Number 3, jobs must be designed. Jobs must be designed to enhance employee motivation. Number 4, progressive recognition should be made to employees to encourage motivation. Number 5, organizations should consider combining intrinsic and extrinsic rewards in their motivation processes. And number 6, job enrichment should be used or provided to employees with vertical job loading factors to ensure that workers are able to perform higher level activities, to challenge them and to give them an opportunity to make a contribution and feel that their knowledge and skills have been applied. So before we finish, you have an assignment, learner. Assignment, and your assignment today is assess the application of Hasberg's Frederick Hasberg's two-factor theory in human resource management. Human resource management. So Lana, that is your assignment. Assess the application of Frederick Hasberg's two-factor theory in human resource management. So I want to take this opportunity to thank you very much for being attentive in our lesson today. Thank you. Welcome, learner, to our continuing lessons in human resource management. Today we are looking at motivation theories and practice of human resource management, where we are looking at classical theories of motivation, and we are looking at Douglas McGregor theory X and theory Y. Now, this Douglas McGregor is known for proposing theory X and theory Y, which are two assumptions about human nature, and the theory X and theory Y on which are theory X and theory Y on how managers perceived and handled employee motivation. The theory X and the theory Y were developed by McGregor in the 1960s. And these theories have extensively been used to inform decisions in management and in human resource management. So what Douglas McGregor did, when it comes to theory X assumptions are the negative sides of the assumptions where some managers had the assumptions about workers. And theory Y is the positive side, according to McGregor, that there are some managers who made assumptions that, for example, in theory X, that employees are inherently lazy. And these employees may dislike work. These employees must be coerced to work. So when managers have that kind of a view about workers, then those supervisors or managers will handle employees with coercion or a dictatorial management style. But on the other side, where an organization, a supervisor or manager views employees with assumptions of theory Y, then the theory Y is the opposite of theory X. And in theory Y, it is presumed that individuals will even like to do work so long as the environment is created to have them to work effectively. And what Douglas McGregor proposed is that managers should emphasize on the theory Y assumptions to be able to create environments that help employees achieve their objectives. So we can have a look at theory Y and theory X, and then we see what were some of the assumptions that were made under theory X and theory Y. So here you have theory X assumptions, theory X assumptions. Okay. Now, when it comes to theory X assumptions, as you have said, Lana, this is the positive side. Okay. This is theory Y, theory X, theory X. Theory X is the negative assumptions that supervisors or managers may have regarding workers. And what are some of these assumptions? What are some of these assumptions of theory Y? We have just indicated that in terms of a working environment, a manager may argue that the average worker is inherently lazy. So this kind of a manager makes an assumption that a worker is inherently lazy, for example. 2, dislikes work. 3, cannot take responsibility. 4, should be coerced. Should be coerced. So that means forced. Should be coerced or forced to work. Should be coerced or forced to work. 5, will avoid work at all options. So if an employee has an option to avoid work according to these assumptions, a manager assumes that this employee will avoid work at all options, at all options, or maybe opportunity. So these are the kind of assumptions, and these are not all the assumptions. These are some of the assumptions that were proposed by Douglas McGregor, that when you look at a work environment, there are some managers, and these managers may have this kind of assumptions about workers. And when they have this kind of assumptions about workers, then these kind of managers are likely to adopt what is called a dictatorial approach to managing these particular employees within the working environment. Then On the other hand, there is now the theory X assumptions. Theory Y assumptions. Theory Y assumptions. Now, the theory Y assumptions, this was the negative. So theory Y is the positive side. And when it comes to the positive side, according to Douglas McGregor, employees, the average employee will work willingly. The average employee will work willingly. So what is important is for the management to create a conducive environment. So according to McGregor's theory, when it comes to the theory Y assumptions, what are some of these assumptions? One, workers can take initiative for their work. Two, workers are responsible so long as the right conditions are created. Workers will seek extra, will take initiative and seek extra responsibilities. So what we are saying, Lana, if you look at the theory Y assumptions according to McGregor is arguing that this is the progressive side, and workers can be what is called highly ambitious. Creativity is inherent among the workforce and so on. So these are the issues. On the theory Y assumptions, if managers make an assumption that the average worker will take initiative for their work, the workers will be responsible so long as the right conditions are created. Workers will take initiative and seek extra responsibilities. Workers are highly ambitious. Workers are willing to be involved in decision making. And when it comes to performance, these employees are able to provide output. So what McGregor provided is that Douglas McGregor, as a note learner, McGregor indicated that it is the responsibility of management to create the right work environment, for employees to operate in. So according to Douglas McGregor, looking at theory X and theory Y, McGregor, Douglas recommended theory Y for progressive managers. So for motivation purposes, McGregor Douglas provided that managers who are progressive should be able to create a conducive environment, and once they create a conducive environment, the assumptions on which they should base decisions on regarding their workers could be the theory Y assumptions, and encourage employees to be able to perform. So those are the issues that surround the theory X and the theory Y assumptions in relation to a work environment. So we can go through this learner slowly again. We have looked at Douglas McGregor theory X and theory Y, and we have indicated that in the 1960s, Douglas McGregor is known for proposing two assumptions about human nature, and these two opposing assumptions were theory X and theory Y, and according to Douglas McGregor, these were the set of assumptions that managers perceived their subordinates or their work environments, and the kind of the managerial decisions they took were influenced by these assumptions. Then we have looked at theory X assumptions and indicated that the theory X assumptions were the negative assumptions that managers could make regarding their employees, and that would then influence the kind of management styles they adopted. And we have seen that the theory X assumptions may include: one, average worker is inherently lazy; then two, an average worker dislikes work; three, an average worker cannot take responsibility for their actions within the work environment; and then four, an average worker needs to be coerced in order to be able to work, and coercion here we have said is forced. And then number five, an average worker will avoid work at all options or at any opportunity. So this then will make managers who are managing employees with this kind of a perspective to adopt a dictatorial or autocratic management style. So when workers are handled with that kind of a style, sometimes it may create challenges. So that is as far as the theory X assumptions are concerned. And when it comes to theory Y assumptions, this is the positive side. And the average worker, according to the managers who perceive workers this way: one, workers can take initiative for their work; two, workers are responsible so long as the right conditions are created for them; then three, workers will take initiative and seek extra responsibilities; four, average workers are highly ambitious; and five, creativity can be inherent within workers or it can be cultivated. So those are the theory Y assumptions, a set of which some managers may perceive their subordinates and now be able to sometimes adopt what is called a democratic leadership style or management style to be able to get work done. And according to McGregor Douglas, it is the responsibility of management to create the right environment for employees to operate in. And Douglas McGregor highly recommended managers to increasingly adopt the theory Y approach to be able to create a democratic management style to be able to achieve both employee and organizational objectives and motivate workers to their level based in terms of performance. So Lana, before we finish, I want to leave you with an assignment. And your assignment for the lesson today is describe Douglas McGregor's theory Y, theory X, and theory Y. Theory Y as it is used in management. as it is used in management. So learner, this is your assignment. Describe Douglas MacGregor's theory X and theory Y as it is used in management. So we have come to the end of our lesson today, where we were looking at Douglas MacGregor, theory X and theory Y, and we have looked at the theory X assumptions and theory Y assumptions, and also your assignment. So thank you very much. We hope to meet in the next lesson.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have two types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries, and then we also have another type of a group structure which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore maybe in this case we can say that there are different types of group structure, including number one, we have the horizontal structure. Number two, we have the vertical structure, and also number three, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company, remember also the parent company here is called the investor because it has invested in other entities. The parent company or the investor has a direct shareholding, in two or more subsidiaries, subsidiaries. So the parent company here is having direct shareholding in two or more subsidiaries. So a good example of a horizontal structure, let's assume that we have A Limited, and which is the parent company, So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries: B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say, in this case, the group accounts are prepared in the normal way, i.e. by adding similar items of assets, liabilities, revenue, and expenses, of the parent company and its subsidiaries. So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group. The group. So let's move and look on the other type of group structure, which is number two, and that is vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary company, and also indirect shareholding shareholding in a subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a sub-subsidiary. So what do we mean by that? Let's assume that we have 3 companies, and A Limited here, we are told, for example, acquired 80% of the ordinary shares issued by B Limited, and then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure, because the parent company here, which will be or which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the sub-subsidiary. Subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know, and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the subsidiary. Indirect shareholding in the subsidiary. In the subsidiary. So how do we compute that particular parent company indirect shareholding in this particular subsidiary? So what we do, we take the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is a subsidiary, and then B, which is a subsidiary or basically do have a shareholding of 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue, and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the subsidiary. Number two is you need to identify the date, identify the date when the subsidiary became a member of the group. So number two, we can say identify the date when the subsidiary became a member of the group, became a member of the group. And basically that particular date is very, very important, because when, for example, preparing number one, when computing the goodwill of the subsidiary, you compute it on this particular date when the subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the sub-subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the sub-subsidiary became a member of the group. And actually, the sub-subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the sub-subsidiary. So therefore, you can say that the sub-subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the sub-subsidiary. So basically we are saying that the sub-subsidiary will become a member of the group on the later of these two dates. The later of the date the parent company acquired the subsidiary. So like maybe let's assume that we are told A Limited acquired shareholding in B maybe on 1st of January, like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. Therefore, in this case, we are saying the sub-subsidiary will be deemed to have become a member of the group on the later of the two dates. The date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular sub-subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the sub-subsidiary became a member of the group, of which you have said it must be the later of the two dates. So the other important point number three, is regarding the cost of investment. Cost of investment in the sub-subsidiary. So when talk about the cost of investment in the sub-subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the sub-subsidiary. Now, this particular cost of investment in the sub-subsidiary usually is split into two parts. So first of all, we compute the amount due to the parent company, or we compute, yes, amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the sub-subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the subsidiary. We compute this by taking a cost of investment in subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited, in acquiring the shares of C, may be paid 100 million. Paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 8 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company in computing the goodwill of the subsidiary So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, investment in subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the subsidiary. NCI shareholding in the subsidiary is 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year, so that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is a parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
How are you over there? My name is Patrick Kamure. You are lecturer in taxation. Welcome to today's lesson of public finance and taxation, where we continue looking at the taxation of the business income, where if I can give you a little of recap of what we did, is that we said that there are three businesses that we need to see how they are taxed. One of them is the partnership, is the sole proprietorship. The other one is the partnership, and the third one is the limited company. In our previous lesson, we did the taxation of the sole proprietorship. So for today, we want to go to the next business, which is the taxation of the partnership. So partnership is where we have two or more people who come together to do business together, and they don't register their business as a company. Because of that, we normally say that partnership do not have a separate legal entity from the owners, and that will mean that when you are taxing the partnership, you tax the partners themselves, not the partnership itself, because it is not separate from the partners. They are partners, and the business, they are one and the same thing. So now we want to see how do we normally tax the partnership business. First of all, I want to write over there the introduction or definition of the partnership as I've illustrated. So we have partnership is a business owned by two or more people which is not registered as a company, and so does not have a separate legal entity. That is the definition of the partnership. But our objective or goal is to know how we usually tax the partnership business. So these are the items that you need to consider when you are taxing the partnership business. So areas to consider, or items to consider: while taxing partnership business. Number one, determination of taxable income. Determination of taxable income, and say this is done using either or a gross profit method or number two, or B, net profit method. What we are saying is that when you are determining the taxable income of the partnership, just like other business, and as we introduced earlier on when you are introducing to the taxation of the business today, any business, when you're determining the taxable income, you either use the gross profit method or net profit method. So the same criteria apply to the taxation of the partnership. You either use the gross profit method or net profit method to get the taxable income. We have Roman 2. Another items that you need to consider when you are determining taxable income of the partnership or taxing the partnership is the following expenses: are not allowable partnership. I.e., salary to the partner, to partners, interest on capital, interests on capital from partners, to the partners, commission and bonuses to partners, drawings by partners, and any private expense of the partners. That is the second thing that you need to know, that those expenses, when they are incurred by the partnership, they are considered to be non-allowable expenses. Salaries to the partners, interest on capital, bonuses, the commission, the drawings. In short, we are saying any expense relating to the partner, like private expenses of the partner, we don't allow them when you're determining the taxable income. The third one that you need to consider, the following incomes. Are non-taxable incomes in partnership, i.e., what are those incomes that are not taxable? Interest on drawings, profit on goods sold to partners, and any other income. Any other income from partners. That's another thing, that when you're determining the taxable income of the partnership, if there's any income that the partnership received from the partners, we treat it as non-taxable. This you hear like interest on drawings, like when the partner withdraw anything from the partnership, like goods, the cash, they charge interest. That is an income to the partnership, but it is usually not taxable. Another thing is like sometimes they can have a provision, or the partners can have a provision that if a person wants to buy goods from the business, can buy and they are going to be charged a profit like any other customer. So that profit is not taxable in the partnership, and any other income that the partnership may get from the partners. The fourth one is the income distribution schedule. Distribution schedule. What does that mean? Once taxable income of partnership is determined, it is distributed to partners using income distribution schedule where they bear individual tax burden. They are taxed individually at graduated scale rates in the same way as employment income. After the distribution. The gross tax. The gross tax, once determined, then set-offs such as personal relief, insurance relief, and withholding tax on investment incomes are deducted. Income distribution schedule has the following format. So what we are saying is that about the income distribution schedule, once the taxable income of the partnership is determined, either using the gross profit or the net profit, we tax the income on the partners themselves, and we tax them at graduated scale rates. Graduated scale rates is the same as the employment income, the way we taxed the sole proprietorship, where once you distribute to the partners, because the partners are the one who bear the tax burden, you tax them individually. It is partner A, how much is the taxable income? Tax individually at graduated scales. Partner B, how much is the taxable income? Tax them individually. And then once you get the gross tax of each partner, you less the set-off. Set-off, we said that they reduce the actual tax they are supposed to pay, and they are like personal relief, the withholding tax on investment income, and insurance relief if they have life insurance cover, education insurance cover, or NHIF. Now, I want to show you how the distribution is done through the income distribution schedule or allocation schedule. So it has this format: income distribution, stock allocation schedule. We start by distributing the taxable operating income, and then we list the partners. Partner A, we are assuming partners are A, B, and then we have a column for the totals. Shillings, shillings, shillings. So the taxable operating income you would have determined using either gross profit method or net profit method. You can distribute it this way. The first one is usually the salary. So salary to partners. If partners have the salaries, if this one had a salary, you put there this one and the total. The next one is interest on capital. Interests on capital. So interest on capital for this partner, for this one, and this, if there is any. Then commission or bonus. You put on this, this, and this. After that, those three are the one that you usually post. If there is commission or bonus, interest on capital, salaries to the partners. Then you less interest on drawings. interest on drawings. So interest on drawings here, you less if anybody withdrew the goods and they were charged interest there. Now, after you have distributed those one, the taxable operating income you'd have determined, you minus what you have distributed, minus this, minus this, minus this, but this one you add. Then whatever remains you share according to the profit sharing ratio. We call it profit share. Shared according to profit sharing ratio. So you come, how much is this? This total. And then after that, get the total taxable operating income. Total taxable operating incomes means we take the salary, the interest on capital, if there is commission or bonus, less interest on drawings, profit share, you get the total here. You do the same for this, you do the same for that. Now, you have just distributed the operating income. Then you add taxable investment income. Taxable investment incomes shared according to profit sharing ratio. Sharing ratio. So, if you have something like rent, non-qualifying dividend, non-qualifying interest, royalty, all those, remember, withholding tax is not final. You come and share here according to the profit sharing ratio. This one, total. And then now from there, you can get total taxable income. Total taxable incomes, which will take the operating income plus investment to get the total. Operating plus investment, operating plus investment there. And now, if you are asked about now taxing, getting the tax payable by partners, you will tax this one A individually on this using the graduated scales, the way we tax a sole proprietor's income. The same case, this one, A, B, tax on this one to get the tax they are supposed to pay. So that is what you need to know when you are taxing the partnership business. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Kamara, Susan, and Kubasu are a partnership, trading as Kasuku traders, sharing profits or losses equally. They have provided the following statement of profit or loss for the year ending 31st December 2021. We have the gross profit, VAT refund, foreign exchange gain, dividend income net, a profit or disposal of furniture, rent income. Then total income, then less expenses, insurance premiums, legal fee, depreciation, repair and maintenance, VAT paid, sundry expenses, interest on capital for Kamara, Susan, and Kubasu, motor vehicle expenses, custom duty, accountancy fee, bad and doubtful debts, rates and rent, salaries and wages, net loss. Additional information: number 1. Insurance premiums include 282,500 paid to insure Susan's private car. Legal fee include parking fine, settling a dispute with a customer, appeal against tax assessment, court expense for breach of contract, preparation of tender documents. Number 3. Sundry expenses include interest charged on hire purchase, cash embezzled by cashier, registration of trademark. Number 4. Repair and maintenance comprised of the following: repair of furniture, installation of surveillance camera, cost of office furniture. Number 5, the partners took goods for personal use which had cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. The investment allowance were agreed with the Revenue Authority at 1475,000 during the year ending that 1st December 2021. Salaries and wages included salaries to the partners as follows: Kamara, Susan, Kubasu. So we are required to have the adjusted partnership profit or loss for that year and distribution schedule of the profit or loss computed in C1 above. So we prepare the income distribution schedule after getting the taxable income. So the first question is to get the taxable income of the partnership. Question is, which method are we supposed to use? Here we said if you are given net accounting profit, then you use the net profit method. Here we are given the net loss, which is a negative profit. That automatically means that you're supposed to use the net profit method. So we solve the question. We start with the name of the business, Kasuku Traders. Which is a partnership. We get the taxable income for the year ended that 1st December. (2021). As we had said, when you are given the net accounting profit or loss or income, we start with it and then we adjust it. So we'll start with net loss provided, which we are given in shillings, and we have 2956,000 negative or a loss. Then we add, we had said when you're using the net profit method, you add non-allowable expenses in P&L and taxable operating income not in P&L. Non-allowable expenses in P&L and taxable operating income not in P&L. What does that mean? We usually start with the first item, non-allowable expense in P&L, meaning in P&L is the profit and loss account, which is the income statement. That in this income statement, as you can see, incomes were added and expenses deducted to get the net profit, which is a negative profit anyway. So we are saying, of those expenses that were deducted, is there an expense that is not allowable? So that now it had been deducted to get the net profit. It's not allowable. It's not supposed to be deducted. We add it back. Before we go to the last one, I'll show you where we find it, because that one, as you can see, not in P&L. So we finish with this first one, as we had illustrated earlier on. Let us start with the expenses. We just follow the ones that are in the P&L. Insurance premium. Insurance is for the business, and it is usually allowable expenses. The other one is legal fee. Legal fee is also allowable, as long as they have not extended to what they entail. Depreciation, no. Depreciation is not allowable, as we have been saying, so we add it. It had been deducted, remember, and it is not allowable. 575,000. The other one is repair and maintenance. Repair and maintenance, that is allowable. It's for the business and it's allowable. VAT paid. We said any form of tax we don't allow. Any form of tax. VAT is a tax. Value added tax is not allowable. Had been deducted to get the net profit, and it's not supposed to be deducted. It's not allowable. We add it back. Next, sundry expenses. That those sundry expenses are small expenses put together for the business, and they are allowable. Interest on capital. We had even said it here that anything paid to the partners is not allowable. Partner salary, commission, interest, drawings, in private expense we don't allow. So that one had been deducted and it's not allowable. So interests on capital, which we have Kamara, we have Susan, Kubasu. So Kamara for 7,500. The other one is 185,000. The other one is 146,000. Then we continue motor vehicle expenses. Motor vehicle expense, those are expenses to run the motor vehicle. Don't say it's the cost of motor vehicle. When you hear motor vehicle, they are the expense to run motor vehicle, like fuel, repair. Those are allowable. But if they say the motor vehicle cost, that's now the cost of a motor vehicle. Fixed asset we don't allow. So this is allowable. Next is custom duty. Custom duty is a form of tax. We don't allow taxes. So we'll add it. Which we have 227,500. Next one is accountancy fee. Those are professional fee you pay. They are allowable because they are for the business. Bad and doubtful debt. Now when you hear doubtful debt, is a provision, a general provision, because you are doubting that they might not pay, they might pay. So it's just a provision. We don't allow provision unless it's specific provision for bad debt. The next one is rates and rent. Rates and rent, those are allowable expense because they are for the business. Salaries and wages, we also said those are allowable. They are for the business. They are revenue and commercial expenses. Now look, we are done with non-allowable expenses in P&L. Now we can look for taxable operating income, not in P&L. What does that mean? It means that an income that is taxable, but it has not been included in the P&L, in the income statement up here. So meaning it didn't increase the net profit that we have down there, although it's a loss, it's a negative profit. It didn't. So if it is not in the P&L, it didn't increase this net profit. Where do we find it? We can only find it in the additional information. So we go to the additional information to check for an income not in P&L. If they happen to be taxable operating, then we are going to add. However, when we go to the additional information, there's something else we normally check. You see, we say we are done with the expenses in the P&L, but you may go to the additional information and you are given analysis of those expenses that are in the P&L. Like the last expense we had salaries and wages in the P&L. You may go in the additional information and you're told that was to the partner. Remember, salary to the partner we don't allow. So we still come back and disallow it. So in the additional information, we not only look for taxable operating income not in P&L, but we also look for analysis of the expense in P&L. If they happen to be non-allowable, we still add them. Like if you go to the additional information number 1, we are told insurance premium include. Now insurance premium is an expense. When you go to the income statement, you'll find it is the first expense. So now we are told that one, it includes 282,500 paid to insure Susan private car. Those we don't allow. Why? Because they are private expenses of Susan, who is a partner. We don't allow. So we disallow the 282,500. Insurance, Susan car, 282,500. Then number 2, legal fee include. Legal fee is an expense. Now, is it in the P&L? Yes. When you go to the P&L, the second expense, legal fee. Now, we need to determine if there's a component that is not allowable of that legal fee, so that we add it because it is in the P&L. It included parking fine. Parking fine, we don't allow them. Let me analyze them, then I post the one that are not allowable. Parking fine are non-allowable, so that will add. Setting a dispute with the customer, that is allowable. So if you remember what we said, legal expense related to customer is allowable expense. Then the other one is appeal against tax assessment. We said any expense relating to tax is not allowable. Relating any expense, Any form of tax, we don't allow. Expense relating to tax, we don't allow. So this is not allowable. It's relating to tax. Court expenses for breach of contract, we said that. Legal expense relating to breach of contract, we don't allow. The other one is preparation of tender document. Now, that is allowable expense. So now let us disallow the ones that we have said. Parking fine. $150,000. Tax assessment. Expense, which we have 62,500. We have breach of contract. Costs or expense, 400,000. Preparation of tender, that we said is allowed. After that, we go to number 3. Sundry expense include. Now, sundry expense is in the P&L. When you go to the P&L, you will find it there. So we need to determine the part that is not allowable. It included interest charged on hire purchase. We had said interest on money borrowed is allowable. Interest on money borrowed. So hire purchase, is like you had taken an item through hire purchase, you had borrowed it, so you are paying the interest. That's allowable. Cash embezzled by cashier. We had said any expense that is not income generating, we don't allow. So it doesn't matter who embezzled. As long as it's an embezzlement, it is not income generating. We disallow. We will add it here. The other one is registration of trademark. We had said expenses relating to trademark, patent, copyright, we don't allow them. So these two, we disallow. Cash embezzled. By cashier, 565,000. The other one is registration of trademark. Which we have 281 to 50. After that, we go to the point number 4. Repair and maintenance comprised of the following. So, repair and maintenance, if you go to the P&L, you'll find it. It is there, one of the expense. So, we check the part that is not allowable. We are told it included repair of furniture. Repair of furniture, those are normal business expense and it's allowable. Don't say it's relating to a fixed asset because it was incurred after the fixed asset had been purchased. It's already allowable. Installation of surveillance camera, that is the one that is not allowable because we had said when we were looking at the capital allowance, expense incurred before you start using a fixed asset. We normally claim capital allowance on them when we are claiming the capital allowance of that particular asset. So this one is not allowable because it's part of the cost of the fixed asset, the CCTV. Cost of office furniture, those are also not allowable because they are fixed asset. So we disallow the two. Installation of surveillance camera, where we have an amount of 812,500. The other one is the cost of office furniture. Costs of office furniture. Cost of office furniture, 525,000. Then we now go to number 5. The partners took goods for personal use which had a cost price of 225,000. The gross profit margin was 20% as recorded in the partnership books of account. So partners took goods, they were charged profit. It's like the goods were sold to them. Now, they were at the rate of 20%. Now, if you go to the income statement to check whether that profit is there, it is in the gross profit that you can see in the income statement. And what did we say about the income in the income statement? At the moment, we are interested with the income not in the P&L, not in the income statement. So if an income is in the income statement, we ignore for now. So we move on to the next one. Investment allowance were agreed with the Revenue Authority at 1475,000 during the year. Remember, investment allowance is equivalent to capital allowance. Capital allowance or investment allowance are allowable. Right now, we want the non-allowable expense in P&L. So that being allowable, we ignore. Number 7, salaries and wages include. If you go to the P&L, you'll find salaries and wages there. In that salaries and wages, we are told it included the one that were paid to the partner. We said anything paid to the partner, we usually don't allow it. So, salaries to the partner, where we have Kamara, Susan, Kubasu, which we have 600,000. We have 450. And we have 225. And that is the end of the additional information, meaning we don't have any other item we are supposed to add. Because we are done with the expenses in P&L, unfortunately we didn't find taxable operating income not in P&L. Otherwise it could have been in additional information. Now that we are done with the addition, remember we said now you come to the deduction. Deduction, we deduct 3 items. Less, non-taxable operating income in P&L, that is one. The second one is all investment income or investment incomes in P&L and allowable expenses not in P&L. So we are saying we first look for non-taxable operating incomes in P&L and all investment incomes in P&L before we look at the allowable not, because this one is not in P&L. We start with the first 2. Now we go to the P&L and look for them, but unlike us, I like to delete this part here so that I can continue, and then once we are done I can come and we distribute here. So the continuation is here. So let us go to the P&L, look for non-taxable income, meaning that in this income statement up here there could be an income that is not taxable that was included. We remove because it increased the net profit there. We remove because it's not taxable. 2, if there is any investment income here, investment income increased the net profit, we remove it so that we remain with operating income only, as we had said. So we start with the first income, gross profit. Gross profit is a taxable income and does not have an issue because we are in the business of buying and selling the goods. So the profit we make is a taxable. But there was additional information number 5, that the partners took goods for personal use which had cost price of 225. The gross profit margin was 20% as recorded in the partnership books. We said any income to the partner is not from the partner is not taxable. So it's like the partners purchase the goods from the partnership because they are being charged the profit. We remove that profit. So profit on goods taken by partners. So here we are told the goods, the cost of the goods was 225,000. This is the cost. I want to remind you that whenever you are given margin and markup, I know you have done financial accounting or financial reporting. You are told whenever you are given the markup or margin and you want to get the profit, you must be very careful. That, remember, I want to illustrate here. Remember, markup, let me start with the margin. Margin is usually equivalent to profit over sales, which in this case we are told is 20%. So 20% stand for 20 over 100. Now, we use the margin the way it is to get the profit if we are given the sale. Now, in our question, we are given the cost. The cost, we use the markup, which is the profit over cost. So in this case, then we have to ask yourselves, how much was the markup? You don't have to worry. You just need to use the margin to get the markup. How? See here we have profit over sales. Margin is profit over sales, which is 20 over 100. Profit, it is 20 then. Sales is 100 then. And here in the markup, we have the profit. So bring this 20 here because it is the same. It's a common factor in the markup and margin. Profit, 20. And then now get the cost. Remember, even when we are doing the gross profit method, we were saying a sale minus the cost of sales, we get the profit. Now, if you want to get the cost, remember here, we want to get the cost. If you want to get the cost of sales, then take this cost of sales together with the negative to the other side, and the profit will bring here. Remember, profit is positive here. When it come here, it will be negative. Cost is a negative here. When it go beyond the is equal sign, it become positive. So it's like saying the cost will be the sale minus the profit. So in this question, do we have the sale? Yes, the sales is here, which is 100. So we take 100 to get the cost minus the profit. Do we have the profit? Yes, the profit is 20. The one that we have even used here, minus 20, meaning it is 20 over 80. So now that we have the markup, and the markup is the one that you use the cost, now we can apply it directly. This is fraction 20 over 80 times 225 because that is the cost. So we'll come here and talk of times 100 over 80. And not 100 over 80, 20 over 80. 20 over 80. We do the computation so that we can get the profit that was charged on the partners. 225,000 times this 225, let me confirm, is 225. 225 times 20 divided by 80, which give us 56 to 50. So 56 to 50, we minus. Remember, we are minusing because it's an untaxable operating income in P&L. So I'll now continue here. Now we go back to the P&L, look for other non-taxable income and investment. After the gross profit, we have VAT refund. VAT refund is not even an income because you just overpaid your VAT and it's being refunded to you. So we remove VAT refund. VAT refund 102,500. It is a non-taxable income. It's not supposed to be taxed. The other one is foreign exchange gain. We only said the non-taxable foreign exchange gain is the unrealized one. Unrealized we should not tax. Actually, if we were told unrealized, we should have removed because it had been included to increase the net profit and it's not taxable. But when it is cited, what does that mean? It means it is realized. So if decided, it is realized. So that is taxable. We won't remove. Dividend income net. Dividend is an investment income. And we said all investment income in P&L or investment income in P&L, we remove them. So we remove dividend income. And somebody may ask, do we remove the net of the gross? My answer is, you remove the figure that increased the net profit. The figure there, whether net or gross, right now they are saying net 562.5. The 562.500 is the one that increased the net profit that we are adjusting. So remove it, whether gross or net. The figure is the key, 562,500. Then profit on disposal of furniture. If you remember, we said income from selling fixed assets we don't tax. So had been included in the in the income statement, they increased the net profit, it is not taxable. So profit on furniture. So profit on furniture, which we have 591,000. The other one is rental income. We said all investment income in P&L we remove. Rent is an investment. We remove rent income, which we have for 15,000. And that is the last income in the P&L. So we are done with non-taxable operating income in P&L and all the investment income in P&L. Now we look at the last part, allowable expense not in P&L. An expense that was supposed to be deducted in the P&L in the income statement to get this net profit, it had not been deducted, meaning this net profit, it is overstated. So we need to remove it. If it is not in the P&L, where do you find it? You find it in the additional information. Let us go to the additional information for an expense allowable not in P&L. Now we start with number 1, insurance premium. Now remember, we want expense not in P&L. Insurance premium is in the P&L. Leave it. Number 2, legal fee. Legal fee, if you go to the P&L in the income statement, you'll find it there. Leave it. Including, don't say, like in the legal fee, we are told it includes settling a dispute with the customer and also preparation of tender. Remember, those we said are allowable. Don't go to the P&L and you won't find them and say now they have not been deducted. No, all of them are in the heading of the legal fee. So they are all inside the legal fee that is in the P&L. So as long as the heading is in the P&L, ignore it. So number 3, sundry expense is in the P&L. Repair and maintenance is in the P&L. Number 5 was about gross profit, not even an expense. Number 6, investment allowance were agreed with the revenue authority to be 1475,000 during the year. Now, investment allowance or capital allowance, it is allowable. It had not been deducted, because if you go to the P&L, you will not find it having been deducted there. So we deduct. It is allowable expenses, not in P&L. Investment allowance written as that, in short, or CA for capital allowance for the year. For the year. For the year. For the year, which is how much? Here we are told it was agreed to be 1475,000. 1475,000. We continue getting the allowable not in P&L. Number 7, salaries and wages include. Salaries and wages is in the P&L, and there is no other expense that is not in P&L. However, I want to mention this. Sometimes you may not be given this investment allowance agreed. Like you may not be given that point number 6. Let's say it is not there. If you are not given, make sure you come back to the expenses that you disallowed. Check if you have a fixed asset. Remember, fixed asset we disallow so that we come and allow the capital allowance. Allowable expense not in the capital allowance. So if you are not given this, like in this case, we had which fixed asset? Here we had installation of CCTV. If you remember, we said capital allowance is at the rate of 10%. And then the next one is the installation of CCTV. There was office furniture, cost of office furniture here. Remember, office furniture, we are supposed to claim at the rate of 10% as well. So if you are not given this capital allowance, we could have come here and say capital allowance on installation of CCTV camera, 10% of the figure that we have, 812,500, we minus that figure. Then capital allowance on furniture, 10% of 525,000, we get the amount before. But if you are given the capital allowance, then you are okay. So with that one, then we are supposed to now get, since there is no other, we have considered every factor here, we can get the net taxable operating income. So taxable operating income, I want to do that first. So what we do, we start with this negative, we add all these figures, we minus these figures so that we can get the net. So I'll start. The first one is 2956 negative. Remember to minus negative. 2956,000 plus now positive 575,000 plus 233,750 plus 407,500 plus 185,000 plus 146,000 plus 227,500 plus 155,000 plus 282,500 plus 150,000 plus 62,500 62 did it first plus 62,500 plus 400,000 plus 565,000 plus 281,250 plus 812,500 plus 525,000 plus 600,000 plus 450,000 plus 225,000. Then now we start minusing 56,250. We minus 102,500 minus 562,500. We minus 591,000 minus 415,000. We minus 1475,000. So giving us 125,250. So we have 125,250. Now, having gotten the taxable operating income, having gotten the taxable operating this one, I want you to get the difference with the sole proprietorship and also the company. For the partnership, we don't add investment income here. Investment income, first we have to distribute this operating income among the partner until here we get the total taxable operating income. So the total we get here would be the same as this. And then the investment income we add here. So the investment income are not added here. They are added in the distribution schedule. So for now, this, we cross it that way for the partnership because now we need to distribute. Now after that, we have answered required one. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required two, distribution schedule for the profit or loss. We have answered required one. We were supposed to get the adjusted partnership profit or loss for the year. Here it is. Required two, distribution schedule for the profit or loss. So distribution schedule is the way we had said. So we'll come and now distribute whatever we have determined. So I'll delete just part of this. And then I'll also change the names here because they are two. And then I'll also change this. Let me delete this. So I'll call this the partnership name, Kasuku Traders Partnership. Income distribution or allocation schedule. And then here we noted there were three partners, by the way. So I'll delete this so that I can introduce the three partners. I'll give them the initials. As you have seen, there's Kamara. So I write KA to stand for Kamara, Susan SU, and Kubasu KU, and then totals because of the space. So shillings, 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 shillings. So we had said the first thing we normally distribute is the salaries to the partner. So you just need to go to the question and determine if there was salaries to the partner. When you read through from the income statement, there was none. Additional information number 1, 2, 3. It was in point number 7. So you come and say now salaries to the partner, Kamara, 600,000. Susan, 450. Kubasu to 25,000. And now we get the total. We add the 3 to get the total. So 600,000 plus 450,000 plus 225, which give us 75,000. There. Then the second one is interest on capital. This one, when you go to the income statement, you have to remember the 4 that we talked about first. The salary, interest on capital, commission or bonus, there's interest on drawings, those 4. So you follow them that way. The next one is the interest on capital we had written. So we check. It is there in the income statement, interest on capital. So we would have here 47,500. The other one is 185,000. The other one is 146,000. And now we get the total. So 407,500 plus 185 plus 146, which give us 738,500. Then the other one that we had here was the commission or bonus to partner. But I'm very sure as we went through the question, there were no commission or bonus to the partner. So if it is not there, ignore, just assume it. You go to the fourth one, raise interest on drawings. In the question, we didn't have interest on drawings to the partner, none. So now we do the last one, fifth one, which we said is the profit share. Profit share. So profit share, how do you get? We said we take the operating income, this one, of 125 to 50 minus what you have distributed. You have distributed this and this, which is 75,000 and also 738,500. Then what remains, you share according to the profit sharing ratio. That's what we said. Profit share, you share according to the profit sharing ratio. If you look at the first paragraph, is where we have the profit sharing ratio. Kamara, Susan, and Kubasu are in partnership trading as Kasuku, sharing profit and losses equally. They are 3, each to get a third. So first one, a third. The other one, a third. The other one, a third. So let's see what remains. We'll start with 125 to 50, and then we minus 1275,000. And then we minus 738,500. Then we have negative. It will be negative. We have negative 1888. So I'll extend this a bit. 250, which is a negative. Now each is supposed to get a third, so you divide by 3. Each to get 629. 416. I want to round off to, because it's 416.6. 417. So 417, which is a negative. Same case here, because it's for each. And the other one is 629, 417. All they are, remember, are negative. So from there now, we need to get the total taxable operating income. Operating income. So total taxable operating income would mean we take this plus this minus this because it's a negative. The same case for everyone. So we start with 600 for the first one, 1,000 plus 407, 500 minus 629, 417, and then we get positive 3, so this would be 378, 083 positive. And then now we go to the second one for Susan for 50,000, and then we add 185,000 minus 629, 417, 5583. Then for Kubasu 225,000 plus 146,000 minus 629, 417. This is a loss of 258, so negative 258, 417. Then now we get the total, which would be 1275,000, and then we add 738, 500, and then we minus 1888, 250, which we get 125, 250, 125, 250. And that answer, you'll find it is starting with the operating income, because remember we have been distributing this operating income. Actually, we can even write it here, 125 to 50. So at the end, the total column should tally with the operating income, because we have distributed through salary, interest, and profit share. Once you do that, now we said the investment income come here. You add the taxable investment income. Taxable investment incomes. So for the taxable investment incomes, so we need to go to the question, especially in the income statement, determine if we had an investment income, and then we share if it is taxable. The first investment income in the income statement is the dividend income, which we are told it is net. What we say is this: if you are given an income like dividend or interest, and you're not told where it's coming from, always assume it's a non-qualifying dividend or non-qualifying interest. Like this one, they have not indicated where it's coming from. So being non-qualifying means that the withholding tax was not final. We need to tax it further. So the dividend that we don't put here are the one that we indicated as exempt or qualifying, because exempt are not taxable. And here we are talking about taxable. Qualifying, withholding tax, it's final. You are not supposed to tax it again. So only non-qualifying. So this one, being that it has not been indicated, we assume it's non-qualifying, so it should be here. So dividend income, where we have 562,500, and then it is net. Remember, we said that for non-qualifying dividend, if you are told net, withholding tax is 15, meaning they have already deducted 15, meaning this is 85%. Remember, we said you only tax the gross. So if this 85, 100 will be what? To get 100, multiply by 100 over 85. And then profit sharing ratio, each was to get a third. So it will be 562, 500, we multiply by 100, divide by 85, you get 661, 764. Uh, 765, we round off, and then divide by 3, which comes to 220, 20, 588. Now with that one, we have distributed the dividend. There is another investment income, rent. We said if you're not told where the rent is coming from, you assume it's a commercial rent so that you tax it further. So here we have not been told. And then for the rent, you must minus the allowable expense relating to rent. Repair, caretaker salary for the rental. But for this question, we haven't been told whether there were any expenses relating to rent. So we distribute the way it is. So rent income, which we have a 415,000, and then profit sharing ratio, each to get a third. So that would be in total 415 divide by 3. Divide by 3, giving you 138,333. 138,333. 138,333. And then since there is no other investment income, we can now get total taxable incomes. So total taxable income, we do them this way. If the operating is positive, that's the time that we add investment. Like this one is positive. But if it is negative like this, we don't add. We cross it there. Remember, we say that a loss from one activity can only be deducted against profit of the same activity. So operating for this guy, this person, they had a negative. It will be carried forward to next year. So next year, when they generate a profit, he generate a profit or she generate a profit from the operating, she deduct this loss. So for this year, he will be taxed on the investment income only. So for this one who have positive are the one that we add. The negative we don't add, we only add the positives. So we start with the first one, 378,083. 083 plus 220. 588 to 2588, and then we add 138,333, which give us 737,004. We go to the next one, 5583, and then we add to 20. 588 to 2588, and then we add 138,333. We get 364 504. For this one, remember we said we don't add the negative, carry forward to next year, we only add the positives. So 220, 588 plus 138, 333, which we get 358. 358, 921. And then we go to the total, 125 to 50 plus 661. 765, and then we add 415,000, so giving us 1202 015. Yeah. And the question ends there, and this total cannot be the same as this way because this we didn't add. So this we carry forward to next year. So as per the question, that is where we stop, and that is how we determine the taxable income of the partnership, and we do the distribution. For now, we are going to stop there until I see you in our next lesson, where we are remaining with one business, that is the limited company. We see how limited companies are usually taxed. Thank you very much. However, make sure that you do the assignment that is being shown at the end of this video. Thank you very much. Hi there, my name is Patrick Kamau Kamure. You are a lecturer in public finance and taxation. Welcome to today's lesson. Today, we continue from where we stopped last time. Remember, the topic we are looking at the moment is called the taxation of the business income. And we said that there are three businesses that we need to look at how they are usually taxed: the sole proprietorship, partnership, and the limited company. So far, we have looked at the sole proprietorship. Last lesson, we did look at we started looking at the partnership, whereby after looking at how partnership is usually taxed, we went ahead and we used the net profit method to get the taxable income of the partnership. So today we continue with the same lesson, but we look at another question where we used a different approach to answer the same question, a different question using now the gross profit method. Welcome to today's lesson. So we are going to start by reading the question. After reading the question, then I'm going to help you solve the question. So here is the question. This is what the question says. Karimu and Shika commenced trading in partnership as Kashi on January 2019. They share profits and losses in the ratio of 2:1 for Karimu Shika respectively. The partners were to receive monthly salaries of 18,000 and 22,000 for Karimu Shika respectively. The partnership did not maintain complete set of accounting records. The following summary of the bank statement for that year has been presented to you. So we have the receipts consisting of capital introduced, Karimu and Shika, cash sales, receipts from debtors, sale of a van. We go to the payment side: equipment of office, rent for go down, salaries and wages, purchase of for resale, repair and maintenance, insurance, interest expense, motor vehicle expenses, sundry expenses, motor van purchased, tax penalty, electricity, medical expenses, balance carried forward. Additional information: number one, the following payments were made in cash from the cash sales before banking. We have the motor vehicle expenses per annum, wages per annum, sundry expenses per annum, weekly drawings for Karimu and Shika. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118,000. As at that 1st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. Depreciation was to be provided on equipment at 10% on a straight line basis. As at that 1st December 2019, the amount owed to supplier was 780, while the amount owed by the customer amounted to 1420. An amount of it 2,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad debt. This amount was excluded from the total amount owed by a customer as at that 1st December 2019. Salaries and wages include the salaries to the partners. The go down had been occupied since 1st November 2019 at an annual rent of 450,000. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. The wear and tear allowance, and it's good to note that wear and tear allowance is the same as the capital allowance. So wear and tear capital allowance was agreed with the Revenue Authority to be 112,000 for the year ended at 1st December 2019. So number 11, closing inventory was valued at 620,000 on 31st December 2019. Assume that year of income had 52 weeks. Required: 1. Adjusted partnership profit or loss for the year 2019, and number 2, distribution schedule of the profit or loss calculated in C1 above. So the first question is to get the taxable income, and we say that whenever you are told to get the taxable income of any business, you either use the gross profit approach or the net profit approach. Net profit approach, we said, is when you have been given net accounting profit or loss or income somewhere. If you haven't been given, you use the gross profit method. So this question, we are not given the net profit or loss or income. So automatically we use the gross profit method. Now gross profit method, we said, we usually start with the sales. We less the cost of sales. Cost of sales, we take the opening stock plus purchases, less closing stock minus any item that reduce the stock. And then we get the cost of sales. We less from the sales, we get gross profit. And the reason why we call it gross profit, we said. And then you add other taxable operating income, and then you less the allowable expenses. So But we said before you start, always confirm. Do you have the sales? Do you have the total purchases? If you don't have, or haven't been given, then in that case you have to determine them first. So in this question we take note that we're starting with the sales, we are given only one, the cash sales. But the cash sales does not represent the total sales. We have to look for the credit sales. We add to the cash, we get the total. So now we are not given the sales, so we have to look for it. The other one is the purchases. Have we been given the purchases? Yes. In the payment, in the statement of bank statement, there is a purchase for resale, but that is a cash purchase. Now, how about the credit? So in this case, we have to determine the credit purchase so that we can add to that cash, we get the total purchases. So this is what we said you normally do. To get the total sales, you do it this way. You say total sales is equals to credit sales plus cash sales. We said for the cash sales you'll be given, it is there, like we have seen it's already there. The issue is about the credit sales, where you have to determine it. Now, the best way to approach the question, we said, leave a space like 2 lines, where now you'll be able to open the debtors or receivable account to determine the credit sales. So you'll come here and have the debtors stock receivable. You start with balance brought down here, that's what we said, for the debtors. And then jump 4 or 5 lines here, where you'll be posting those items that affect the debtors. And then balance at the end here for the debtors. And then totals will be here. Same case on the purchases, we say total purchases is as a result of credit purchase plus cash purchases. For the credit purchase, we jump a space of 2 or 1 line, and then we have the creditors or payables account, where we will be able to get the credit purchase. Then for the creditors, you start with balance brought down here for the creditors, and then jump 4 or 5 lines, then have the balance carried down for the same creditors. And then you'll be able to post everything and the totals there. Once you have done that, now go through the whole question. If you come across some cash sales here, something affecting the debtors here, cash purchase here, anything affecting the creditors here. So we start. From the first paragraph, the only figures that we have are 18,022, which were monthly salaries to the partners. So those do not affect, so we ignore. We go to the receipt. Capital, introduced, that's not. Cash sales, yes, here. So we post it here, 700,000. And then receipts from debtors. Receipts from debtors, we said it reduces the debtors. Here, receipts, which we have 5,200,000. Then sale of motor van, that doesn't affect. We go to the payment side. Equipment for the office, that does not affect. Rent for the go down doesn't. Salaries and wages, no. Purchase for resale, yes. Here, that's a cash purchase, of which case we have 9,900,000. The other one is the repair and maintenance doesn't affect. Insurance, interest, motor vehicle, sundry expense. Motor vehicle purchase, that's a fixed asset, not goods. Remember, what we are looking for are for the goods. Tax penalties, electricity, medical expense, balance carried forward, those do not. Then we go to the additional information number 1. The following payments were made in cash from cash sales before banking, meaning what went to the bank, as we can see the bank statement was this. But before that figure was posted, not really this one, but the one in the bank statement, we had 12,700, this one. But before they banked the 12,700, they had paid some expenses, meaning our cash sales was more than what was banked. So to get the how much it was, we need to add the one that was sold on the one that was sold on cash and then used to pay the expenses. Which one? Motor vehicle expense. So the key thing there was from cash sales, were paid from the cash sales. Motor vehicle expense per annum, that we had 138,000. The other one is wages, 162, plus sundry expenses per annum, 35. Then weekly drawings by Karimu and Shika. So weekly drawings for the whole year, it has to be for the 52 weeks. So 52 weeks times now weekly for the total, which is 7,200 plus 6,400, and that ends there. From there we go to number 2. During the year, discount received from the supplier amounted to 132,500. Discount received reduces the creditors, so we'll have it here. Discount received, which we had 132,500. The other one, while discount allowed to customers amounted to 118,000. Discount allowed, which reduces the debtors. Discount allowed, which we have 118,000. I want to bring this one a little bit up here, but I haven't changed anything. It's just this. And so we had said the balance carried down for the creditors. We leave it there. So we continue. After that, we go to the point number 3. As at 31st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. That doesn't affect. Depreciation was to be provided on equipment at 10% straight line. No. As at 31st December 2019, the amount owed to supplier was 780. Now this at the end of the year, what the supplier are owing is 780,000. And then while the amount owed by customer 1420. What is owed by the customer is 1420 at the end there. We continue. An amount of 82,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad. This amount was excluded in the total amount owed by the customer as at 31st December 2019. So that's a bad debt written off. Bad debt written off reduces the debtors written off, which we have 82,000. 82,000. The other one is number 7. Salaries and wages include salaries to the partners. That doesn't affect. Number 8, go down had been occupied since 1st November 2019 at an annual rent of that. Doesn't affect. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. Doesn't affect. The wear and tear allowance was agreed with the Revenue Authority to be 112,000 for the year 2019. Doesn't affect. Closing inventory was valued at 620 on that 1st December 2019. Doesn't affect. So we are done. So from there we do the computation. So we are going to add the totals on this side and compare to the total on this side. Actually, we have seen the balance brew down is 0 and also balance brew down here because we started or they started the business at the beginning of the current year. So there was no balances from last year. So it's all about the total on this side would be now the credit sales here. Credit sales. So we add them 5,200 thousand plus 118,000 plus 82,000 plus 1420, which gives us 6820,000. And this one, 6820, should be the totals, 6820, because we now have written the balancing figure. So then this one, we transfer it here. 6820,000, which we should be able to add now the cash. So we'll start by taking 7200 plus 6400 times 52. So it will be 7200 plus 6400 times 52 weeks, because that was per week. That becomes 707,200 plus 35,000 plus 162,000 plus 138,000 plus 700,000. Then now we add this one plus 6820,000. 6820,000 giving us 20,562,200. That is the total. We come here, we add this plus this. This is 0, so that will be the credit purchases. So this plus this, 132,500 plus 780,000. So that will be 912,500, which will be here 912,500. 912,500. We transfer that one here, 912,500. And then now we add the cash purchase. So plus 9,900, which give us 10,812,500. There. With that one now we can prepare the statement of determining the taxable income. So we'll come here, the name of the partnership is Kashi Enterprise Partnership. We get the taxable income for the year ended 31st of December 2019. So we start with the sales, which we had determined 20,562,500. Then we less cost of sales. Cost of sales, which we take the opening stock. But here you'll note that we were not given the opening stock because we started the business at the start of this year. So there were no opening stock from last year. So 0 plus the purchases. Purchases is what we have determined here. 10,812, 500. Then we minus the closing stock. Closing stock is the one given in point number 11, 620,000. So minus 620,000. And then we also minus any item that could have reduced the stock during the year. Damaged, withdrawn stock, stolen, of which case the whole of this question, we didn't have any stock that was stolen, damaged, or withdrawn by the partners. There was none. Let me confirm properly. There wasn't any. The drawings that we are given in additional information, number 1 was cash drawings, not goods. So in this case, we cross to get the cost of sales. Cost of sales, which will be the 10,812, 500, you minus 620,000. And that gives us 10,192, 500. And then we can be able to get the gross profit. Gross profit will be, we minus that from 20,562, 500. And that gives us 10,370,000. Then we said this, after getting gross profit, and the reason why we call it gross profit method is to add other taxable operating income. Other taxable operating incomes. Other taxable operating incomes. Of which case we said you jump a space of like 3 lines and then you less. I want to bring this one here, 1,000. So you less allowable expense after jumping around 3 lines. Allowable expenses. So what we do now, we go through the whole question. If we come across a taxable operating income, an allowable expense, we post here. We start from the top. The first paragraph was about the salaries to the partner. We said anything to the partner we don't allow. It's an expense yet, but not allowable, so we cannot post. We go to the summary of the bank statement. On the receipt side, capital is not an income or an expense. Cash sales, we used it to get the sales. Receipts from debtors, we use it to get the sales. Sales from the van, we said income from selling fixed assets, we don't tax, so we cannot post here. We go to the payment. Equipment. Equipment is a fixed asset, which we should claim capital allowance at the rate of 10%. But we won't do that. Why? If you look at additional information number 10, we are told the wear and tear allowance, which we said is the same as capital allowance, was agreed with the revenue authority to be 112,000. So that's the one that we use. Anywhere we require to compute capital allowance, we use that. So we can even post it now. The capital allowance, also called WTA or wear and tear allowance for the year. It was agreed to be 112,000. From there, we go back to where we found that in the bank statement. After equipment, rent for go down. That's an allowable expense, rent expense. But we have an additional information to that rent. If something has an additional information, check it out. In additional information number 8, the go down has been occupied since 1st November 2019 at an annual rent of 450. So annual is per year. And now it was occupied from 1st November. Those are 2 months. So forget about the one that you are given. Use the one that you can get for this particular year. So in this case, we are going to take 2/12 times the 450 because it was only occupied for 2 months to the end of the year in this particular year. So this is going to be 2/12 times 450. That will be 75,000. That is the one that we allow. Any other, we forget. Then we go back. After the rent for the go down, salaries and wages. That is allowable. But we have to check whether it is mentioned somewhere else. Salaries and wages. Yes, it had been mentioned in additional information number 7. The salaries and wages include the salaries paid to the partners. Salaries. And here they have made it very clear that it is salaries and wages. Another place that we have wages now mentioned is number 1. The following payment made through the cash from the banking. So we have the wages. So what do? We'll come here and have the salaries and wages. So we open a bracket. Remember, we want to know the allowable salaries and wages for this year. 890,000. And then now we have to add the one that was paid through the cash. This was through the bank. The cash was 162. And then number 7, it includes the one paid to the partners. So we have to remove because we said anything to the partners we don't allow. To the partners was how much? In the first paragraph is where we were told the monthly salaries to the partner was 18 and 22,000. Monthly, underline monthly. So meaning to get the whole year, we have to take minus 12 times 18,000 plus 22,000. So that we can get, and since it is not mentioned somewhere else, we do the computation. So we take first of all the 18,000 plus 22,000, and then you multiply by 12 months because it was monthly, we get for 80,000. Then we remove them from this. So we take 890 plus 162 minus 480. That gives us 572. That's the one that we should be arriving there. After that, we go back to where we found the salaries and wages. After salaries and wages in the bank statement, purchases for resale, that we used to get the purchases up there. Repair and maintenance, that is another allowable expense. Repair and maintenance. So we check if it is mentioned somewhere else. There isn't. So we just pick the figure as it is, 860,000. After that, we go back. After the repair and maintenance, there is insurance. Insurance is also a allowable expense. So we have insurance. Is it mentioned somewhere else? Yes. Additional information number 3. As at 31st December 2019, electricity and insurance prepaid. So this was prepaid, and it's at the end of the year. We said prepaid at the end of the year is for next year, not for this. Anything that is not for this year, we minus. So we are going to take the insurance of 62.5, and then we minus the prepayment, which we have 12,800. That will give us how much? This will be 62,500. We minus 12,800. That gives us 49,700. After that, we go back to where we found the insurance. After the insurance, there is interest expense. Interest, we said, is allowable. So interest expense. But it is mentioned somewhere else. In additional information number 9, included in the interest expense is the interest on partner's capital contribution at the rate of 5%. Included in interest. Anything to the partner we don't allow. So we will take this interest, which is 612,000, and then we minus the one that was paid to the partners, which was 5% of the capital. The capital is in the bank statement, where we have for the two partners 3,500 plus we have the 2,500, that is 2,500,000. That. So we add the capitals, which are 35 plus 25 times 5%, which give us 300,000, and we minus from 612, that give us 312,000. That's the one that is allowable, the one paid to the partners. Then we go back after the salary, after the interest, after the interest. Motor vehicle expense. Motor vehicle expense is allowable, and we say that is not the cost of motor vehicle, it's the vehicle expense incurred to run the motor vehicle, fuel, repair. So in this case, that is allowable, not a fixed asset. Motor vehicle expenses, where we are told the motor vehicle expense is 186,500. After that, we have sundry expense. Maybe there is something that I should have confirmed. In additional information number 1, there is more motor vehicle expense. The one that was paid in cash, 138. We forgot about that, so we should add it. So it will be 186,500 plus the one that was paid cash, which we have 138,000. 138,000. We check if it is mentioned somewhere else, but the motor vehicle is not mentioned anywhere else. So what does that mean? Then that means that we do the computation. 186,500 plus 138,000, which we get that 245,000. That 32,4500. Then we go back after the motor vehicle expense. We have sundry expense. Sundry expense is an allowable expense, so we continue. Sundry expenses. And this one again, it is mentioned somewhere else in additional information. Number 1, the one that was paid through the cash. So we'll have 218,000. And then we add the one that was paid through cash, which we have 35,000. Which we have 218 plus 35,000, which give us 253,000. Then we go back after the sundry expenses, motor van purchased. That's a fixed asset which we should claim capital allowance. But remember, we were already given the capital allowance, so we ignore. Tax penalties, we said any expense relating to tax we don't allow. Electricity expense, that is allowable. So electricity expense, but we check for the additional information. If you go to the additional information number 3, we had electricity prepaid, and we said prepaid is for next year. So that one we need to remove. We need to minus, because of what was paid this year of the electricity, 45,800. Part of it is for next year, and so we should minus from here, where we have the 25,000. That gives us 2,800. Then we go back to where we found that. After the electricity, there is medical expense. Medical expense are allowable unless we are told it was relating to the partner, which we haven't been told. So medical expense. Medical expenses 630,000. Then now we go to the additional information for any taxable, operating, or allowable expense. Additional information number 1, the following payments were made in cash from cashes. Motor vehicle expense we have considered, wages we have, sundry expense we did, weekly drawings, those are not allowable expenses. Additional information number 2, those are the figures for the balances of debtors and creditors at the end of the year. So they are not incomes or expenses. Number 3, we have already adjusted for them. Number 4, depreciation. Remember, we said depreciation is not allowable. We claim capital allowance instead, which we have been given. Then number 5, as at 31st December 2019, the amount owed to supplier was 780, while the amount owed by customer was 1420,000. That we had said actually, there's something, there's additional information we jumped. We jumped number 2. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118. Discount received, that we know is a taxable operating income, so it should come here. Discount received, that is a taxable operating income. And we have the discount received of 132,500. And then we have the discount allowed. Discount allowed is an expense and it's allowable. Discount allowed. Discount allowed, which we have been given as 118,000. There. From there we continue. We were actually in point number 5. That's where we were saying that we had the balances at the beginning and also at the end. And then from there, number 6. An amount of 82,000 owed by Jamira Mamba, a customer proved irrecoverable, and it is to be written off as bad debt. This amount was excluded in the total amount owed by the customer as at 31st December 2019. That is a bad debt written off, which we said is allowable expense. So we'll have bad debt written off. Bad debt written off, which we have an amount of